chairman is doing the left. And it's good to see you, Jay. And I can see what Gensler is saying. So right now there's no standardization. So he would like it to be where everybody is reporting this stuff the same way. As if that's even remotely possible, given the complexity of the issue, and especially the way that they're approaching it, where it wouldn't just be the company, but it'd be anybody who supplies the company. You got to know about their emissions. And even once people use your product, the customers, you got to know about the emissions that you're somehow going to be generating. The logistical nightmare in and of itself boggles the mind in terms of what it would take in terms of time and expense. I'm sure the big four accounting firms are like, wow, this is amazing. But they couldn't get any closer to reality than where it is right now.
Well, look, Joe, thanks for having me. And I want to say that I'm sympathetic to the position that Chair Gensler is in trying to respond to calls for more standardization here. But you hit the nail on the head, which is in order to have what I would say is a standardized approach or a common approach or an ability to think about it, you have to have a climate policy to begin with. Now, we have a climate policy today, and companies are doing I think, a very good job, if you look at the disclosure of public companies, in addressing what that climate policy means for them. But there's a movement afoot, and I'm sympathetic to some of the voices here that say we need to do more. But we don't have a set climate policy in this country. We don't have carbon neutral 2050 or something else as a climate policy. And so what the SEC is doing here is, in essence, assuming a climate policy, because it's picking which metrics are important and which ones aren't. And you can't do that unless you assume what the climate policy is. That's not the SEC's role. That's as simply as I can put it. And you put a super background on it by saying, look at all the complexities that need to go into what your climate policy is going to be, because it necessarily includes energy policy, housing policy, transportation policy, not to mention national defense and our place on the world stage.
I mean, the SEC's job is for fair and open markets. This is another attempt at, a backdoor way of allocating more capital again, or that's the way it would be used. And if so it was voted for 3-1. There's 3 Democrats. The 3 Democrats voted in favor of it. There's no way this passes muster with the court. Back in 2015, there was something similar. It wasn't nearly as nutso as this, and that didn't even pass. This is not the SEC's purview, not even in the craziest sense of the word.
And that's what Patrick McHenry and I said in the op-ed that we put in yesterday, and I think the Journal picked up on it today, which is this is a step on the way to the courthouse. And I think there's not really a rational analyst of this that doesn't see it that way. There are 2 points around authority and expertise here. One is, does the SEC have the expertise to pick the metrics and the like? Of course, look, the people at the commission are some of the best people I've ever known. Jay, they do an incredible job, but they're not climate scientists, okay? And then the question is, statutorily, do they have any basis on doing this? We have an EPA. There's the technical term is the major question doctrine. Right. Shouldn't this first be in the EPA? But does the EPA even have authority to set something as
pass a law?
Yeah, it's Congress. It should be a Congress.
You have to go Congress, but I'm just thinking, okay, so Exxon, I could see, all right, you might have a chance of being somewhere in the ballpark of what's going on, maybe even with their suppliers, maybe even with their customers. But pick just your average company, a consumer goods company. I mean, how is Price Waterhouse or whomever, how are they supposed to look at a normal company's business and figure out the material climate impact of what they do, what their supply chain issues coming from the Far East, wherever they get everything, what that's going to mean, and how their customers are going to impact? It's insane. It's just no way. No wonder it's not standardized. It's impossible to do.
Yeah, I think David Novak, who I respect a lot, was on talking about response to sanctions. Okay, sanctions. Right now, he said something very important. He said every company has to approach this differently. If you're sending goods, you're sending textiles, sneakers or something, it's pretty easy to deal with that. You just stop shipping the sneakers, you do what you can for your employees, you do all of those things. But for every company doing that, doing what you can for your employees, they still have to get paid. So financial institutions that have relationships into Russia, they need to think about what's happening with all these other companies. They can't go cold turkey and, sort of a binary cutoff. It's the same thing, only much more complicated with something like climate policy.
I mean, this would be expensive and cumbersome, and I think it's kind of ironic. We've been having the discussion about, Russia being somewhat emboldened by Europe's acquiescence for providing its own energy, sort of giving up on nuclear, giving up on other things. And then we come to, we don't want that to happen domestically, but you saw the executive order the Biden administration put out in January of 2020 on climate. It basically, I mean, the overall purpose of it is to make it less likely you bring hydrocarbons out of, or at least you price it higher so that you hurry the transit. This is coming right in the face of what we've been talking about for the past 3 weeks. They're doing it right there. It's amazing. The hubris.
Well, Joe, look, let me just say this. If you're going to have a whole of government approach, the place to have the whole government approach is Congress and the White House.
Right. Instead of this.
It's kind of that simple.
These, because they're, I don't know. All it does is just sort of cause a lot of controversy, but it doesn't really, nothing really changes, and it doesn't really accomplish anything.
And I look, Patrick and I said this, and I, I'm not going to hide the ball on this. It's easy for Congress to push these hard questions to agencies because they can say, "Hey, look, I'm doing something here. I'm banging on the SEC, and I'm very sympathetic to the folks on the SEC responding to that. I'm banging on the SEC to do something about it, but not do something about it themselves. It is a political buck pass."
All right. So we had the executive order. Then we had, possibly the Fed needs to get involved. Sarah Bloom Raskin. So that was going to be a backdoor approach to trying to I don't know, control the marketplace instead of just make sure the marketplace is fair and open. It's a way of actually allocating capital. So we're going to use every government agency to try to allocate capital.
And also let me go to that, Joe, because you raise it. We've done incredibly well in the economy, in the banking sector, the capital markets sector, by trying to make the dialogue between companies and investors fair, open, honest, enforceable. But we've done everything we can not to put our thumb on the scale of capital allocation. And because I think that if you start doing that, you undermine all those other key tenets. It is for investors on the one hand, and companies on the other, to have that dialogue and make those capital allocation choices, not the government. If the government wants to make capital allocation choices, we got the tax code. And the tax code is how you do it across the board, not just for public companies, but public companies, private companies, foreign companies, et cetera. If that's where, if you want to allocate capital and favor capital, you have the tax code.
Yeah, I mean, for a while we're watching crypto and Gensler's efforts there and stuff, and I had to commend him on some of that, but I got to be honest, this makes me think, wow, I'm not sure what to think.
Look, I think Gary's doing a fabulous job on a lot of stuff.
Right.
I just think that this is one of those things that's outside their authority and jurisdiction, and right. I'm not alone in that.
No, I guess not. I try not to show where I come down on these things. Anyway, thank you, Jay Clayton, former SEC. It's good to have you on. Anything else going on that you wanted to talk about today? Or this you wrote an op-ed. You wrote an op-ed. There's another one today. So this was good stuff. And we'll talk to you about something else later next time.
All right. Hopefully. Thanks, Joe.
Okay.
Good to see you.
Good to see you.
Oh, Joe, that's you trying not to show how you think about things?
Exactly. It's hard. It's difficult on these contentious issues.
You do such a good job.
Yeah,
I have no idea where you stand on things.
But just stuff
anyway,
like this.
When we come...
my first question was almost on a scale of 1 to 10. There's bonkers down here, and there's just absolutely nutso bonkers up here. Where would you put that? It's just like an 11. Anyway.
I heard. Anyway, when we come back, we do have much more on the markets and what you need to know ahead of the opening bell. Should point out the Dow's indicated up by about 155 points, plus the latest on the crash of a Boeing 737-800 jetliner in China. Squawk Box will be right back.
Let's get a check on how the markets are set up this morning. The S&P 500 indicated higher by about 11 points. It was roughly flat yesterday. The Dow fell 200 yesterday. It's gaining back most of that in the pre-market. NASDAQ was down about 55 yesterday, and it's got a small gain so far. Treasuries this morning really are the story, adding to their gains in yield. You see the 10-year note there, close to 234. Shorter-term maturities moving much faster. The 2-year yield hit 2.2% at some point this morning. Federal Reserve Chair Jay Powell vowed tough action on inflation, which he said jeopardizes an otherwise strong economic recovery. In prepared remarks for the NABE policy conference yesterday, Powell suggested rate increases could be even higher if necessary than the quarter percentage point move approved at the last meeting.
If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
We will talk markets and hear from Dynamic Funds' Noah Blackstein after the break about the remarks and what investors should be doing with their portfolio. Swap Box will be right back. Let's talk markets now with Noah Blackstein, Senior Portfolio Manager at Dynamic Funds. Noah, good morning.
Hey, good morning. How are you?
I'm good, thanks. You know, I'm glad to have your perspective here on what does and what doesn't matter for growth stocks and their relative performance. I see that you're with me on this idea that, you know, higher interest rates in themselves don't really explain much of the story with growth stock valuations, the boom bust that we've seen so far. But what do you think mostly has been driving things? I mean, we have this massive relative peak in growth back in November. It's been a tough 4 months.
It's certainly been a tough 4 months. I think this narrative that growth stocks are somehow interest sensitive and the higher rates go, the worse it is for growth stocks. It's just Certainly been true probably since the fourth quarter of 16, but historically hasn't been true. There's been a positive correlation with higher rates and growth stocks. So, I think a lot got lumped into the growth stock category. A lot of, science experiments, no revenue, no earnings companies, a lot of just absolutely atrocious things that were thrown into SPACs, which everyone ran around and called growth stocks. But I think that shakeout has happened. And, typically growth stocks have had a positive correlation to rising interest rates and a stronger economy. So I know there's a narrative going around that, the higher rates go, the higher the discount rate is, and that means growth stocks are worth less. I mean, that's an answer you'd expect from a first-year business student, and even worse, perhaps one of their professors. But fundamentally, it isn't true, and seemingly intelligent people have reiterated it. So I'm not sure where it comes from. What matters most is the strength and the duration of that E, or that earnings growth, and thus far we've seen through earnings season some fairly strong growth, and the economy remains, to this point anyway, fairly strong.
Well, where does that leave you in terms of just looking for stocks either that have been, way too punished or stuff to stay away from? You were saying before, the average pullback in a NASDAQ stock is close to 50% from high to low.
Yeah. Look, I mean, I've been running the same fund now since the late 1990s. And so what's gotten me through every bear market I've been through is companies with actual revenues and actual earnings are the first place to start. And there are quite a few with a number of secular growth trends. Having said that, there was obviously a big surge in work from home stocks, for example. But even in some of those companies, there are companies that were trading a year and a half ago at 50 times revenues that now trade at 25 times earnings. So, I would say that, continue to focus in on the secular names with revenue, with earnings. But there's so much carnage, especially in some of the other stuff with actually pretty good companies, that some of those, especially the ones that, oh, that's 50 times revenues, don't look at it. I go, actually, if you look at it now, it's trading at 25 times earnings. Some of those stocks that were in the work from home space have been absolutely decimated. So always start with revenue and earnings in companies that are continuing to grow, for sure.
I mean, one of the interesting aspects of this environment is, nominal U.S. growth has been higher than anyone's ever seen, right? I mean, 11% last year with inflation plus real growth, and that's just the top line for your average company in some sense, right? So if every other basic non-growth business is able to post pretty good top-line growth, does that mean that those typical growth stocks are going to stay in the penalty box because I can just go and buy cyclicals right now?
Sure, and I think that's what was going on. If you look at what I think was the bigger driver was just you had these companies that were able to grow through the pandemic, and then you fast forward a year later, and then everyone's growing at very high rates. Even some of the worst retailers in the world that were growing at 40% year over year because the comparisons were so easy. But now we're in a situation where financial conditions continue to tighten and the yield curve continues to flatten. And that abundance of growth, which is certainly out there, isn't going to be the same as the year-over-year comparisons in 2021. And so I think the number of companies that are going to be able to continue to execute and grow at those high rates is going to continue to get slimmer as we move forward. I'm not forecasting a recession. Obviously, we're always looking at the shape of the yield curve and credit spreads to give us an indication of that. But to see the Fed this aggressive and the yield curve this and flatten this much and continue to see people buy deep cyclicals certainly is something I've never seen before.
Yeah, you would think that maybe it's going to become a less generous environment. Noah, I appreciate your time today. Good to speak with you.
Thanks, Mike. Take care.
It is now 2 minutes after 8 a.m. in New York. You're watching Swap Watch live from the NASDAQ market site in Times Square. I'm Joe Kernan, along with Becky Quick and Mike Santoli, and the futures are positive in the green today. Good week last week. A little pullback yesterday. Not much to speak of, though. In the headlines this morning, Canadian Pacific Railway is resuming normal operations this morning after the company and workers agreed to binding arbitration to resolve a labor dispute. The railway, which is an important part of supply chains in both the U.S. and Canada, had halted operations and locked out workers over the weekend. And another labor dispute is taking place at a Chevron, California refinery for the oil company, a major producer of gasoline and jet fuel. More than 500 members of the United Steelworkers Union have gone on a strike after a contract proposal was rejected. However, the plant continues to operate normally and industry analysts say the strike should not impact supplier prices. And Nike shares are higher this morning after the athletic apparel and footwear maker reported better than expected quarterly profit. Nike says consumer demand for its products continues to outpace supply, although it is seeing higher freight and logistics costs, and they specifically mentioned North America for the good results. Back.
That's right, strong consumer there. Right now, let's get over to the crash of the Boeing 737 jetliner in China. Rescuers combing through the wreckage of it.
I think we've got an audio issue there. Like he was saying, the wreckage of the China Eastern Airlines flight carrying 132 people. We want to get back to Phil LeBeau, who joins us with 24 hours later and what we know. Hey, Phil.
We don't know a whole lot more, Joe. In fact, we are expecting to hear from authorities in China who are at the crash site. An update, if you will. Not sure what exactly they're going to tell us, but we're expecting that any minute now. No survivors are expected from this crash. I hate to be the bearer of bad news, but when you take a look at what this crash was and how the plane at the steep level of impact, nobody is expected to have survived. Black boxes have not yet been recovered. We're talking about the cockpit voice recorder and the flight data recorder. The NTSB is assisting in the investigation. China will lead the investigation, but as is usual protocol, whenever there is an accident with a U.S.-made aircraft overseas, that country does the investigation. The NTSB assists. China Eastern, which operated the aircraft, is grounding all 102 Boeing 737-800 planes in its fleet. The 737NG planes are 26% of the China Eastern fleet. Unclear how long they'll be grounded for, if this is just for a few days or for a week, will remain to be seen. But for Boeing, this is a huge deal because China is the largest market for the 737-800 planes. They really are the bread and butter plane, if you will, that Boeing has delivered over the last 25 years. It has a strong safety record. We talked about this yesterday, and this will continue to be a theme, that this is one of the safest airplanes in commercial aviation. As you take a look at shares of Boeing, keep in mind that there is the other story here, which is what impact this crash may have on the 737 MAX returning to service in China. It's been cleared by regulators there to resume commercial flights, though no airlines have put it back in service yet. And we still have not seen a 737 MAX delivered to China. And that's what we're going on 3 years now. There's a number of them that are parked out in eastern Washington that have been built, that are ready to be delivered, but those deliveries have not yet resumed. So a lot of questions that need to be answered. I'm not sure how much we're going to get from the authorities when they hold their press conference here in the next few minutes in China, but we'll be watching it and we'll let you know what they have to say.
Phil, thank you. We will look for you in the updates.
All right, shares of Alibaba jumping in Hong Kong overnight. The company announced an increase in its buyback program. Eunice Yoon joins us with more on that move. Hi, Eunice.
Hey, Mike. Alibaba shares closed higher by 11%, and this is after it unveiled an expansion of its repurchase program from $15 billion to $25 billion. So this makes it Alibaba's largest ever. The repurchase program is going to be effective for the next 2 years, and this is the second time that the e-commerce giant raised its buyback scheme in a year. The last hike of $5 billion took place last August. Now, Alibaba's deputy CFO said the upsized buyback is meant to reflect what he said was the confidence that people should have in the long-term growth of the company. Alibaba, along with other tech majors, has been grappling with a whole host of issues, of course, the tech regulatory scrutiny, as well as worries about slowing growth. The government here has been trying to shift the concerns in the stock markets, trying to improve the negative sentiment. Today, the front page of the Official Securities Daily ran a commentary which said Beijing would be proactive to support stable market development. It would correct policies that hurt market expectations, and that it believes stable foreign investment is the only way to achieve high-quality growth. Now, again, this is the latest effort by Beijing to try to signal to the market that the priority here is stability. Guys?
Yeah, Eunice, that $25 billion buyback authorization, it's pretty significant given the size of the company at this point after the declines, more than 8% of Alibaba's market cap before this latest move. Does it say anything, do you think, about the Chinese authorities' message about how these companies should be thinking in general about allocating capital. In other words, is market stabilization, is helping their stock valuations now a priority over expanding, whether globally or anywhere else?
Yeah, well, I think that market stabilization is the priority. And in fact, there were several analysts today who said that this share buyback scheme is probably a good thing for Alibaba because at the end of the day, the government measures are still there. And maybe there aren't going to be as many opportunities for Alibaba to expand, to make new investments, to do everything else that it was doing to try to really broaden out its empire. So I mean, I think you've struck the nail on the head there because the government continuously, this is the third time now where we've heard from two very high-level officials, the premier this week, the vice premier last week, where they're really trying to hammer home that stability is very, very important at this stage for the capital markets, for the leadership here.
Yeah, it seems like trying to put a bottom in that market might have worked. Eunice, thank you very much.
When we come back, Disney facing employee backlash from the company's response to Florida's controversial Don't Say Gay bill. We will have the latest on that conflict next. Plus, Maryland Governor Larry Hogan on why his state decided to suspend its gas tax. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box on CNBC. Disney is trying to address employee frustration over its handling of Florida's so-called Don't Say Gay bill. But today, some workers are planning a walkout. Julia Borston joins us now with the latest. Good morning, Julia.
Well, at a virtual meeting yesterday, Disney CEO Bob Chapek acknowledged missteps and announced new plans to help address that employee frustration. Chapek said that he wanted to use this moment as a catalyst for meaningful change. In addition to working with those of fighting the Florida bill and pausing donations in Florida, he announced 3 new steps the company is taking. Chapek is going on a listening tour to hear employee concerns around the world. He announced a new company-wide task force to develop strategy and concrete actions to engage LGBTQ+ employees and creators to be a force for good for those communities, with a special focus on developing more LGBTQ+ content. He also revealed that the company has signed the Human Rights Campaign opposing the Texas policy that criminalizes parents providing gender-affirming care for transgender minors. Now, these moves address many of the demands of the group that organized the walkout that is scheduled for this morning. Those demands include requesting that Disney cease donations to politicians involved with the bill, commit to an actionable plan, and reaffirm the commitment to protecting LGBTQ+ staff. Now, sources tell me that the temperature, the level of outrage at the company has cooled since last week as employees see Disney engaging with these issues. Mike?
Julia, in fact, I was going to ask that if the employees who are upset and maybe leading these walkouts, are there things incremental beyond what Chapek has committed to in terms of engaging with these issues that they're specifically looking for from management?
Well, look, I think we'll learn more today, and it'll be very interesting to see how many people walk out. But a lot of people told me that they saw what happened yesterday as an important first step. I mean, this meeting, this virtual meeting that Chapek held, ended up going longer than the 90 minutes that had been planned for it, and it sounded like it was very emotional. And one thing that I heard from a number of people is that they brought in a lot of outside experts, people who are in Florida, who are dealing with these issues and who are fighting these types of bills, similar to the Don't Say Gay bill around the country, and also that they're really listening to their employees now. But this, they've all told me, is just the first step. Now the question is, what does Disney do next? What does this task force look like? And sort of what are the next steps to making sure that Disney follows through on the conversations and promises that it's made in the past week or so? So it seems like this is a valuable first step, but you know, the question is what is the action that follows?
Yeah, maybe a secondary question is, what's the future of Disney's longer-term political engagement in Florida, which has been very extensive, of course, over the years. Julia, thank you very much.
Join us now to talk about these latest challenges for Disney and how much Bob Chapek has lost in this fight and what it all means for shareholders. Sarah Fisher, Axios media reporter, and Matt Maloney, he is the Puck News founding partner. Matt, just reading one of your pieces from, I guess, so it's about a week old, I guess, from the 14th. But you just say it outright. You think Bob Chapek was trying to pivot to the center from the perception that Disney was too far left, and this was a miscalculation that backfired?
I think it's pretty clear it backfired because of everything we've seen over the past week and the fact that he literally had to flip-flop on the issue and come out against a bill that they had decided to not take a position on. And, you know, it caused a firestorm. And this is a narrative that has been created around Bob Chapek, that he has sort of been tone deaf to some of the issues that are important to not only Disney employees, but some of the talent that are so important to the success of the company.
And since it's been a week or so since your piece, has he pivoted back to the point where he's, is it possible to do enough damage control in your view for him? Is it sounds like the tempers have cooled to some extent. No one knows, you know, how many people are going to be at the march and whether it's still as front and center as it was a week ago. You think it's working, these initiatives?
I think these steps are a positive change. The first and most important was that he apologized to employees for the position that he took. And he said he recognized how important it was to take a position on these issues. I think Julia is exactly right in that it's going to be proof in the pudding what they actually do on these issues going forward, because the entire company is now watching every step that he makes. And it's going to be a gradual, but I think a positive thing for him to engage directly on these issues, because everyone is watching and he's got a year. This is a CEO whose contract is up in February of next year. And if he can't fix these morale issues and these perception issues within the company and outside, he's got a real problem.
Sarah, what have you, in terms of the last week or so, what are your, just go off, what are your comments on the whole situation?
Well, one, it's notable that this is Florida. This is a state where Disney has, I think, 80,000 employees. Many of them are LGBTQ. And so it's going to have to deal with these types of political issues moving forward with Ron DeSantis as governor. This is an opportunity for him to elevate his own political cachet ahead of a potential 2024 run. And so this is the first time that Bob Chapek might be running into this, but it's not going to be the last. The other thing I know is that there's some whiplash happening right now with Disney employees. You had Bob Iger, who was leading the company for many years, an open Democrat, somebody who was considering a presidential run as a progressive. He took swift action in response to a lot of these political situations. You think back to the Georgia heartbeat bill. You think back to his handling of the Jamil Hill controversy. And so I think employees were expecting their CEO and their leader to come out in support of them. Now, as Matt has reported so well, that the company is looking to shift a little further into the center, I think it's going to have to reckon with how that move can impact internal morale. And, the big picture thought here is this is one piece of politics that Disney is going to have to deal with. But think about all the things around the world they're going to have to start addressing. You have Russia. They were the first studio to pull out. You have drama in China. Bob Chapek's going to have to figure out how to manage all of these political controversies seamlessly going forward as the company's CEO.
Yeah. And Matt, you actually had some anecdotal knowledge about, I guess, did Bob Iger and his I guess Willow ran into Chapek at a restaurant. How did that go? What was that like? Can you describe that?
It wasn't Chapek. It was his chief communications officer. I was actually randomly having dinner with Jeff Morrell, who runs communications now for Disney and is one of the architects behind this shift to the middle politically. And he had actually never met Bob Iger. And we were sitting at a restaurant in Brentwood in Los Angeles, and the Igers were having dinner a few tables away, and they met and they chatted cordially and they were very nice. But to me, the tension there was pretty palpable because Iger, I think, could see what was coming with this controversy. And he very deftly had navigated a number of controversies for Disney in his tenure. And, Disney is different. It's not like other companies. People have an emotional connection to this brand. They plan their entire family vacation around going to this brand. So you have to really tread carefully when you are taking positions in the world because people look at what Disney does and they feel what they do. Well,
didn't Chapek hired this guy, right? And it knew exactly. How do you think it happened? Do you think that that the new communication, Morrell, do you think he advised Chapek to move to the center? Do you think Chapek said, I want to do this and I want you to help me, I don't know, what, Republicans buy sneakers too? Was that the rationale?
I think so. I mean, you have to ask them exactly how the conversation went, but it's very clear that both Chapek and his communications chief, Jeff Morrell, they have made contributions in the past to Republicans. Jeff Morrell came from BP, the oil and gas giant, and the chief of staff at Disney also comes from kind of conservative politics, the Bush administration. So the kind of brain trust around Bob Chapek is a more conservative brain trust than what the previous CEO, Bob Iger. Which is fine. I mean, the previous head of communications from Disney also had a background in Republican politics, a little bit more moderate, but it doesn't mean they can't successfully manage the communication strategy for this company. It just means that they need to be very cognizant of reading the room and knowing that when you are a creative company with 200,000 employees, you have to be cognizant of the LGBTQ issues and the fact that people at this company feel very strongly about these issues. And they've been trained to expect that the CEO will speak out because of what Bob Iger did over 15 years. So I think that they have perhaps learned their lesson here. We'll see how it goes moving forward. But I think it's going to be, I think it was a real wake-up call.
Sarah, we're not really talking about Florida or legislators, and then we didn't really talk about Georgia and legislating. I guess we don't talk about Texas and then the legislature there. I mean, all these laws were passed. I mean, if the voters there have the ability to change things. And I know we talk about all the companies and their reaction to the votes in these different states. It's kind of strange because it's kind of one step removed from the people that are actually involved with passing these laws.
Something major happened during the pandemic, though, which was that there was a huge shift in America where people started to place more of their societal trust in corporations and business leaders as opposed to government. If you take a look at who handled the vaccine rollout, it was private companies. It wasn't the government. And so as a result, there's more pressure on CEOs nowadays to address political issues in various states as they come. Now, if you're a company like Disney, and Matt just spoke to this, and you have an employee base of thousands of people who either are LGBTQ or are allies of the LGBTQ community, you are almost forced to ally with them in many of these situations, or you're at risk of losing talent. Look at Disney right now. They're trying to compete with the biggest tech companies in the world when it comes to streaming and creative talent. They can't afford to lose these people because they're not going to speak out on issues in the correct manner. If you take a look at Pixar's response to what happened with Disney, they even opened up a new can of worms last week saying, you know, it's not just about this bill. We don't think that you guys are letting us represent LGBTQ voices in our own creative. And so I think the new reality, Joe, is that unless you want to open that can of worms with your employees, you have to take a firm stand on these social issues. And if you decide not to, be prepared to have backlash from your talent pool, and that could impact you long term.
Right. And then it eventually affects the company in a big way. All right, Matt, it wasn't in, Bellany, it wasn't in there. You know, they should put rhymes with felony in the notes. They should, and it wasn't there. So I apologize. Matt.
No problem.
All right, good, Matt. And Sarah, your name, Fisher. I mean, how am I going to mess that up? At Axios. Anyway, thank you both.
There you go. Or Axios. Anyway, when you come back, the company whose COVID drugs it claims are close to working on almost any variant. We will bring you that good news story next. Plus, we'll be speaking with Maryland Governor Larry Hogan about his state pausing its gas tax to give drivers some relief at the pump. Stay tuned. You're watching Squawk Box, and this is CNBC. Some news on the COVID front. Despite Omicron fading in the United States, a new biotech company is pushing for even better drugs. Meg Terrell joins us right now with more. Meg, good morning.
Good morning, Becky. This company is called Arium Therapeutics. Arium is apparently Latin for airborne. And the goal is to develop better drugs for COVID right now, including working on potential future variants, but also to develop drugs for future potential pandemic threats. Now, the nearest term application is a combination of antibody drugs that the group has developed with some scientists from Switzerland that they're going to be testing for COVID prevention, planning to start human trials this summer. They have preclinical or animal data. So far, they've put out a preprint. It's not yet peer-reviewed, but they say it's very promising compared with what else is already out there. The team is very familiar to pandemic preparedness and to the biotech space. The CEO is Dr. Rajiv Venkaya, the former head of the vaccines business at Takeda and the architect of the original pandemic plan in the United States under the George W. Bush administration. Atello Stampacchia from Omega Funds is the executive chair, biotech VC that's the founding investor of this company, along with F Prime Capital. And John Maraganore, a very familiar biotech face, the recently departed CEO of Alnylam, also involved on the board here. We talked with Dr. Venkaya yesterday about this promising set of antibody drugs and what they see in them. Here's what he said.
What we've tried to do with these antibodies is look at all the ways that a situation could arise that makes the antibodies ineffective and say, what's the likelihood that that's going to happen? And if it happens, are we likely to see those variants or strains emerge in nature? So far, we haven't been able to see that. And so it gives us hope that this could be useful for near-term variants arising from Omicron or from Delta.
So, of course, guys, we've seen how quickly these great antibody drugs can be wiped out by a surprising new variant. They say, based on their data now, they don't expect that to happen, at least on the near term. And they expect a pretty quick development pathway through trials and getting through the FDA. Becky?
Hey, Meg, where's the market for this, just in terms of where does the money come from? If you're talking about a pandemic that has waned, at least in the United States, as best as we can tell, if you're talking about some funds starting to run out for testing in other places that have been there, this seems like a really important plan. We all know COVID's not going away, but who's spending on it? Who's willing to put up the cash right now?
That was exactly my question, Becky. When we're at a place where Congress is at a stalemate over providing new funding for the COVID response, is now the right time to start a company based on these threats? And they acknowledge that they will need government funding to support these kinds of endeavors. Obviously, they are getting private funding from the biotech VC space right now, and they're also going to be pursuing partnerships for manufacturing and things like that. But it requires society and governments coming together and agreeing we need to keep investing in these kinds of threats, including the one that is still here in COVID. But it's going to be very interesting to watch how Wall Street and government and other kinds of, public health funders respond to an initiative like this.
Yeah, it seems like it requires us being better prepared than we've been in the past, even when it's kind of spelled out right in front of us. Meg, thank you very much. Meg Terrell.
Coming up, Fed Chair Jay Powell vowing tough action on inflation. What does that mean for the big financial stocks in your portfolio? We're going to speak with a banking analyst, but next we're going to have a gas tax suspension in Maryland, the first place. Will that make a difference for drivers struggling with high fuel prices? We're going to ask Maryland Governor Larry Hogan, who just signed some emergency legislation into law. Stay tuned. You're watching Squawk Box on CNBC.
Maryland is the first state in the nation to pause its gas tax as fuel costs have surged nationwide. Governor Larry Hogan signed emergency legislation on Friday to ease consumers' pain at the pump, I should say. Georgia has also announced a gas tax holiday, and more than a dozen states could follow. Joining us right now is Governor Larry Hogan of Maryland. And Governor, thank you for being here this morning. Obviously, higher prices for gas are front and center for just about everyone. This was bipartisan legislation. Why did you all go ahead with this move?
Well, we saw the pain at the pump with the rapidly rising prices that everybody across the country was seeing, and we decided we wanted to take some, urgent, immediate action. And this all came together really quickly. Within a week of us calling on our legislature to act, they passed this unanimously across party lines in both houses. And so here in Maryland, instead of just arguing about who's to blame for it, we decided to take immediate action to do something about it.
It makes sense, and I suppose every little bit helps, but obviously there are people asking some questions about what this might mean. Some critics have pointed out that for the average Marylander who drives 12,000 miles a year in a car that gets about 25 miles to the gallon, they're only going to be saving about $15 over the course of this 30-day savings. And again, every little bit helps, but that does mean that the state's going to have about $100 million shortfall. And I guess that gets to the point of wondering, are you robbing Peter to pay Paul in some way if you are having to make up for those funds elsewhere?
Well, first of all, I think it makes a huge difference to the average consumer. And I can tell you that, the average price across country is something like $4.25. We're down around $3.75. So we're 50 cents a gallon cheaper than most. We have the lowest gas prices, or one of the lowest in the entire country. And I had people all weekend, all over the state, thanking me because they saw the difference. If they put 10 or 20 gallons into their tank and they got 50 cents a gallon, it was a pretty big deal to them. It really isn't going to impact us because we've turned our state around and gone from a $5.1 billion deficit to a $2.5 billion surplus. We have $3.6 billion in our rainy day fund. We have a AAA bond rating. We could afford to do this. It is about $100 million a month. It's not going to take any money away from any other important programs, and it's not going to take anything away from our infrastructure, which the gas tax is supposed to pay for. We're building, we're improving infrastructure all across the state on every priority project. So I think it's a big deal for consumers. I think a lot of other states are going to do exactly what we did. I can tell you it's overwhelmingly popular. Look, instead of just arguing about things in Washington, we actually did something.
No, I'm sure it is. I guess my point would be is if there are other states that follow suit and wind up using maybe COVID relief funds for something like that, would you have a problem with it?
I think, whatever we can do to try to help people. I don't know what other states are considering. I just know that we proposed this in a week. It got passed. I signed it into law that day and on Friday, and immediately gas prices came down dramatically, and people were very happy about it. It's obviously just a short-term fix, but I think it helps us.
It's a short-term fix, and you all are doing what you can help, obviously. But there are bigger problems here and some bigger concerns about what happens with gas prices overall. What would you like to see happen on a federal level? Because the federal gas tax has not been suspended yet.
Well, I think a big issue is just, we've got to provide for America's energy independence, and we've got to increase production here at home, and so we're not so reliant on foreign countries for our oil. And I was one of 24 governors who signed a letter to President Biden calling for just that, to rapidly change position and to help us increase production, and so we can solve this on a more long-term basis rather than us just taking emergency action at the states.
Governor, let's talk a little bit about cybersecurity. The President Biden warning yesterday that Russia is prepared for cyber attacks on the United States. I know it's something that he is calling on companies to make sure that they are shoring up resources, but I would assume as the governor of the state, you're looking at things too. I know that the Department of Health from Maryland was attacked by a denial of service attack back in December. And from everywhere I hear, it seems like these attacks are stepping up even before some massive launch comes from the Russians. How prepared are you? What are you doing on that front? And what do you see at this point?
Well, it's definitely a serious problem that we're watching very closely. You're right. Health departments across the country were attacked with these kinds of things. They're going after not just large companies and our critical infrastructure, but every federal and state agency across the country. And it's something to be very concerned about. But Maryland is the cyber capital of America. We're home to the NSA and U.S. Cyber Command and NIST. And so we're very focused on that. And Ann Neuberger, who made this announcement yesterday from the White House, is a Marylander and a friend and participated with us on a number of things. And I can tell you our whole team is focused on it. I think the threats are real. And we've been talking about this for a long time about Russia's capabilities. And I think now that Putin's sort of backed into a corner and getting desperate, and we're cutting off his financial supply, taking dramatic actions against him, I think he's going to try to retaliate, and we've got to be prepared for it.
How safe do you feel at this point, and how safe should the average citizen here feel?
I think we're doing everything that anyone can think of to keep us safe. I think businesses are doing it, local and state governments and the federal government, all of our security agencies are working on it. But I'm not convinced that they won't be able to get through. I mean, remember the Colonial Pipeline they shut down on the East Coast was a major problem. We've had attacks in different places. I think they've made some pretty serious threats, and we're aware of them, and we're going to try our best to provide the best defense we can.
Governor, one of the things we've been talking about this morning is the Fed's move to say that it will raise interest rates and do whatever needs to be done to tackle inflation. You made the point that your state's in very good fiscal shape right now, and that's one of the things we've talked about too. Consumers seem to be very flush. Businesses seem to be very flush, but obviously everybody's worried about what comes with inflation, what comes with things like higher gas prices. When you're kind of looking out across the horizon, what do you see in terms of the tax receipts your state's taking in, both from the consumer perspective, but then on the business front too? And where would you kind of advise, just from where you sit, where do things look?
Well, so our economy is booming, and we've got the fourth best economic recovery in America. We're growing businesses and jobs. We have huge demand and not enough supply. We've got supply chain issues. Inflation is an issue. Our revenues are up dramatically. So, it puts the state in better fiscal shape, but the costs to the consumers are going up, which is why we've been, like we did on the emergency gas tax legislation. This week, we're trying to finalize eliminating our retirement taxes to ease the burden on folks that are on a fixed income. And we've cut taxes 8 years in a row by nearly $4 billion. And because, I think we want to try to let consumers like families and small businesses keep more of their own money in their own pockets so we can grow the economy. But, I think inflation is a major concern. There's no question about that. And it affects, individuals and businesses and state governments as well.
Yeah, it's funny to have such a flush economy and have consumers feeling so on edge about what comes next, businesses too. It's a different time that we're entering. Governor Hogan, thank you for your time today.
Yeah, thank you very much.
All right, coming up, Jim Cramer's first take on the trading day ahead, plus why today is such a big day for Tesla. Then Wells Fargo bank analyst Mike Mayo brings us his take on financial stocks, now that it seems like Fed Chair Jay Powell is getting a little bit more hawkish. Don't go anywhere. Squawk Box will be right back.
down in the New York Stock Exchange. Jim Cramer joins us now. We tried to take the Nike results, Jim, and extrapolate to whether it's everywhere. So North America was great. So I said it, and I was kind of kidding. I go, people are running in their Nikes to catch a plane that has no empty seats, to go to a hotel where they can't get a room, to try to book a table at a restaurant that doesn't have any openings. Is that the economy we're looking at in North America right now?
Well, that's why what we ought to do to get ahead of all this is to say that Powell's willing to go to 100 basis points at the next meeting. That way, if he only does 50, we're like, wow, I guess things are better than we thought. The Nike call was extraordinary and on every single line. And what's incredible is the separation they have from everybody else. They continually talk about how there really isn't anyone in their universe, and they're very true. It was a picture-perfect call. The stock's up 6. I don't want to say it'll be up 10 because I don't trust the rest of the market, but Nike really shocked people. And I think the litany that you just described is the litany that a lot of people hate, which is that they want to see everything slow down, but we can't even slow down housing. So I think that Powell, I understand the 50 and 50, and I suggested it could be 50, 50, 50 just because I want to be ahead of the curve like all these hedge funds want me to be.
I guess here we are in the West, and Jim, every day we realize how good we've got it, and we see what's playing out. Sometimes I feel guilty that we're going full bore with, reopening and life is great and going on, and watching that happen, I just wonder whether that's okay. It's just what it is. It's a world away, but it's just really bad.
I was complaining about something in my life to someone, and the person said, look, you could be huddled in a basement in Kyiv, and here you are complaining about
Was it about Faber?
No, Faber's out somewhere where he's just in some place that's better than where we are.
Maybe you're complaining about that because he's out again.
Well, Faber has a better time than I do when he goes away. He's, obviously just
he leaves it all behind, I think. Life. He can do that. He can compartmentalize things. I think you're right. He does. I think he does have a.
But I feel guilty. I do.
I do. Life goes on.
I know.
How can life go on here? How can life go on here?
Why can't we name the generals? We named the oligarchs. Well, good. They stole a lot of money. How about the generals?
They should never get in a Western country.
Let's get the generals' names.
Right. Never get in another Western country ever. They can stay there forever. See how that works out.
I want the generals' names. We have them. Let's print them. Right. That way, at least they figure, well, maybe there could be something if I don't continue to be in league with
How about this? I saw this posited by a former defense official, that even if Putin does somehow say, okay, we're not going any further, the sanctions never come off unless he's gone. Because
I like that.
If they come off
Bing
after
West said that yesterday in the Journal.
Yeah, exactly. That's who I saw on one of your.
Yeah, and Bing is the best writer about military. He was in the Marines, and he really knows a great deal. He was in the Pentagon. And, I don't think Biden just said that's not going to happen. I just get the sense when Biden goes to Poland that unless he gives us the names of the generals and steps up, the seizing of oligarchs' mansion, and by the way, was that mansion hideous? I don't know how that place is going to go for 50. But let's go after the generals. Remember we had the trading cards of the generals in Iraq who were all a bunch of idiots anyway?
I do remember that.
We have real generals here.
That's right.
Give me the names.
Maybe like 4 fewer of those guys, or 5 fewer, thanks to some of the Ukrainians, which...
We knew all the generals who destroyed Chechnya. Yeah. They just destroyed it. They destroyed Grozny. They just said, listen, let the women and children out because we're going to level it. And then they leveled it. And we know who did it. They got away with it.
All right, Jim, thanks. We'll see you. We'll see you in just a couple of minutes. Sans Faber. And we want to remind you about the new CNBC Investment Club. You can sign up to find out more at cnbc.com/join the club. Or just point your phone at the code on the screen. It's magic, like Magic Mike, and it'll take you there. Squawk Box will be right back.
Tesla will officially begin delivering its Model Y crossover utility vehicles from its newest Gigafactory outside Berlin, and the timing couldn't be better. Phil LeBeau joins us right now once again. Phil, good to see you.
Hi, Becky. A big day for Tesla and for the folks in Germany as Tesla opens Giga Berlin. It's been open for a while in terms of pre-production, but today is officially the beginning of deliveries. And this will be important because this plant will be supplying Tesla Model Ys and other vehicles in the future to the European market. They've been supplying those vehicles so far out of their plant in Shanghai. That will free up capacity there. And as you take a look at what's happening with Tesla in terms of its capacity, think about how much is coming on. This is a big year, 2022. You've got Giga Berlin, which is opening right now, and then you've got Giga Texas opening next month. Here's their annual delivery. It's supposed to hit 1.42 million this year, up considerably from the 936,000 last year. But in terms of capacity, look, they're adding Giga Berlin today, Giga Texas next month, and then production is going to be focused primarily on the Model Y. I can't wait to see what the numbers are in terms of Model Y deliveries by the end of this year. It is rapidly moving up the list of the most popular vehicles in the world in terms of overall sales, and they'll be near the top for 2022. And again, this is a plant that is critical as Tesla continues to expand, because in the past they've been supplying vehicles built in China, shipping them over to Europe. That was not a sustainable model in terms of growing sales. Now they can ramp up sales in Europe with Giga Berlin opening. Mike?
Phil, thank you very much. As we've been telling you this morning, Fed Chair Jay Powell vowing to get tough on inflation. The central bank chief telling an economics conference yesterday that inflation is much too high and that the Fed would take necessary steps to address it. This is particularly important news for the big banks. Joining us now, Mike Mayo, senior analyst at Wells Fargo. Mike, the rate story seems to be working in banks' favor. The stock's kind of lagging a little bit. What's your read on that? Should we be concerned of what the market's saying about the fortunes for this economic cycle, or is that an opportunity?
It's a great opportunity to own bank stocks. Look, the single most important factor for banks right now is the recovery from the pandemic. And we expect the best Main Street banking growth since the 1980s. You have record cash, and that includes record deposits, sticky deposits, higher interest rates. Maybe we get 11 rate hikes through next year, and growing loans, business loans, commercial real estate, really amazing credit card spend. So you get cash plus rates plus loans, and you get the best growth since, almost any of us were in the business. Mike, I don't think you were in the business. Becky wasn't in the business. Maybe Joe was in the business, but not since we were all wearing neon and watching the movie Wall Street. So that's a great backdrop for bank stocks, and our number one pick, especially Bank of America, which should have more spread revenue growth at higher spreads.
Mike, even though it's been debunked that the Treasury yield curve is very important for banks' earnings, it seems like it's still a storyline. It seems like the stocks maybe trade a little bit worse when we're looking at a flat curve right now. Is there a way out of that?
Well, we do look at the 2-10 spreads, the spread between the 2-year Treasury, the 10-year Treasury, and it's gone from 70 basis points all the way down to a little bit less than 20 basis points as we speak. And that's one indicator for the potential for a recession. So the playbook is, if we go into recession, sell bank stocks. Well, number one, that just ignores the de-risking that has taken place at banks. And Bank of America used to have 25% subprime loans. Now that's down to like 4%. So first of all, they're much more resilient. Second, our house view is that we're not going into recession. And third, the 10-year Treasury yield is somewhat, manipulated due to the actions by the Fed. So the pure 10-year Treasury yield, could be as much as 100 basis points higher. So monitoring the 2-10 spreads for the risk of a recession is not as relevant as before. So we think the stocks have sold off on concerns about bad loans at banks. And right now, loan quality at banks remains really good. It might go from great to just good. But times are good for banks. And I'm really surprised with the 10-year yield going up as much as it has that the bank stocks have not caught up, but I think eventually you'll see the better earnings through the course of this year, more after the first quarter. So it's definitely an opportunity.
what you say about the safety of banks, they have more capital, they have fewer riskier loans. Does that not also just restrain the returns they can earn here? I mean, we're talking about just a ton of reserves and everything else on their balance sheets.
Well, what's underappreciated structurally, and I've talked about this on your show, is the tech revolution at banks means the industry is trending toward the best efficiency in history. And it's not just that top line growth, which you get through higher interest rates, it's the incremental profit margin on every dollar of new revenues is going to be better than expected. And that's one reason why we're so much above consensus, again, for example, Bank of America.
Mike, great to talk to you. Thanks very much.
Thanks for having me.
Wall Street was 87.
Yes, it was.
Officer and a Gentleman was 82. Mayo.
That's right.
Zach Mayo. When Lou Gossett is still alive, been doing well, 85 years old, still got that Oscar.
Sergeant in that movie.
Still got the Oscar. Still got the Oscar. Yeah. Yes, he does, and he's 6'4". He's still. Is that what that is? What that's from? Final check, Mayo. Final check on the markets. See, you can work with me on this. You know these things.
Movies, I'm pretty good.
Yeah, you were damn good. Up 167 points, 25 on the NASDAQ. You too, Becky. We'll get by. We'll be back tomorrow. Make sure you join us. Yeah, the wind beneath my wings. No, that's beaches. Yeah. Make sure you join us tomorrow. Squawk on the Street is next.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer. David Faber has the morning off. Equities hanging in there after Powell's speech on Monday and one of the worst days for bonds in a decade. That selling continues today. 2-year yield 2.20, and we got more Fed speak on the way. Our roadmap begins with Fed Chair Powell's fight against inflation, saying that a rate hike above 25 basis points is on the table. Nike jumping on a quarterly beat while navigating some of those supply chain issues, and Alibaba surging as the company boosts its share buyback program to a record $25 billion. We're going to start, though, with the markets and the message the Fed chair delivered yesterday about rate hikes.
If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
He packed a lot in there. Go above neutral, we may do it. 50, we may do it. Tried to explain what happened to transitory. Talked about what part of the curve he looks at when inversions occur.
He's not caught a break yet. I mean, just when you think that something's going to change, you'll get nickel up limit. I mean, nickel was down today for the first time, knocked down the down limit. You'll get aluminum out of control. You'll find steel out of control. You'll look at food and you go to the soup. So, I mean, he just doesn't catch any breaks. The Lennar call was seminal last week. We said supply chain's just completely broken. We've had a bunch of calls today saying it's 12 to 15 months now to get a boat from China. So he's not had any luck. So I think it was smart for him to say that, if only just because if he doesn't catch a break soon, he needs to do it.
Yeah, he did say one of the mistakes they made in sticking with transitory was underestimating the persistence of supply chain friction. And today, a bunch of trims on auto production out of Goldman and some of the annual selling rates here in this country.
Look, I think you're going to see a slowing just because there's some demand destruction. I find that when I listen to Powell, I think it's very logical because I just don't, when you hear major home builders talk about how they can't get garage doors and they're having a hard time getting cabinets. I mean, we're talking about very simple things that should just be available. We're seeing major home builders go to Lowe's and Home Depot to get things. I mean, yet the gross margins hold up because these companies are so smart. But it's just who can pass on prices faster.
Do you think the argument over Bullard's on the tape this morning again, saying 50, we overstayed our welcome on asset purchases. Does it matter to you, or is 50 just another 25 since they're already telegraphing a hike at every meeting?
Well, I mean, I'm looking at the 10-year. I think they have to do 50 unless something happens. I mean, it's very interesting to hear how many companies are saying such a huge percentage of our workforce didn't come to work in January. I mean, I'd love to see something better go better somewhere. But I can't find anything that's lower than now. I mean, I had Stiefel on last night. Really terrific interview. They were thinking about 3 rate hikes 3 months ago, and I think about 7 rate hikes now. I mean, these are numbers that are not conducive to having a continual rally. The advanced decline yesterday was not so good, but I do think that this is maybe one of those periods where you can buy Bristol Myers. I mean, take a look at J&J.
Yeah. How about Truist on Procter today saying
that was a great note.
Yep.
You know, talking about Procter being able to these companies have pricing power and they don't have any. This is when we had recession. When you began to have in 2000, there was this moment in April where you started having Coca-Cola go up and Merck go up, and we're there. We're there. I mean, I'd rather own Coca-Cola than I would any software as a service company.
What's the term? Shrinkflation, where packages get smaller, but the price stays
well, I mean,
the
look,
same.
I mean, everyone goes to cereal. Look, there's a couple of notes today about Deere. You know, Deere's got this great tractor that comes out this week where you don't need a driver. And a lot of things are keying on the idea that each aisle of the supermarket is frightening. When I go to the supermarket, I'm kind of like, I mean, I should be more conscious. I don't get conscious until I'm at the register. At the register, I'm like, geez, there's got to be some mistake.
What happened?
There has to be.
So why are equities? You think it's because they equities like the Fed being on top of the case?
I think that the equity market showed its true colors last week, which is that when you're dealing with executives, like let's say you're talking to a great executive like Dave Cote, who used to run Honeywell. I mean, he would tell you, listen, we have to end the cycle. We cannot be in a cycle where you can say to your customer, okay, look, 30%. You have to pay 30% more. And then that guy then passed on 30%. We have to break that mentality. And that's what Powell got wrong, was that the mentality is now ingrained. I mean, I saw there's a note today about Sherwin-Williams and how it's time to buy Sherwin-Williams. I'm like thinking, are you kidding me? I mean, Sherwin-Williams has pricing power? Nobody has pricing power. You can't raise your prices as fast as they raise their prices, except for when you have a Procter, which can say, hey, guys, you know what? Go tell somebody else about that. Don't look at us. You want us? That's one of the reasons why I like the stock of Walmart for my charitable trust. Walmart has the ability. Costco, definitely. I mean, Costco can say, hey, guys, no, we got somebody better. But Kroger did it. Kroger had a lot of pricing power.
Right.
But the companies that have pricing power, maybe I can name 10 companies with pricing power. 10?
Yeah. I mean, there has been a pattern, and we're going to talk about Nike in a moment, of companies that complained about high costs and then gross margins went up.
Well, every home builder, they also, oh, woe was me, woe was me, woe was me, and then their gross margins were fabulous. And they always say, well, listen, we found ways to be able to do it. I think the ways they're able to do it is they raise price dramatically, and people still buy homes. There's 1 month, as you said yesterday, there's no inventory in homes. So a $400,000 home is a $500,000 home. Now, I think if you really want, you want the truth.
The Oscars?
Ladies and gentlemen, Adam Jonas.
Oh, yes.
My friend from the dog park emailed me a photo of a window sticker for Bronco on the lot of a local Ford dealer. The MSRP, manufacturer's standard resale price, was $63,000 on top of what was added $35,000 in market value pricing. And then he talks about how he was playing a pickleball game, wicked returns, by the way, where again seeing the Lexus stickered higher,
where the cap rate for the car was what, 100 and some odd,
Yeah.
120K?
Now, this was the best Jonas note ever, because it really does state the truth, which is the prices for cars are not what you think. I mean, it's kind of like the crab clause at the breakers. Nothing is what, I mean, so a lot of times the sticker price has nothing to do with what you're actually paying.
Right.
And that's what Powell has to understand. He has to go and try to buy a car.
Well, Jonas's point would be they're playing with fire, that they are inviting demand destruction by being so aggressive, more aggressive than the manufacturer.
But we all need cars, and the used cars are a fortune. Look, I bought this Maverick, which my wife has since taken. It's a $48,000 completely stripped down little truck. I mean, it's like a teeny weeny little truck, and you know, it took a solid 11 months. But when I got it, they hadn't raised the price, thank heavens. I am sure that same, they don't even make the truck because there's not enough product.
But I got to imagine it makes you want to buy some dealers, at least. Jonas even says revenue's going to be good again.
I like Lithia. I think Lithia is an undervalued situation. You don't have the problem of that people talk about with Carvana and the bonds. But I don't want to get too granular other than to say that, again, I don't have a lot of companies that can do it other than Nike, by the way, has. There was a moment in the Nike call tour de force, as always. Dono just amazing. But he's talking about a shoe. This was called a modular interlocking modules that connect the pieces of a shoe without glue. That allows for an 8-minute assembly, which is a fraction of the time it takes to make a traditional shoe. Well, there you go. I felt so great after the Nike call. I really did. You know, I watched Nike call, I read the Nike call, watched Theranos. I mean, what a night!
Yeah, I'm laughing because in Shoe Dog, Knight goes through. There's a whole bit about how hard it is to glue.
Was that one of the best parts? I talk about in the piece that I'm doing tonight about the great Prefontaine. I had to stop sign. I mean, the saddest part of the book is what happened to Steve Prefontaine when he realized about, he had a terrible death, but he was also at the Munich Olympics. But the Shoe Dog book is, Don Ho's taken that and gone one extra level.
Right. We do have a bunch of price target increases today. Cowen goes to 154. Credit Suisse goes to 165. Foot Locker's going to benefit a little bit today, not quite as much.
Although I think the Foot Locker was a bit more of window dressing, because what they really like is direct to consumer. And like Tim Cook, which of course on the board, they care what the customer wants and where the customer wants to buy. And they think the customer wants to buy on the app, the mobile app. So if the customer wants to buy at a Foot Locker, fine. But they have more different shoes in there, which reminds me of all these people who trade shoes. And they trade shoes like they trade crypto. It's like, except for neither one of them is actually used in a currency.
How far are you willing to read this as a tell? Is it a tell on the overall consumer? What does it mean for China?
Okay, China wasn't that great, but China wasn't as bad as people thought. Xiaomi reported last night, and they had a fantastic number. Now, there's a note today that says that Apple may be having a weaker period. I discount that entirely when I saw the Xiaomi note. You have to go through these notes. There's like so many today. Yeah. And the trick to understanding China, I believe, is the buyback, the increased buyback Alibaba. And I just think that it was just an extraordinary thing to add another $10 billion. Xiaomi, great numbers. Alibaba buyback. Barclays says China February handsets below seasonal. I'm not buying that. I'm not buying the Barclays number.
$25 billion is going to be the biggest buyback in Baba's history for sure.
Well, the communists have obviously said, look, we want things to be good. Now, Pinduoduo, which is my favorite stock from the point of view of just absurd names, is finally starting to make a turn too. Yeah. Starting to turn.
Well, you think the crackdown is easing here?
I think that they feel like, look, we got to get something going here, and let's just let the capitalists have their way for a few weeks and suck some people in.
Oh, look at that.
Well, let's suck the managers in to come on our air and say, hey, listen, the time is right, and then they're vindicated. For about 4 weeks, and then the communists have said, all right, enough, you made enough money.
That's kind of how it works over
yes,
there,
it is.
right?
No, the communists suck you in.
Yes.
Right? They just put you in, and then
Not
they
too
say,
much. Not
too much, because then again, they've got their Maoist roots.
Right.
Maoist really bad for the market.
Not a huge trader, as I understand.
No, Zhou Enlai not either. Yeah. Deng Xiaoping a little more. Deng Xiaoping liked he was the penny stock guy.
He would have used Robinhood, right? Yeah.
Oh my God, yes, and he would be 5 Sigma. It was a 5 Sigma event for Zhou Enlai.
We got a lot more to get to this morning. A lot of moves in currencies. The yen, of course, we'll watch the 10-year. Oil seeing a little bit of relief as we try to determine whether or not the EU can decide overall whether to ban Russian oil. Take a look at futures. A lot more Squawk on the Street continues after a short break.
16. Not Nike's quarter, but every single line on them, particularly the direct-to-consumer, but also, I know when you listen to really good football announcers like Al Michaels talk about separation. Well, they just talk about separation. Now, here's a good one. Who else makes sneakers?
It's a small universe.
And then, like, you look at the players that they've lined up, who they have. I mean, this was a remarkable quarter, and I just think that Donahoe was kind of undercurrent of it was, what were you guys thinking? Do you think that we can't handle this environment? We can handle any environment because we are the best and we're purpose-driven. And we don't just mean purpose-driven, throwing the words out. We mean that we are sports seeker, and that's why you got to go back to Shoe Dog. This was a Shoe Dog quarter, and that's by Buck Knight. We all know it's like the best business book. It also reads like a novel, but I've got to tell you, it was vintage Knight.
Yeah.
Like, there's nobody else who does it like we do.
There is a lot of talk about cybersecurity, especially coming off of the president's comments
Trying
yesterday.
to get a line on it, yeah.
And now we got Okta investigating claims of a hacker data breach. I mean, are you sort of bracing for some negative news event?
Yes, I am.
You are.
Now, Okta was very unfortunate. That's Todd McKinnon, and he's done a great job. And it looks like there's got some screenshots. It looks like the sound of the whole instance was something like, hey, you think we're secure, but we're maybe not. I saw Nikesh Arora last week, who's unbelievably good from Palo Alto. He says be prepared. George Kurtz from CrowdStrike says be prepared. I don't know what it's going to come in the form of, but we have some good people in cybersecurity. So I'm not so sure that we're just going to be rolling over. We have companies that are, we have major banks that have 2 and 3 and 4 suspenders and belts. So while I always want to fear it because I just think that the Russians have no scruples whatsoever, the North Koreans haven't and the Chinese haven't, and we've done a pretty good job.
Right. Interesting piece in the Journal this morning about New York City and how it's a city where everyone wants to live and no one wants to work.
I know.
So you end up with a lot of businesses which are doing fine and others that are reliant on sort of quick workers coming in, quick lunch. They're not getting the traffic. No. But I do see Simon Property up too this morning.
Well, look, and people are shopping. I mean, Simon Property, every time this thing goes down, 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 and then we hear about how well they're doing, and boom, it goes right back. Simon Property yield 5. That dividend is no dividend. Look, I don't want to say absolutely safe, but I think the dividend, David Simon is going to give you that dividend. I find that there are companies that are so good at what they do. Federal Realty. I just think the Federal Realty, Don Wood is fantastic at what he does. And that only yields 3.6 because he's doing so well. But shopping has become, once again, we like to do, not everywhere. Not everywhere, because there are places in the mall, pockets of the mall, that people aren't going. Gap Store's not doing that well. But I love Costco here. I think Costco is the retailer for this moment.
Well, because there's always the possibility of a membership hike,
special dividend.
Yeah, that's all. That's their trump card. They don't play it very often.
No, but Costco, they have two stores in China. They could have 20. I mean, they're having good numbers in Canada, in Mexico. There isn't a place where there's a Costco where people don't want to, line up for a Costco. So I think that that's still good. By the way, let me give you the other ones that I think are really great. I think that anything after listening to the auto calls, if you want Global Foundries, Lam Research, these are the companies that are determined to be able to make it so that the chips that are needed are going to be supplied. So Lam Research, I think, is the #1 of the semi-equipment, and Global Foundries is a very, very good company. Oh, by the way, NVIDIA, don't forget, at 1 o'clock today, Jensen Huang.
1 o'clock. Yep.
And the world stops, and tonight, no matter what you do, you've got to go listen to his call or watch his call. He'll be in his patented black motorcycle jacket, I hope. And he is, remember, you're going to have to try to expand your mind. You just may not understand it the first time.
Could you repeat that?
We're just not in. It's like interesting because it's like when I went into a class on logic at Harvard, logic, you know. It turned out it was mathematical. I got out of there like bat out of hell.
But office hours didn't help.
Oh my God. But you know, that's when you listen to Jensen. He'll be talking about the digital twin, and you'll just want the cliff notes so bad, or the remember the Rose, that fabulous Rose canon, the canon to Shakespeare. That's who he is. And by the way, Shakespeare, he is a Shakespearean character, but a good one.
Jensen?
Yeah.
Really?
King Henry IV.
From one of the comedies, I hope.
Yes.
Yeah.
He ain't no Falstaff. That Falstaff's the other guys.
Jim, we mentioned Disney in the first half hour. It's hanging in there up about 1%. I guess the question is really whether or not this ends up being material to growth, to subs, right? It's just such an internal controversy that they're dealing with right now.
Well, it's a week of April 4th that people are supposed to come in, not before that. Mostly senior executives now, some groups, Treasury, there are people coming in. And you know, I think it's wonderfully normal to be back to work, is what I'm understanding from terrific people who work there. I don't want to overdo it since everyone else seems to be overdoing it. And I know there's a lot of talk about Iger versus Chapin. Well, how about Schultz versus Johnson? And Starbucks up 5 since Howard's come back.
Well, people forget about the Iger-Eisner. I mean, rift there was. Successions haven't always come easy.
The only one I've heard was Bonga Mibach at MasterCard. That's the only one I could find where it's smooth and they like each other and it's high five. Right. Two people who are grown-ups and geniuses, by the way. This Mibach, I mean, Eji Bonga has picked a fantastic successor, and it is just. But when you think about the bank successors, I don't know how many of them talk to each other.
Yeah. Wow. I mean, MasterCard's up $50 in just a couple of weeks.
Well, look, I mean, Michael had a fantastic analyst meeting where he really talked about everything from cybersecurity to
Russia.
Russia,
hugely material.
Well, the Russians have, famously, Russians have 2 and 3 credit cards, and well, sorry, now they're in some sort of Chinese system. We could talk about nothing but Russia, and I think it's fascinating people, but I think a lot of people just feel like, how is it possible that there could be, that we're like thinking about a beach house and they're huddled in the subway? It just doesn't seem possible.
Well, we talked yesterday about the way in which the market has adapted to those events. The VIX back to its 100-day. I mean, volatility has really receded. We could go to 4,500 this morning.
Well, look, it's not our job to talk about angst. That doesn't mean like, wow, I love Coinbase here. How about what's going on in Kyiv? I mean, but I think we all wake up and we read those headlines, and then we say, okay, now we have to compartmentalize. And I didn't think that we would be compartmentalizing this quickly, particularly because it's trench warfare. We don't really have the right. AeroVironment's got better drones than we're using. We're using handheld. You have the drones from the backpack. I mean, if you go in and look at if you just go to the AeroVironment webpage, you could realize that you could do a better job yourself than what National Security Council is doing. Right. You just send them. I mean, the webpage, by the way, you can get. Well, let's just put it this way: the Russians would be shocked if we got the real weapons.
Wow. The 2 big headlines on Russia, by the way. One is ArcelorMittal removing Russia supplies from their own steel supply chain. They're a huge player. But the other is the Kremlin saying that they think negotiations should get more active. I mean,
I don't know. I don't trust them.
Yeah.
What is India doing? India seems suddenly a democracy, seems to be in the wrong orb. India not being called out at all. I don't get that. But we're not United Nations people, but what is that about?
Yeah, it's been confusing to some.
In the meantime, Carl, it is amazing. I mean, here we are, Apple's up, and we've got some good movement in all the cybersecurity. Only Upstart seems to be hit, and that Upstart was because there was Upstart they have a terrific way to be able to do AI loans, and well, I mean, people are saying that there's a lot of some loans going bad for AI. And I found that quizzical because I always thought that AI would be better. Now, Upstart, just is supposed to be putting an end to FICA. That's what they want, and democratizing loans. And I don't know. I mean, if they have vintages like Wedbush says, who took it to a sell, which has a 2.91% You can't have a delinquency that high without real problems going down the road. I wait to hear what Upstart says because I felt they're a pretty good firm, but those are bad numbers. That's bad numbers, and you're not going to get rid of FICO using those numbers.
Right. Yeah, Affirm down 2%. As well, 2.5.
Yeah, isn't that interesting? I had Max Levchin on last week, and I thought he made a good case. But you know what? If you have delinquencies for that buy now, pay later, like you're going to not. Brian Wynn's going to tell you you don't know how to loan.
Right. So we are within about 10 points of 4,500. Let's get to Bob Pisani this morning. Hey, Bob.
Move up here, 0.7% for the Dow and the S&P. Dow's being helped by, of course, Nike and the banks doing well. Take a look at the sectors. Important thing here is the banks up, J.P. Morgan, Amex, Goldman, all helping out the Dow Jones Industrial Average. Nike doing well, as I mentioned, too. Consumer discretionary being helped. That's Nike right there. Tech's holding in there, modest rally. Energy's flat, but don't kid yourself. Oil went from 94 to 110 in just a few days, so that's still very much on the table. S&P 500, I notice here, just above the 200-day moving average. 44.72 was the old 200-day moving average. We haven't been there in the last 6-7 weeks or so. So that's nice to see. That's positive momentum overall. Let's take a look at the two big market issues, and we know what they are. Number one, we have the Fed, a 50 basis point rate hike potentially back on the table. And the other problem is those higher oil prices here. There's no easy replacement for Russian oil, and there's a lot of notes out over the weekend and overnight about this. Saudi Arabia and the United Arab Emirates not dramatically increasing production, not a lot of movement on the negotiations with Iran. And U.S. domestic producers, they've been burned before by this. Discipline, capital discipline is a big thing about not increasing production too much and then getting burned down the road when prices come back. So you're kind of stuck. You're looking for 8 million barrels a day to replace the Russian oil. Bank of America had my favorite quote this morning. This is what they said. Fully displacing Russian oil exports in excess of 8 million barrels a day with spare OPEC capacity and incremental U.S. shale supply is mathematically not possible over the next 2 years in the absence of a major oil demand contraction. That sums it all up there and the problems we've got. So don't kid yourself about oil being down today. 110 is a pretty high level overall. Let's move on. Alibaba up 11%. Have you seen these moves in Alibaba here? It was $74 6 or 7 days ago. I think we're 112 or 113 on Alibaba right now. The important thing is the buybacks. Again, I keep emphasizing this. It's not about buybacks. It's about share count reduction. Share count reduction reduces, improves the earnings per share. And that's what you want. Alibaba has not reduced share count in a long, long time. They have 2.4 billion shares outstanding. Put that back up there in 2017. Now they have 2.7 billion. Their share count is up about 12% in the last 5 years. That's important. Now, let's hope these share counts, this buyback, reduces the share count. But oftentimes, I've told you about this, it's a giant hamster wheel for corporations in general. You improve the share counts, you do the buyback, and then at the other end, you simply give executives more options and they exercise the options and you don't get any share count reduction. Let's hope this leads to actual share count reduction. Finally, if David was here, I'm sure he'd mention a very interesting SPAC that we've got today because this is a business that a lot of people are very interested in. Forge Global Holdings, right behind me here, just went public. This is a SPAC deal. It's Motive Capital. They completed a business combination with Forge Global Holdings. This is a private securities marketplace. And what happens here is it enables company shareholders to trade shares with accredited investors. We've talked about this. Companies have stayed private for much, much longer than most people ever anticipated that they would. Some companies have been private for 10 years now. So there's a need for employees and for companies, early stage venture capital people who invested in these companies to find some way to monetize their investment. These enable, Carl, a marketplace to do that. The CEO, Kelly Rodriguez, is here right behind me. In fact, they're ringing their internal little private bell. I'll go over and say hello to him now. But they're a very interesting company going public today. Carl, back to you.
All right, Bob, thanks for that, Bob Pisani. Quick reminder as we go to break, you can always get in on the CNBC Investing Club with Jim. Sign up, find out more at cnbc.com/join the club. Or use the QR code on your screen. You won't believe the content that you will. Yeah, it's been good, really good. Before we go to break, take a look at the bond report as we keep our eye on treasuries. We do have some inversions today on 3s, 10s. Although, as Powell said yesterday, he really looks at Fed funds to 18 months as the clue to what part of the curve is important. VIX is down for a 6th straight day. We're back in a minute. S&P is above the 200-day again. We'll see if we can hold it this time. Dow, meantime, up 272, and the heat map looks pretty good. Just a few components in the red, including Home Depot, J&J, and Salesforce. Stop Trading with Jim is coming up next. Let's get to Jim and Stop Trading.
With the NASDAQ 3-1 to the bulls, I'd like to look at which one is the most important tell, and that's Alphabet. Morgan Stanley put out a piece today to talk about travel's good, vertical's going to be great, just trying to figure out how much better it's going to be. I think that's the one that could go to its all-time high of the FANG stocks. Once again, Phil LeBeau back and forth with me, Tesla, the Gigafactory, really, really important. And I've got Bausch Health tonight. Bausch Health is breaking up, and no one seems to care. I care. It's in my travel trust. I want to find out how the pieces are doing. They do need a better market, but from the looks of what we got here, there is a better market. And from the looks of the bank stocks, maybe there's good things ahead. The market likes something that we haven't come up with. It likes something, whether it be the Fed's persistence or whether it be the idea that perhaps that Jay's going to navigate us. Well, I did a piece yesterday in praise of Jay. It was so sycophantic, it made me sick myself when I wrote it.
Hey, Woodward wrote a whole book called Maestro.
Yes! Yes, you're right. So there's ways to go. I think that, by the way, the fact that NVIDIA is down ahead of Jensen's speech, people are doubting the man. They've doubted him many times.
You generally like that?
I do. I wanted to see it down. Remember, it has to do with vision, and you may not get it initially. In the same way that when I went to the Da Vinci Museum, and there he had a helicopter. He had figured out a helicopter. He did. He's like, oh, here's a helicopter. And he'd been like, go to cadavers, and he was doing amazing things.
The guy was the best.
Yeah, and that's Jensen. I mean, Jensen built the headquarters, and it's like, there's grass on all the walls. So I said, how do you do that? He goes, well, if you figure the sunlight correctly, you can always grow grass in the walls. No one's growing grass in the walls except for Jensen.
We'll see what happens at 1, Jim. We'll see you tonight at Mad Money, 6 p.m. Eastern Time, as the Dow's up 300, and we're knocking on the door at least of 4,500. Good Tuesday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan. David Faber has the morning off. Bulls trying to hang on to the ball here, even as we get a continued sell-off in treasuries. 10-year gets to about 235, but the Dow is up almost 300 points, and we are trying to see if we can get above 4,500 on the S&P, Morgan.
Yeah, key level we are watching right now. We're 30 minutes into the trading session. Here are three big movers that we're watching as well. We're going to start with Nike, running higher. Get it? After beating on both the top and bottom lines, boosted by an increase in digital sales. We're going to have a lot more on the blue chips quarter in just a moment, but you can see shares are up 5% right now. Plus, Alibaba increasing its share repurchase program to $25 billion from $15 billion. It's now the largest ever buyback plan for the China-based tech giant. Shares are up 10.5% right now. They're up almost 50% just over the last week of trading, but keep in mind, still down 50% over the past 12 months. And we are watching Disney, the company preparing for a planned employee walkout today over its handling of recent LGBTQ plus issues, including its stance on Florida's Don't Say Gay legislation. The walkout is expected to begin at 11 a.m. Eastern. Carl?
All right, Morgan, turning back to the broader markets. As you know, the Fed chief saying inflation is much too high yesterday and that the Fed will take, quote, necessary steps to address the issue. Our Steve Leisman has the latest, Steve, as we get more Fed speak today.
I don't have the right prompter in front of me. Hey, Carl,
Steve,
yeah, Fed Chair Jay Powell putting markets on notice the likelihood of faster rate hikes from the central bank that go as far as needed to fight inflation, even to the point where they rise above the neutral rate to purposefully slow the economy. That could mean a 50 basis point rate hike as soon as the May meeting and a funds rate that ultimately rises above 2.5%.
If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
Fed chair spoke, market heard him. The Fed chair, they heard him more definitively than they did at his press conference last week. Before the meeting, you can see there the probability of a 50 base point rate hike was just about 9%. After the meeting, it rose to 50%, settled back to 36%, and then traded to 68% now. So 50, now the likely call for the Fed at the next meeting coming May. And could be more. Goldman Sachs out with a note this morning forecasting the Fed could hike by 50 at the next two meetings, going to 3 to 3.25% by the end of 2023. That's more than the market has priced in. So take a look here. Here's the market pricing: 150 by August, 217 by year end, which, by the way, shows now 8 hikes priced in or now assumed. The funds rate then gets to 2.8% by the end of 2023. So there is some debate here about how far and how fast the Fed goes. But Carl, Morgan, there's little debate that it goes pretty far and pretty fast.
Yeah. I mean, to that point, Steve, it's been less than a week since we heard from the chairman after the meeting last Wednesday. And yet this does seem to be that much more hawkish in just the last couple of days. What's changed? Or is this really just sort of a slow walk towards a more hawkish stance in general?
Well, first of all, nothing has changed physically. There's been no data. And you're right to ask that question. I will tell you that the Fed commentators who I read are puzzling about why Powell might have felt the need to come back and make this point more definitively. And it might have been a couple reasons. First of all, you remember we had Chris Waller on Friday, and he talked about the idea of a 50. Market seemed okay with that. It may be one of those things where he sent out somebody with a trial balloon, and now he's decided to actually take it and bring forward that tightening. Obviously, there's a lot of political pressure on the Fed chair to address inflation. That's another explanation. Finally, maybe he thought he wasn't really heard as definitively as he wanted to be, and put out some notions, and then he wanted to crystallize it in a speech. Speeches in general tend to be more definitive and policy markers than the press conference itself. So I think maybe he took a bunch of things that he put from the press conference and crystallized them into a really definitive, or as definitive as you could be with this uncertainty out there, Carl. Policy statement.
Yeah. No, it was definitely, he packed a lot in there, as we had said with Jim a few moments ago. Definitely a robust speech presentation at NABE. Steve, thanks. We'll talk to you in a bit. Steve Leisman. Sure. We're joined this morning by Trivariate Research founder and CEO Adam Parker. Adam, it's great to have you back. Good morning to you.
Good morning, Carl.
I know there was a time last fall where you were definitely on the under in terms of the way in which the Fed would progress from here. Has the data changed that view materially for you?
I mean, it's a good question. Look, I'm not an interest rate expert, as you know, but I just have learned in the last 10 years that whenever everybody thinks something on the interest rate side, you're better off leaning in the other direction. So I think everyone got a little bit too hawkish. But if we're marking to market what's happened in the last few months, Carl, I think you have to be honest and say, okay, we had a big change about perception of rates. We had a growth scare. We have a war. And so what I think, more expert on is corporate earnings and what's in the price. And I think 2023 earnings will be above 2022, but I think there's a risk relative to what I thought 3 months ago. I think if you're being intellectually honest, the probability 23 earnings above 22 are lower than they were 3 months ago.
I know you got some really well-defined themes here in terms of what you want to go long on. Mid-cap biotech, healthcare, you still like energy, you like old technology, you like Dell. Can you talk about what strings these together?
Honestly, I think the biotech stuff is interesting because, we know that growth stuff gets hurt when rates rise. But I think it's a little bit intellectually lazy to just say, oh, rates are rising, so all growth is worth less. I mean, only 15% of biotech companies actually ever generate positive cumulative free cash flow. So your discounted cash flow model, they actually lose less. And, a lot of them get taken out. So the sales pipeline looks the same. The stuff's at a 10-year low on price to sales. If you're going to start dipping into something that's a little bit more speculative growth, that makes more sense to me, biotech, than maybe profitless software that still trades at 20 times forward sales. So I think there's stuff to buy in that kind of, let's call it speculative growth part. Biotech looks good. I think the other businesses, and the key theme I'm talking about with investors every day, is gross margins, net margins 6 months from now, where are they achievable and where aren't they? And so what threads those themes together is where I think they either have pricing power, like healthcare services, or, I use United Health in our business, and they certainly have pricing power over me. Or, where they can pass on those costs, right? So that's, I think, the key, where they can pass on higher commodities and transportation and wage costs to their customers. Those are the businesses that are going to work, and that's what most clients are focused on right now.
Yeah, healthcare. It's been an area of actual secular inflation for quite a number of years now. Adam, I realize we're seeing this divergence right now between equities and the bond market. Two different narratives, arguably, that are playing out over the not near, but medium to long term. The rising risk of recession, at least as it's being flashed within the bond market right now, the playbook that you're laying out, does it stand up against that possibility?
Look, there are periods, Morgan, where corporate earnings can still grow, but you have a technical GDP recession. I think that's possible. I think what we're trying here is for the Fed to thread the needle where they can slowly raise rates but not cause a recession. If there's a mild recession but earnings grow, that's possible. Why? Because what usually causes the top is corporate arrogance gone awry, hubris, right? Too much capital spending, too much hiring, too many hiring of, fancy new MBAs, inventory in advance of recovery, all that stuff. I don't see a lot of corporate excess right now. So if the economy slows, sure, it'll compress earnings some, but I don't think we're going to have a big earnings decline. And I think that's probably not how I would position the portfolio. I don't think the base case is earnings decline very much.
So you've given us your long themes. How about your short themes? What are you steering clear of?
Certainly, profitless software, the kind of stuff that doesn't work after, growth stock sell-off. I'm cautious there. I think a lot of staples look expensive to me. They're over-earning. I think the estimates could be optimistic. And as you know, the conflict, the war here really exacerbates some of the, wheat, soy,
That's Adam Parker. We wish we could have finished that thought, but always good insights from Adam. We'll talk to him next time. Adam, thanks. Morgan?
Well, we're turning now to the crash of that Boeing jetliner in China. Our Phil LeBeau has the latest developments for us. Phil.
Morgan, investigators in China just wrapped up a press conference where they gave a few details about the crash scene, but really no details about what might have happened, what might have caused this China Eastern 737-800 to crash. First and foremost, they do not expect to find any survivors from this crash. Also, the investigators during this press conference, which lasted about a half hour, they said that the jet met all standards before takeoff, and also that there is no clear assessment of a cause for this crash. China Eastern's pilots, according to the investigators, were in good health, but there's no other details. Did they radio the tower before the crash? What was the number of hours they had flown? What were the weather conditions? Those remain questions that were asked but not answered by the investigators at that press conference. For China Eastern, the result of this crash, as they try to assess what happened, is that they are going to be grounding 102 737-800 planes. Look, that's 26% of their fleet. President Xi in China has called for safety checks of all commercial airplanes. As you take a look at shares of Boeing, we talked about this yesterday, the 737-800, also known as the NG model, it's a workhorse with a strong safety record. They've been building it, or they were building it, basically from the early 90s all the way up through 2020. And there's still some military models that are built. Then it was replaced by the MAX. Boeing has huge business when it comes to the 737-800 in China. It is the largest market for that aircraft. And there's also the other question that this raises. Does China slow down any potential bringing back of the 737 MAX in terms of deliveries of new MAXs that have been built, that are waiting to be shipped over to China? They're in eastern Washington. They have already, the regulators in China have already approved the MAX to fly again. They did that in December, but we haven't seen one enter commercial service. So that's the other question that is looming over this. Does this crash make China perhaps slow down the rollout again, or allowing airlines to once again roll out the 737 MAX? Just a number of the questions that will be coming up over the next week or two. But again, in terms of this press conference in China, really no new details. They still haven't found the black boxes, guys. We'll see if they have another press conference later on today. I don't expect that to happen. It might be tomorrow or the next day before we hear from them.
All right. We know you'll keep us honest on it, Phil. Thank you, Phil LeBeau. When we come back, a lot more on Baba's buyback today, pushing the stock to double-digit gains in some early trading. Get a quick check on where we stand this hour. The intraday high for the S&P so far this morning is 4499.99 as we try to get above 5K. Don't go away.
Welcome back to Squawk on the Street. Shares of Nike moving higher this morning. The retailer's quarterly results beating analyst estimates thanks to strong demand in North America. Nike delayed its outlook for the coming year, citing uncertainties around inflation, the war in Ukraine, supply chain restraints. The company expects to provide guidance with its next quarterly results. But joining us now in the meantime to discuss is Bernstein analyst Anisha Sherman. Anisha, thanks for being with us today. You have a buy rating on Nike. It sure seems to me if there was one takeaway, one headline takeaway from these results, it's pricing power. How do you see it?
Yeah, absolutely pricing power. But I would add the second one is brand strength. You know, Nike's brand strength has increased as a result of, you know, all the disruption we've experienced over the last 2 years. It has more customers, faster customer growth, more DTC sales, stronger app traction. So it really is commercially much stronger in terms of the brand, and that drives pricing power. So it's a virtuous circle.
Yeah, I mean, in terms of those cost pressures, are we at a place where we can say that those have peaked, or that we're seeing the peak in those for a company such as Nike? I mean, elevated transportation costs, all the issues around COVID closures, for example, in Vietnam and parts of Asia, which now seem to be coming back online. Is the worst over?
I believe so, but you know, as you know, with COVID, it's hard to tell. I think, you know, the problem for Nike is the concentration of the supply base. 50% of the shoe volume comes from Vietnam, 30% of the apparel volume. So they're quite exposed to that country in particular. But in terms of COVID, it does seem like the worst is over. In terms of freight costs, they've talked about having elevated transit times this quarter, and as a result, are putting more money into air freight and more express freight, which again is more costly. So overall, I think you're right. I think it moderates over the course of the year, but there'll be blips here and there as we experience this quarter.
Let's talk about the growth in direct-to-consumer, because obviously that's been something that's playing out for a number of quarters. We've seen it impact shares of Foot Locker in the past, although those positive comments on the call regarding Foot Locker last night. How much more profitable is D2C versus the more traditional model that Nike had always implemented?
Yeah, there's a lot of discussion on this fact, and we've broken down the P&Ls to try to analyze this and understand the different cost buckets. On a gross margin level, it's considerably more profitable, 20 plus percentage points, because when you're in wholesale, your revenue is only about 60% of the GMV of the product, because you give the reseller or the retailer a pretty big chunk of that total GMV. When you're DTC, you get the full revenue. So there's a nice revenue gross up, which results in much higher gross margins. But you have much higher OPEX. So you're running your channel costs and your shipping and your marketing and so on. So net, it's quite close. It is slightly margin accretive for Nike, but that is because of Nike's scale and the economies of scale it gets on the channel costs. For many other brands, it's margin dilutive.
Yeah, that explains a lot about the chart we're looking at right there, a 1 year of Nike and Foot Locker. Anisha, I wonder how you're thinking about Vietnam. We've done some coverage from there, and it's a huge, obviously, supply chain focus for the company. I mean, how are you generally viewing supply chain risk, I guess COVID risk, when you're looking at Asia?
Yeah, supply chain risk is tricky for footwear manufacturers because they structurally have to be concentrated in their supply chains because there's so much expertise and CapEx involved in creating high performance footwear that it's hard to have the kind of diversified supply chains that apparel does. So that is structurally part of the business model. What the big footwear giants, including Nike, are trying to do is try to find agility and nimbleness elsewhere. So tagging their products with RFID so they have more line of sight into the entire chain from start to finish, doing more fast production runs, paying more for air freight to ship things faster, and trying to make up for it elsewhere and get more agile, as well as using their data and their DTC to do better demand planning. So they have, better predictability and good models to understand what's going to be hot and what's selling.
Finally, talking about a brand within a brand, the Jordan brand, this idea of Jordan-only retail concept in North America, and I realize this has been tested out in other parts of the world by Nike, but just how much more can the company monetize that brand?
Yeah, I mean, they're trying to go after the younger consumer. It's working. It's a very powerful brand, and lifestyle sportswear and streetwear are ongoing trends right now. So I think they can get further monetization out of it. There was a lot of commentary on the call about how healthy the consumer is, and quite an optimistic outlook, especially in the face of everything we're hearing about inflation. So what they're seeing is better brand heat, continued engagement, willingness to pay even with low single-digit price increases of the last couple quarters. So I think they're seeing continued brand health and continued growth.
Anisha, thanks for joining us today.
Thank you.
Shares are up 4.5% of Nike. Carl.
Meantime, as we go to break, shares of Okta under pressure as hackers claim they have breached a number of the cybersecurity firm's systems. Company saying today that it detected an attempt to compromise an account in January, but sees no evidence of ongoing malicious activity beyond that event. Shares down a little less than 5%. We'll be right back. Stay with us. Time for our ETF Spotlight today. We're taking a look at the Crane Shares China ETF, ticker KWEB, as you know, more than 60% off the highs of the year and on pace for another month in the red. Core holding, though, Alibaba, more than half off its 52-week high, announcing an increase in the buyback to $25 billion. That is the largest ever for the company as it tries to recoup some of the stock's massive losses. Is now the time to put your money to work? Mike Santoli has some thoughts about what it's like trading some of these China names, Mike.
Yeah, Carl, I mean, with any company, when they do an aggressive new buyback authorization, this one amounts to more than 8% of Alibaba's market cap right now. Usually is this sort of subtle signal that, in fact, they think the stock is a good deal or they have excess capital they want to distribute out to shareholders. This is a much more explicit signal, obviously, that the Chinese authorities are giving some kind of a clearance to these companies to try to support their valuations, that the authorities are not looking to penalize holders of capital beyond what's already happened. I'm not sure if that really tells us much about the longer term or just that they, can stop going down for a while, recoup some of those losses. With Alibaba, how many people have come on and talked about how cheap the stock looks if you believe, the earnings and you're willing to deal with a lot of the kind of weird setup, the structural setup of Alibaba in terms of the offshore entities and things like that. So obviously a positive in the context of everything in this market that's gotten beaten down this badly and was once very crowded and has now become arguably underowned. It's all having a revival in the last week.
It's interesting because, a lot of this stems from policy stuff, too. And, the SEC had begun identifying Chinese companies that would have to be delisted by early 2024 because of those audits. And then you have Congress has been pushing to force delistings as soon as 2023, expected to be part of the China competition bill that's making its way across the hill right now. And then you have these moves by Chinese regulators, at least where companies like Alibaba, for example, or Baidu or JD.com, that are not considered affiliated with national security, have those national security ties, are being pushed by Chinese regulators to prepare for more of these audit disclosures. Could this actually be one of those rare cases, and this is what's playing out in the markets, where we see the U.S. and China come together on some sort of agreement, dare I say?
I don't know, Morgan, if it requires an agreement. Theoretically, that could be out there. I just wonder if all of those factors have largely been in play for some time right now. Anybody who really it was crucial for them for these to have sustained U.S. listings, if that was really going to be critical that it has to be listed in New York, maybe you're already out. And everybody else who says, fine, I'll own it through, directly through the Hong Kong shares, that's able to put in some kind of a floor as well. I don't know if we have a lot of clarity. I don't have a lot of clarity as to kind of U.S. intentions when it comes to that law and how, there might be some daylight in there. But I do feel like once you've, been cut in half in value, a lot of those impediments have probably been accounted for.
Hey, finally, Mike, more broadly, our second day in a row of peaking above the 200-day on the S&P, and we've been watching S&P 4500. We just got it. How important are these levels, I guess, psychologically for the moment?
I think putting some distance between where the market was below that really steep downtrend, it pretty much coincided with crossing above the 200-day, is significant. It definitely builds the case that there is something more going on than just a reflex bounce. I think the more crucial area is probably 2% higher from here. The February highs hit twice, just under 4,600. That, if you look at a chart, that's sort of like the top end of the range unless proven otherwise. So maybe there's some clearance till that level.
All right. Mike Santoli, thank you. After the break, we'll talk travel and cruise stocks. Carnival reporting results today. We're back in 2.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. The sieges of Ukrainian cities continues to inflict heavy damage near the Black Sea in the city of Mykolaiv. Doctors cleared rubble at a psychiatric hospital hit by a Russian missile. Meanwhile, Ukrainian forces say that they have retaken an important suburb of Kyiv. Russian opposition leader Alexei Navalny has been sentenced to another 9 years in prison for fraud and contempt of court. He's already serving a 2.5-year sentence. Navalny says that the charges are bogus and politically motivated. Kremlin critics say that this is an attempt to keep Putin's most ardent foe in prison for as long as possible. And back here in the States, some amazing footage of one of the reported tornadoes that hit Texas and Oklahoma. Take a look at this video. A truck getting flipped on its side and spinning around before being blown back onto its wheels. Miraculously, the driver was able to drive away. The storm is expected to move into Louisiana and Mississippi today. Incredible. Carl, I'll send it back to you.
All right, Rahel, thank you very much. About an hour into trading this morning, action is pretty decent, back about 4,500 on the S&P for the first time since February 11th. You got the VIX down for a 6th straight day, below 23. All of this happening despite the rise in yields as the 10-year gets above 235 and the 2-year gets above 220, both of those the highest since 2019. Despite the rising cost in fuel prices and inflation at a 40-year high, folks are springing to book some travel. Our next guest predicts a major uptick in domestic and international travel even. Joining us this morning, TripAdvisor CEO and co-founder Steve Kaufer. Steve, it's good to have you back. Good morning.
Oh, thanks. Good morning to you.
Everybody sort of understands the need or the desire to get back on the road domestically, but I'm curious to know how strong you think international is actually going to be.
Oh, we think it's going to be pretty strong. We have roughly a quarter to a third of the U.S. travelers that are planning to travel this spring are looking internationally. And you see the big cities coming back, the London, the Paris, the Rome. We're really excited about that. And of course, it's so much easier to travel there now than it has been over the past 2 years.
Are you seeing a little bit of moderation in the cancellation rate, meaning people have been booking and canceling as a habit now for a couple of years, but I wonder if those booking patterns are, the stability is maybe elongating a bit?
Yes, we are seeing the fact that people are more comfortable making plans, and they are actually going out and traveling more. If you've been on a flight recently, it's more full than it has been in the past. As people are making their plans, and we really encourage folks to make their plans in advance now, because we see with all the data on our site, a lot more people are planning their trip. Hotels are filling up, flights are filling up, and more than half of Americans are planning to take a trip this spring alone. So it's going to be, we think, quite a busy summer.
So, Steve, it's Morgan. How does that compare to pre-pandemic levels? And I guess in terms of the types of trips that people are booking, the details that you have access to through that data, is it the same as before the pandemic, or have some of those trends and tastes shifted as well?
Well, talking about U.S. travelers, it's still more of a domestic profile than in international. So I did just say international's picking up a lot, but it's not quite back at pre-pandemic levels. So people are still a little bit uncertain as to how things will go. Globally, U.S. very robust market coming back strong in March, as we've said before. Europe catching up, also several countries there are quite strong. Asia Pacific a little less so, as there's still more restrictions in place. If I had to look at it regionally, everything is clearly coming back from where it was. Great news with Australia opening back up again, that sort of thing, but not quite at pre-pandemic levels.
How does inflation factor into all of this? I mean, there's this expectation that as you're seeing energy prices, for example, spike, that's going to lead to higher airfares. Is that already starting to trickle out?
You might well, in fact, see some higher airfares. Some airlines have done a good job hedging fuel prices and that sort of stuff. But the one thing that we have seen undoubtedly, consistently throughout the pandemic is that people love to travel. It's just become this inalienable right that's been denied over the past couple of years. And so people are eager to get out. I don't think a high gas price or a high flight is going to keep anyone from traveling this spring, and that's certainly what the data on our site is showing today.
Steve, one thing that we keep noticing in U.S. industries are businesses where they have been hesitant to invest in new development and new supply because they were burned the last time. Housing is a great example, Oil's becoming a great example. And historically, hotels have been a great example. They've been, in some cases, too willing to develop new properties. I wonder how much discipline you think they'll have in this current recovery.
Hard to say. I mean, 2 years ago, there was nothing like the precipitous drop that we had seen. But it's climbing back, and everyone's looking for those new travelers. In fact, our survey is saying half the travelers are looking to go somewhere that they haven't gone before. That's pretty exciting. It's a great way for new destinations to take advantage of those new travelers. To the hoteliers that are looking, or the chains that are looking to build new properties, travel certainly will recover. I have no doubt about it, fully and beyond our 2019 levels. So it's a true constant. And I guess I'd leave you with the thought that as it's been denied by the pandemic, so many people are realizing now that it is part of what makes them a happy person. It is part of what makes them enjoying their life, to be able to get out and travel. And all of our data is coming back saying people are planning to take more trips. They're planning to spend more per trip. It's been this pent-up demand that's finally being freed now.
So how much of it is pent-up demand versus, I guess, a return to normal? Do we even know yet?
I'd say on the leisure, we certainly don't know yet. It's one of those hard to predict things. But on the leisure slot side, in our surveys, I think it's now becoming, or we believe it's going to become something that people just expect to do more of. And we're moving away from I just want to go sit on the beach for a week. We're moving into the real experiential trips where I want to take the cooking class from the local chef that'll teach me something that I can actually bring home. I experience it like the people that live there, and I take it home, and I'm able to continue kind of that learning or that experience part of the vacation. I think that's here to stay. I think people are going further than they've ever gone before. And we certainly see a strong renaissance in travel, not just pent-up demand, but an ongoing push by everyone.
Yeah, no, it's definitely caused us to not take travel for granted anymore. That's for sure, this whole experience. Steve, thanks. Good to talk to you. I'll talk to you next time.
Thank you.
I know, I'll still take a beach. Carnival reporting results before the bell this morning. Our Seema Modi has the latest, fresh off the company's call. Seema.
Hey, Morgan. Despite weak results, Carnival CEO Arnold Donald says the cruise line is coming off its best 3 weeks of booking since resuming operations. While Omicron did hurt first quarter sales and resulted in higher cancellations, about 75% of its fleet is back to sea. For context, Royal Caribbean is at around 85%. Now, on fuel costs, Arnold says Carnival is trying to reduce consumptions by removing less efficient ships. In total, about 22 since 2019. Costs related to fuel at this point are not pushing cruise fares higher. That is something that Wall Street will be watching very closely. Arnold also talked about ceasing operations in Russia, which did account for nearly 5% of capacity. He says the invasion has added some volatility to its business and does impact consumer confidence to an extent. He, though, sees occupancy building through this year, but a full return to historical levels not expected till 2023. So the timeline is being pushed back. I think what this tells us, guys, is that while the appetite for travel is improving, as evident in TSA check-ins and hotel occupancy, as well as the comments from CEO of TripAdvisor you just heard there, today's numbers for Carnival suggest that the broader recovery in cruising will take a little longer. Earnings expected to turn positive this summer, so that's looking at third quarter or so. Morgan, back to you.
So what does that mean in terms of actual capacity levels and companies like Carnival putting more ships on the water and continuing to grow their fleets?
I think the idea, Morgan, is they're going to stay very aggressive on trying to bring back as many ships to sea because they hope that demand will continue to gradually improve over the coming months. They're currently at 75%. So that says 75% of their ships are currently running. They're hoping to get to 100% by this summer. I think watching fuel prices will be really interesting, right? If we continue to see higher fuel prices, does that stop them? Does that delay them? At this point, the commentary that we're hearing from Arnold Donald is that it won't.
Seema Modi, thank you. Shares of Carnival are down about 1.5% right now. Just a quick programming note. Don't miss an exclusive interview with the CEO of Carnival, Arnold Donald. That is later today at 3 p.m. Eastern on the closing bell. Still to come, how a $50 million mansion on the Rocky Mountains could be the next target of U.S. sanctions. We've got those details. And as we head to break, a check on the top gainers on the S&P this morning. Align Technology, Constellation Energy, Wells Fargo, SVB, and Signature Bank. We'll be back in 2. Welcome back to Squawk on the Street. Let's get a check on Bitcoin at this hour. It is higher. It's up about 4.5%, 42,970. Joining us now to discuss the cryptocurrency space is Pascal Gauthier, Chairman and CEO of Ledger, which develops security and infrastructure solutions for crypto and blockchain applications. Pascal, great to have you on the show. In terms of what we're seeing across the asset class more broadly right now, I just want to get your take, given the fact that we have seen Bitcoin climb above 40,000 again in recent trading sessions. We've seen a bounce in Ether and some of the other names, and sort of how it speaks to the dynamics we've seen from a pricing and trading perspective.
Sure. So thanks for having me. I think for us, we never look really at the price. We look at the dynamic of our own business and how much devices we're selling in terms of security. And what was interesting for us in Q1 is to see that we had exactly the same trend as we had in Q4, where Q4 was an extraordinary quarter for the crypto markets. And so, for us, the way that we look at it, you still have a lot of people coming in. So now you can see action on the price, I think, because of this, but also because, this is an asset class that is getting more relevant by the day. And so for Ledger, it has been a very strong Q1 quarter to date, comparable to Q4.
So talk to me a little bit about how geopolitics is factoring into potentially some of that demand right now, because certainly everything we're seeing playing out with Ukraine and Russia, crypto has become a key focus, not just the debate around sanctions and sanctions evaders, but also just in terms of all of the money you're seeing being raised through cryptocurrencies in Ukraine to aid in efforts and humanitarian issues there. Is it fueling not only security, but also just demand in general for the types of keys that you are creating and selling?
Yeah, definitely. And I think, what you're seeing now is something that, the Bitcoin and crypto community has been advocating for a long time. Since 2008, I joined in 2014. And even in 2014, when you were saying those things like, Bitcoin will be useful in those type of situations, people will look at you and thinking, okay, this will never happen. And now what has happened between 14 and now is, many fiat currencies have gone down, severely, depending on the country. War has happened, when people thought that war was behind us, and it's happening in Europe, just at our doorstep. And so these are situations where suddenly Bitcoin revealed itself as a great store of value, as a great medium of exchange. But it's no surprise. It's something that we've said for a long time.
So how does that speak to the partnership that you recently announced with Nuvei, I'm not quite sure if I'm pronouncing that right. Because I would imagine that what we are seeing playing out in Eastern Europe, for example, or the fact that you have a hyperinflation dynamic that is starting to emerge in certain key emerging markets as well, is only going to drive more everyday, potentially, use of cryptocurrency assets.
Correct. But you see those trends, they've happened already 12 months ago. I was looking at our statistics before coming on this show, and the last year we've seen extreme growth, much higher actually in Russia and Ukraine that we've seen in other regions of the world, especially compared to the US, for example. So let's say that US was 150% growth year on year, and what we've seen in Ukraine and Russia was more like 800% and north of that. And so I think the markets always anticipate crisis, and I think this has been building up until now. But what you see definitely is every time that a country enter a war territories and or fiat currency it's a debacle. Think about Lebanon, for example. Then crypto is really coming in every time, and so it shows that it's probably good for exchange of value for the future, for sure.
We keep looking for sort of landmarks regarding institutional demand and activity. A lot of it was when some of the U.S. banks started crypto research desks, and now these reports that Goldman is the first U.S. giant on the financials to trade crypto over the counter. I guess how material do you think that is?
I think, in general, the space is really early stage. I mean, think, the internet in 1995, except that this time everyone seems to be convinced very early on. I mean, in 1995, internet still had to convince a lot of people, and the bubble exploded in 2000. I think this is 1995 with everyone convinced. I'm actually very surprised by the maturity of the bank and the financial institutions that just jumped in this new asset class as if it was nothing. I mean, if we look back, we're thinking this was hard, but actually it went pretty fast. For all big U.S. banks to say that now, Bitcoin is okay, that went actually pretty fast if you think about technology and how usually big corporations flip. But it's still early, but everyone is very positive.
Finally, talk to me about this explosion in NFTs that we've seen over the last year, 2 years, and what that's meant for security and the opportunity there for Ledger.
Yeah, so NFT is an interesting phenomenon. I think NFT covers many things. NFT for me right now is just like saying a website again in 1995. So under an NFT, which is a technology, you have like multiple type of applications. For us, it's been extremely interesting because NFT started with everything that is scarce and has value. Think art, think those pieces that have got extreme value. And it's been really great for the business. The reason why, Ledger is still doing extremely good in Q1 versus Q4, even though, Bitcoin and cryptocurrencies have gone down, is probably because of the trend that we're seeing in NFT. That trend is still really high. It's actually a lot of new people are coming in the market just for NFT, not so much for crypto. And then, of course, there's the crossover, because as soon as you touch NFT, then at least you need Ethereum or Tezos or Solana. So you need your crypto to go with it. So it's a big boost, but NFT is not over. I mean, it feels like a hype, but it's actually a very strong underlying trend.
Interesting. Pascal Gauthier, thanks for joining us today.
Merci.
You are looking at a live shot of Disney headquarters in Burbank, California. A company is preparing for a planned employee walkout over its handling of recent LGBTQ plus issues, including its stance on Florida's Don't Say Gay legislation. We'll have a lot more coverage coming up in the next hour on Tech Check as we continue to hover just above 4,500. Don't go anywhere.
And welcome back to Squawk on the Street. I am Frank Holland. As you can see, stocks are mostly higher today, with financials and communication services leading the way, the top performing sectors. Communication services is up 6% in the past week, but still the biggest laggard on a year-to-date basis, with roughly 2/3 of the sector still in negative territory. But today's leaders include social media names like Twitter, Match Group, and Meta Platforms. All of those names are up double digits in the past week. Alphabet is also outperforming today, up roughly 2%, but the tech giant is still around 8% off of its February high. There's more Squawk on the Street ahead. Stay with us.
Welcome back to Squawk on the Street. At the top of Wildcat Ridge near Aspen sits a 14,000 square foot modern glass mega mansion that could be the next target for sanctions. Our Robert Frank has that story. Robert.
Good morning, Morgan. Well, so far, the U.S. has not frozen any assets of the oligarchs, but that may soon change. The White House now considering whether to add Roman Abramovich to its sanctions list. Now, he has been sanctioned in the UK, Europe, Canada, and Australia, with his assets there frozen and travel restricted. Now, if he is sanctioned here in the U.S., the first stop for the feds will likely be Aspen. Abramovich owns 2 homes there. One is a 14,000 square foot modern glass mega home on 200 acres in Snowmass. Abramovich bought the property back in 2008 for $36.5 million. Brokers tell me it is now worth well over $50 million. He also owns a 5,500 square foot ski chalet down the road that he bought for $12 million. County records show both properties actually remain in Abramovich's own name. Now, this is highly unusual since most oligarchs own their real estate through anonymous shell companies or relatives. Now, because he is still the official owner, the feds would likely to be able to freeze these assets almost immediately. Now, to seize them and actually take title, justice would have to prove Abramovich committed a crime, which could take years. Meantime, Morgan, it's unclear who's going to pay for all the upkeep and the more than $100,000 a year in property taxes.
It's pretty incredible. I mean, it does seem like there's a little bit of a fire sale going on here where Abramovich and some of these other Russian oligarchs that are getting sanctioned are concerned. I mean, meantime, the sale of Chelsea, the soccer club as well, expected to have some buyers emerge there. I mean, how quickly can some of these assets across some of these different countries actually be sold, potentially?
Yeah, it's Chelsea. It's his $100 million London mansion. It's his place in France, also more than $100 million. The challenge for any buyer is, yeah, these assets are attractive, but do you want to get involved in a transaction that involves someone who's sanctioned on the other end? Will there be someone down the road claiming ownership? So that's going to be the challenge for getting a quick sale of any of these assets, including these Aspen homes.
All right, Robert Frank, thank you. Just getting a quick check on the markets. The S&P is up about 1% right now, 4504. The Dow is also up 234 points. And the NASDAQ is trading higher as well. It's up about 1.6%. That's going to do it for Squawk on the Street. Tech Check starts now.
Good Tuesday morning. Welcome to Tech Check. I'm Carl Quintanilla with John Ford and Deirdre Bosa. This hour, Disney employees walk out. CEO Bob Chapek responds. We've got details live from the company's headquarters. Plus, Baba with this enormous buyback. Shares are up double digits today, 50% in the last week. And then cyber attacks top of mind for Washington. Okta shares down after suffering its own breach reportedly. We'll have what stocks could benefit from investments in that space, Dee.
Carl, we're going to start with the markets. The Nasdaq snapping a 4-day winning streak. Comments from Fed Chair Powell signaling more aggressive rate hikes. That put pressure on stocks yesterday. That has not been the story for the prior week, though, when we have seen a ferocious rally and some stark moves in the mega caps. Nvidia, Tesla, Amazon, and Meta all up double digits. Alphabet, and Microsoft and Apple. Those are also outperforming. We talked about Anaplan yesterday, BTIG, giving you another idea this morning, initiating on Datadog at a buy. Stocks rallying over the last week, but it is still down to start the year. This is a stock that has fared better than many others in the tech and especially cloud sector. Guys, it's another day, though, of big gains for the Nasdaq. We're seeing this outperformance, John, up 1.6%.
Yeah, I mean, I'm not convinced. I don't know. I mean, everything seems to be up, roughly speaking, technology-wise, since that, what was it, March 14th low, and the mega caps are following suit. A lot of growth stocks higher as well, Carl, but there's been so much volatility that it's hard to draw a storyline versus just kind of like the story of a ping pong match, it feels like.
Indeed. We're watching Amazon, D, which is trying to get back above
the flat line for the year to date. And of course, with Adobe tonight, we're going to be definitely on edge looking for signs that maybe some of the disappointments in the past couple of quarters relative to expectations might be reversed if guidance is a little bit more bullish.
Yeah, it's going to be really important to look at these mega caps. We talked a little bit about this yesterday, but that ferocious rally we saw last week was in a lot of the unprofitable tech names, the ARC names. But what we're seeing now, and you just saw that board, is the mega caps following suit and perhaps, John, a more solid foundation for a market comeback.
Maybe so. Let's talk about it. Our next guest is a longtime tech investor, sees risk to owning large cap stocks in this environment, leading his funds to hold their lowest large cap tech exposure in their history. Joining us now, Jacob Asset Management's Ryan Jacob. Ryan, good morning. So what is a large cap these days? I mean, now we got mega caps. What do you call a large cap?
I think you can comfortably call anything over 100 billion a large cap. Now that we're in the age where trillion-dollar companies aren't as rare or exist now, we have a whole other range to look at. But generally speaking, we have reduced our large and mega cap holdings, and we do have one of the smallest allocations, probably under 5% in our strategies, allocated to these larger names.
Now, why is that? I mean, these days, ServiceNow, even Airbnb is a hair above 100 billion in this environment. Qualcomm, Intel, et cetera, are all in that category. Even some names that have significant growth, though I know that your concern is that the smaller and medium-sized stocks are going to have a better chance of posting that important growth in the fundamental level in this inflationary environment.
Well, I think when you look at the distinction, growth names, I know with rising interest rates, investors are very cautious with growth names. I think we believe that there should be a distinction between higher growth names and lower, more mature company growth names. So when you look at an Intel or a Qualcomm, these may be GDP +3, +5% type growers. A lot of the small and mid-cap companies that we favor, they're growing 30 or 40% more a year. So they're more able to overcome, a slight rise in interest rates. When you look at the more mature tech companies, they're really being valued based on current earnings and cash flow yields. So they probably will act more bond-like in terms of seeing a compression in valuation multiples. But we're seeing the better opportunities now, definitely in the smaller cap space.
Yeah, although, you can never be too careful. I mean, a lot of these giants can be creative. Alphabet's a good example today where there's different ad formats. They're going to try to leverage travel and auto on this, reopening post-COVID, which can maybe make up for some tough comps in retail and e-commerce. I wonder, I mean, how much of the names, the large names that you think you may be a little suspect about, which do you favor the most?
Well, it's funny. Actually, Alphabet is kind of the last man standing for us. Alphabet is our only remaining mega cap company that we own, and it's still a small position. But when you look at Alphabet, they're still growing very comfortably over 20% a year. When you look at the margin profile, we believe that Alphabet will have a problem similar to Apple had a few years ago, where, quite frankly, they're generating too much cash. They won't be able to make any sizable acquisitions. The cash is building on the balance sheet very, very quickly. So we think we'll see continued upping of buybacks there. And you combine that with 20% plus growth, that's really the reason why that one's still remaining in our portfolio.
Ryan, a lot of our guests argue, though, that big tech is the much safer place to be in an uncertain macro environment with rising rates. Some of these smaller names, yes, they are growing, but, the market is trying to figure out whether they're features or platforms. Isn't there more risk when you're going into these names, when you're seeing these valuation compressions and, we don't still know where they're going to settle? Could some of them be washed out?
Of course, there's more risk. I think, as John pointed out, a lot of the tech market has been in a bear market now for about 12 months. And that started with the small, more speculative, expensive names. And then really it was only until January that we saw that kind of reach up to the largest mega cap names and be affected. Our guess is that when we come out of this tech bear market, we'll see those smaller, more expensive names actually outperform initially in the same way that they were the first to get hit roughly 12 months ago. I think, with everything going on in the world, it's very difficult. I think if we had not seen the geopolitical issues come to fore, I think we'd be in a much better place right now. I'm not sure the market's as afraid of higher interest rates. I think, we need to remember that higher interest rates are indicative of a healthy economy. If we had terminally low interest rates, I'm not so sure that would really get investors comfortable with where the economy stands. So we actually welcome slightly higher interest rates here. And, I think if you look back also in history over time, whether it's the last decade or actually you can look back 60 years. The Wall Street Journal did recently an article on this where they looked at durations and how, generally smaller cap companies do better in a rising interest rate environment. And that's because it's indicative of a healthier economy.
What's the yardstick, Ryan, that you're using valuation-wise to determine what these stocks are worth? Is it a certain revenue growth multiple?
Yeah, no, it's a great question. And I think it's a place where investors can easily get tripped up. I mean, you don't want to get into a situation where you're using overly optimistic modeling. You can get creative with your numbers as valuations expand. I think when you look at our top holdings, I mean, we do own companies that do trade at maybe 10, 15 times revenue. They tend to be some of our smaller positions, and they also tend to have, really some of the largest TAMs that we can, that we profile for. So, when you're looking at valuations, it's important to recognize the opportunity, but also, kind of where they stand in their business life in terms of their cycle. And if we feel confident that they have 30, 40, or 50% growth ahead of them for a number of years, we'll be much more lenient on valuation. But you'd be surprised when you look at a lot of our top holdings, you're not going to find as many of the 10, 15 times revenue type situations. A lot of our larger holdings you can value on EBITDA, even though they're not kind of the mega cap names that most people talk about.
All right. A fresh perspective. Ryan, thank you. Ryan Jacob from Jacob Asset Management.
Turning this morning to Disney, the employee walkout beginning at 11 a.m. Eastern Time. This is focused on the company's response to that so-called Don't Say Gay bill in Florida. That's where we expect the bulk of the protest as well. Our Julia Borston is outside Disney HQ in Burbank. Morning, Julia.
Good morning to you, Carl. Well, here I am at Disney headquarters in Burbank, California, and there's no sign of the walkout protest that was scheduled to start right now. But we don't know how many employees are protesting elsewhere or how many are doing a virtual walkout and posting an out-of-office message right now. But it is notable that this morning, all of Disney's different properties, including ESPN and Disney World, tweeted their support for the LGBTQ+ community. And this comes after yesterday at a virtual meeting, Disney CEO Bob Chapek acknowledged his missteps and announced some new plans to help address the frustration that you just mentioned about that Florida bill. Now, Chapek said he wants to use this moment as a catalyst for meaningful change. And in addition to working with those fighting the Florida bill and pausing donations in the state, he announced some new steps. First, Chapek is going to go on what he calls a listening tour to hear employee concerns around the world. Second, he announced a new company-wide task force focused on developing a strategy and concrete actions to engage the LGBTQ+ employees and creators to be a force for good for those communities, with a specific focus on developing more LGBTQ+ content. And he also revealed that the company has signed the human rights campaign opposing the Texas policy that criminalizes parents providing gender-affirming care for transgender minors. Now, these moves do address many of the demands of the group that organized the walkout scheduled for this morning, but the organizers tell us that yesterday's session was, quote, a great opportunity for the company to specifically address our concerns, but unfortunately, we didn't hear much of a plan. They go on to say, quote, we still see the walkout as necessary to communicate to leadership just how important this change is to us, saying this change is bigger than the Don't Say Gay bill in Florida. Cultural change is needed, and there are many more bills on the way across the country. Now, sources do tell me that the temperature, the level of outrage, it has cooled since last week as employees see Disney very much engaging with these issues. Of course, the big question is what comes next, guys?
Julia, can you compare what you're seeing with Disney here to what we saw with Netflix a few months ago after the Dave Chappelle special and concerns among employees that Netflix management wasn't sufficiently sensitive to the issues of transgender employees and the culture in general. When you look at how Netflix, Sarandos, and Hastings handled that, and the way Disney is handling this, are there similarities and stark differences?
There are similarities and differences, and I would say the biggest differences are in the types of companies that Netflix and Disney are. Netflix is sort of seen more as an open platform, if you will. They license a lot of content. They've obviously lately been investing in making a lot more content themselves, but they have a really wide variety of content on that platform, a lot of which is considered, sort of more risque, or some of it has been considered offensive by various groups. Disney is very different in terms of the fact that this is a brand that stands for something. It stands for supporting families, and especially under Bob Iger's leadership for 15 years, this is a company that sort of stood for centrist Democrat values and was very much seen as a company that was aimed to support families and also support diversity. So I think this does feel different in that the companies are just so vastly different. And also, once you get into the legal things and what the political donations are, it becomes about much more than one single piece of content.
Julia, that's a great distinction between the types of content that each of these companies are producing. We've talked in the past about whether Disney needs to branch out from its current sort of demographic and audience. Do you think that what we're seeing now could shape that? I know we talked about like horrors and thrillers, but if they wanted to even get a little edgier, would this perhaps give Chapek pause?
Well, look, we also have to remember that Disney did buy Fox, right? Disney bought the entertainment assets of Fox, which included the Fox studio, which does make that kind of edgy, mature, sophisticated content targeting adults, right? So that is not franchise content. That is films like Nightmare Alley, which are rated R, and they are making those types of films. So I think what you're really talking about, Deirdre, is whether or not they were going to pull that kind of content under the Disney brand and make it part of that Disney Plus bundle. And I think that's much more how they decide to go out in terms of streaming. And I do think there's a question of how that kind of content fits with the brand. But I think what we're really dealing with here is sort of the cultural issues and whether Disney wants to be donating to these political causes that cause so much outrage and frustration among their employee base.
Okay, Julie, I know it's still early here on the West Coast, so we'll check in with you to see what happens with the walkout. Thank you. Let's get a gut check on Alibaba raising its share buyback program to $25 billion, a push to prop up the stock following regulator scrutiny and growth concerns. Alibaba just increased its buyback program back in August, but that failed to stop the selling. Of course, this follows last month's report of the company's lowest ever quarterly revenue growth since going public in 2014. Alibaba is up more than 13% today. So, of course, guys, these Chinese tech names have been incredibly volatile. Take the longer view. This stock is down 50% over the last year. So even this comeback that we have seen just brings it back to still beaten down levels. The timing of this, though, guys, is important. It comes after Beijing, Xi Jinping and Liu He have said that they're going to support the markets and the economy and sort of finish up this crackdown on big tech. Question is, John, do the companies even know when that's really over?
Yeah, I mean, okay. So that's what they say now. And yes, the stock has surged back to the levels of a month ago. But Carl, we've still had several people saying these stocks are uninvestable. I'm not sure if this latest move changes that. I mean, they're certainly tradable. They're definitely tradable. But what can you count on when it comes to these, especially as Dee mentioned, Baba's been cut in half over 12 months.
Yeah, well, you can count on continued volatility, Dee. I mean, it's on the one hand, you almost want to search for the pattern of when do they allow the stock to run and then when do they clamp down. We've seen this in multiple industries, but in order to do that, you have to be extremely brave and extremely nimble, as our Cashin might say.
Indeed. Indeed. Well, still to come, the White House warns Russia may be expanding cyber attacks. Plus, we look ahead to NVIDIA's Investor Day. Tech Check, just getting started. NVIDIA's Investor Day kicks off this afternoon. The semiconductor ETF, SMH, down 12% this year, about equal to the S&P's declines. Christina Partsinevelos has more on what's ahead for NVIDIA, especially after that deal to buy Arm fell through. Christina.
Well, we know tech stocks have had a frustrating start to the year, and graphics specialist NVIDIA is no exception. The stock is actually down about 9% on the year after it failed, like you mentioned, to acquire SoftBank's Arm, and actually faced a cyber attack recently. But the bulls are back, anticipating updates on data centers and NVIDIA's push into artificial intelligence, which I'd like to point out right now, the CEO is giving a keynote, and that's all he's spoken about thus far. A Cowen analyst did note that NVIDIA's sales tied to the metaverse, the shift towards interacting digitally, could reach $10 billion by 2030. NVIDIA, we know, is known for its graphics processing units, which are found in data centers, as well as high-powered graphics cards used for gaming, and both of those set up quite well for the metaverse. NVIDIA's data center revenue, as an example, was up 71% just last quarter. It's not all rosy, though. NVIDIA has faced supply constraints with gaming parts. You have third-party pricing drops from the likes of AMD, which could mean increased competition. And, of course, the previously stated $8 billion auto backlog because of what's going on in Ukraine and Russia, and its stretch valuation about 170% higher than the average could leave some investors a little bit uncomfortable holding this stock in this risk-averse market. NVIDIA's management will need to provide data points on how these segments will be handled for a positive acceleration of the stock. And so far, Wall Street is definitely betting that's going to happen today.
Christina, thanks. We're going to stick with NVIDIA for the moment. Joining us for a closer look at what to expect from their Investor Day, Bernstein Senior Semis Analyst Stacey Rasgon. Stacey, good to have you back. To Christina's point, I wonder, you've got to outperform 325. Is this a stock that's being driven by sort of next-gen, aspirational horizon stuff, or just more guidance on their ability to be tactical, manage supply chain, and so forth?
Well, I think the latter is important, for the near term. But I mean, look, this stock, it's a package of like open-ended option values. Like, this is the nice thing about NVIDIA, is they're out there creating new markets. They're creating big TAMs. I mean, the ultimate opportunity in some sense can be as big as you want it to be. And so far, they've been delivering against those kinds of ideals. So this is why it gets the multiple that it does. And this is why investors have been enamored of it, I mean, for quite a while now. But I mean, they're really out there creating new markets and actually executing against that. So, yeah.
Right. So of those new addressable TAMs, what's most exciting? Give me which industries you think are going to be the ones to focus on.
Yeah, I mean, obviously data center is the one that everybody looks at. And I am hugely bullish on their long-term data center opportunity. There's a paradigm shift going on. As we reach the limits of prior data center architectures, we need to do something else to keep performance and efficiency growing. We're offloading workloads onto other types of silicon that they are providing. And I think the opportunity for that is over time massive. And I think we're still early. If you can look at their revenues relative to like how big I think this is, I think we've still got a lot of headroom there. The other one that people are getting really excited about is software. And you mentioned the metaverse earlier here, and I'll be honest, I'm maybe a little too boomer. I'm still trying to wrap my head around the overall metaverse opportunity. But in some sense, they're out there creating software that this could ride on. They've got what they call AI Enterprise. They've got NVIDIA Omniverse. You can think about like sizing these things, and again, they can get blue sky like very, very quickly. We can be talking about like many billions of dollars over time. And today it's nascent. I mean, it's tiny. So these are the kinds of things that investors are getting really excited about if you're taking the long-term view on this stuff.
Yeah, Stacey, really excited. NVIDIA's got about 4 times the market cap of Qualcomm, I think, and you're not alone in that metaverse thing. But why not? Why not embrace the narrative, especially since...
Look, I'm willing to embrace it. Like, it's fine. It's fine. I just got to wrap my head around it.
Yeah, it's a lot to wrap your head around. But why won't NVIDIA get taken down with some of the momentum stocks, even visionary stocks like Tesla, given now that its market cap is bigger than Facebook, bigger than Visa? What is it about NVIDIA that they've got to continue to show to maintain where they are right now?
Well, it already has been taken down. I mean, we had this pretty sizable growth rotation earlier in the year, and I mean, NVIDIA is down fairly sizably from where it was at the peak. And I think it said it was trading about 40 times earnings, wherever it is right now. I mean, it was probably 60 times earnings not that long ago. So it's already come down like on the broader growth rotation. And the numbers have done nothing but skyrocket. I mean, it's been astonishing how large the positive revisions have been here. So I mean, obviously they need to keep that up, but they need to keep the dream alive. That's really what's going to be important. There's a broader debate in the space going on right now in broader semis, this kind of peak cycle versus stronger for longer. I do find myself a little more in the peak cycle camp. We may have talked about that, now and then, but in that environment, one of the things I do like are things that are more secular versus cyclically driven. I do think NVIDIA fits very nicely into that secular bucket. So it is something that we like here. And after the pullback, I think there's a good opportunity.
Stacey, it's Deirdre. Talk about the place that crypto may play in NVIDIA's TAM. We're talking to Ethereum co-founder Joe Lubin later in the program, and we're going to ask him about the upcoming merge to proof of stake. This shift has been cited as a potential threat to NVIDIA's graphics card products. So do you think that we'll get anything there? What do you think the implications are?
The thing is, like, NVIDIA doesn't really know how much of their gaming business is being driven by crypto, and really nobody does. You can try to size it, but it's very difficult, and the error bars are like that wide, so it's hard to know. Is it a potential risk? Yes. I think if it happens, it's temporary. I do think the secular growth for gaming is there. We've seen this before. We had a cycle like at the end of calendar 2018, beginning of 2019. It hurt, but it was temporary. At some point, it's not going to matter anymore. Like in my model, I've got data centers of them larger than gaming this year, right? So at some point, like crypto, whatever it's going to be, is not going to be a material driver one way or the other anymore. And I'll be honest, at some point, it's a little more mainstream now than it used to be. There are other drivers now that are different from what hit them last time. So, I mean, it is a risk. Part of me wishes if it's going to happen, it would just happen and get it over with. Because I think that a lot of investors are actually waiting for that. It's kind of like the one last thing that needs to fall where people could probably get comfortable with it.
Wow, that says a lot about how innovation gets absorbed. Pretty incredible.
Yeah.
We'll see what we get later on today. Stacey, thanks. Stacey Raskin joining us from Bursting.
After the break, a warning that cyber attacks are on the rise and Okta a victim. So are there stocks that will benefit from increased spend in the space? Stay with us.
Welcome back to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Ford. Social stocks, some of the big winners today, and a pretty good tape. We'll have more on the battle for market share in digital ads in just a moment. First, though, a news update with Rahel Solomon. Hey, Rahel.
Hi, Carl. Good morning. Here's what's happening at this hour. Treasury yields jumping again. 2- and 10-year notes have hit fresh highs going back nearly 3 years. That's after Fed Chair Powell raised the possibility of bigger Fed interest rate hikes. Shares of Carnival falling about 1%. The cruise line posting big top and bottom line misses for the first quarter. Carnival expects losses to continue in Q2, but forecasts a profit in the third quarter as booking trends hopefully improve. Oil prices giving back some of yesterday's gains. U.S. crude briefly dropped below $110 per barrel. Prices are getting support from a possible European Union embargo on Russian oil imports, although CNBC is told that that's unlikely at this point at least. And in London, nickel trading slowly returning to normal. Volume is way up, and for the first time in more than a week, the nickel contract did not hit its downside trading limit. John, I'll send it back to you.
Rahel, thank you. The White House warning Russia might expand cyber attacks against the U.S. At the same time, Okta shares down this morning after the cybersecurity and identity company suffered an apparent attack of its own, though it's not clear on the timing of that and the continuing vulnerability. Frank Holland is looking at that attack and what companies are doing to protect themselves. Frank?
Hey there, John. Okta shares falling hard on the news, as you would expect. The cybersecurity company suffered its own breach. Ironically, Needham out with a note today saying that Okta, along with a number of other companies, including Palo Alto Networks, SentinelOne, Zscaler, a number of other cyber stocks in that basket, should actually benefit directly from an expected uptick in cybersecurity spending from the president's executive order yesterday, as well as the Strengthening American Cybersecurity Act that passed just last week. Let's dig into that Biden executive order. It advised companies to use multi-factor authentication. That's when you log on and you send a text or an email to verify your identity. Also, engage with the FBI and the U.S. Cybersecurity Infrastructure and Security Infrastructure Agency proactively. And third, the EO specifically telling companies to build cybersecurity from the ground up instead of adding patches to existing networks. EU leaders, they're meeting with Biden to discuss banning Russian oil exports. The former head of cybersecurity research for AT&T says those talks alone are a catalyst for cyber attacks.
Making sure that the West understand that, hey, they have some tools that they can utilize to counter those sanctions. So, anything from ransomware attacks to even some of those wiper attacks that we saw in Ukraine at the beginning of the conflict are likely to happen.
Other cybersecurity experts say transportation and infrastructure would be the most likely targets of an initial cyber attack, with Shenzhen, the world's third largest port in China, limited by COVID and current U.S. supply chain tightness. Transport CEOs I spoke to say an attack on a major company will be simply devastating. Back over to you.
Frank, so you talk about the possibility in these analyst reports of continued investments in cybersecurity companies, but at the same time, we see Okta shares reacting to the reports of this breach, which might be from January, might not, unclear. That seems to speak to just volatility in the space, perhaps?
Yeah, I mean, I think right now, John, what you're speaking to is the fact that when companies report that they've been hacked, they have an issue, we don't really know the time frame. And that's really a lot about what the act that was passed last week is really about. Companies now under this act are supposed to report any type of cybersecurity breach or any issue within 72 hours to the U.S. government. If they pay a ransomware attack, they're supposed to report that within 24 hours. And that would give a lot more clarity, at least under the bill's design, to not only the government, but other companies about what's going on when it comes to cybersecurity and just how intense the attack was, or if their companies are also in danger.
Frank Holland, thank you for that. And after the break, a deeper look at Robinhood, why they think fair change is the future of growth. Stock is down 65% since its IPO. Don't go away. Robinhood built its reputation on easy stock trading options and then a huge boom in crypto investing. But today it is announcing some new products, and they look pretty similar to an old-fashioned bank. Kate Rooney has the details. Kate, this was pretty much inevitable. All of fintech eventually is heading that way.
Looking more and more like a bank, right, Dee? It's interesting to watch as Robinhood is looking to some of the less exciting parts of finance as the meme stock and retail boom fades. The startup announcing a cash card and savings account on Tuesday, which lets users invest spare change from transactions into stocks or crypto. Say something costs $5.75, it will auto-invest the remaining 25 cents of that transaction, also offering direct deposit and early access to paychecks. And this is one of a handful of some of the less flashy products on Robinhood's roadmap. Think retirement accounts and 401ks. And it signals a different growth strategy with more banking versus trading products. I spoke to Robinhood's Chief Product Officer Aparna Shennapragada about this. She says it's a way to drive user growth and expand the definition of investing. She also says that some of these smaller investments cater to what she calls the crypto curious, who might not be ready to go all in.
You can actually turn your spending, like your spare change from a cup of coffee, into crypto, right? Investing in crypto. And that's a far less intimidating, far less high risk view of just like starting to get access into an emerging ecosystem like crypto. Another idea that we are kind of pushing on, what we call this is like embedded crypto. This idea of like crypto comes with the product. Same thing with the spending account. You can split your paycheck. You can say, hey, some part of it goes into crypto so that you're not feeling like you got to go all in on this emerging ecosystem.
The product suite puts Robinhood in direct competition with Chime, Acorns, and Stash, as well as PayPal, Block, and SoFi. Some of those names really getting hit this year. Robinhood, for one, is down about 80% from that high. Dee.
So, Kate, I wonder, how do they monetize something like this? What does it mean for the bottom line? It's not like a payment for order flow where they're getting paid on the back end.
Yeah, so this is through interchange. That's how a lot of companies, Chime included, make money. They get a slice of the transaction from the card payment. So probably a loss leader in a lot of ways.
Right.
I mean, it might add something to the top line at least, but not as lucrative as payment for order flow. A different way to gain revenue, but also Shennapragada talked about bringing new users in, saying those who might be looking for a different banking experience and having a savings or banking account next to your brokerage account.
Right, and that's been so key, right? Robinhood has really sort of stalled out in adding those users, and then you got PayPal not even looking at users anymore, but average revenue per user.
Exactly, higher quality users.
Kate, thank you so much. Meantime, blockchain startup Consensus doubling its valuation to $7 billion in its latest funding round. The round included a rare crypto-related investment from Microsoft alongside other investors such as SoftBank and Singapore's Temasek. The round comes as Consensus's Ethereum wallet, MetaMask, reaches more than 30 million monthly active users. Here to discuss Consensus founder and CEO Joseph Lubin, who is also the co-founder of Ethereum. Joe, it's great to have you with us this morning. I want to start pretty broad because I think that a lot of our audience looks at Ethereum as a store of value, something that goes up or down. What do they need to know about its use case and about blockchain technology?
Yeah, something that goes up and down in a volatile fashion isn't necessarily a great store of value unless you have noticed that it's been going up for many years. And that's the case for most of the tokens in the blockchain ecosystem. Essentially, this is a paradigm shift. We're moving from the age of silos to the age of community, and we're building a new trust foundation for the planet. And that new trust foundation has enabled decentralized finance, a global decentralized finance platform that is enabling a very wide variety of applications to be built. Some of those applications that are essentially enabling businesses to be disintermediated take the form of non-fungible tokens, which in the early instantiations are enabling creators and content owners to directly access their customers.
Right, so Joe, disintermediation, decentralization, this is sort of the ethos behind Ethereum, but take the NFT market, for example, and many say that it's becoming increasingly centralized. You have a few big players, OpenSea as a platform, Yuga Labs for IP, Andreessen Horowitz as an investor. How do you reconcile that centralization with the fundamentals?
So it's a bit of a gold rush, and people take expedient steps to establish market share, whether you're a VC or whether you're an NFT platform. The direction of travel in our ecosystem and in our company consensus is towards progressive decentralization. So we find product market fit, and then we work diligently to decentralize. We're seeing that across the ecosystem, where lots of DeFi protocols are decentralizing. Many projects are exiting to community, establishing decentralized organizations to govern themselves in. And we will see a powerful movement towards decentralization in the NFT space.
Even so, Joseph, right at this moment, as you say, it's sort of a land grab, and we're seeing the big get even bigger. So walk us through how decentralization happens from here, how we're going to see sort of these existing players like OpenSea disrupted by the community.
Sure. So we operate some important projects. MetaMask is one, Infura is another. It handles a ton of the reads and writes in the Ethereum and related ecosystems. And across consensus, many of our projects are working towards progressively decentralizing themselves. So that involves turning projects that are essentially platforms into decentralized platforms. That can involve turning them into protocol, where lots of different actors can work together on that protocol collaboratively, or it can involve creating decentralized organizations for the governance of those projects.
Right, and it feels like you're taking this ethos to your own cap table. Consensus has a very diverse one, ranging from traditional banks to crypto companies. Now, Microsoft, a part of the latest round. What about Consensus or Ethereum unites all of these industries, all of these companies?
Well, it's a paradigm shift. The world is turning upside down. We've been operating in a world where corporations service their customers, often in an adversarial approach, and there is recognition that we need to re-architect the world and put the user at the center, and create a world where individuals and small groups have economic and political agency. And we have a tremendous group of strategic and financial investors who see that vision and are leaning in heavily to that vision.
Joe, we talked earlier on in the program about the proof of stake merger, that upcoming merger. Why does it matter in terms of Ethereum's practical use? And maybe talk about how it differentiates Ethereum from other blockchain technologies like Cardano and Polkadot.
So Ethereum 1 and Ethereum 2 are running currently. Ethereum 1 is the execution chain. Ethereum 2 is the consensus chain. They're merging. Some people think it'll be in June. Some people think it'll be in July, but it's soon. The merge effectively removes the energetically wasteful proof of work consensus mechanism and replaces it with an orders of magnitude more efficient proof of stake consensus mechanism. Essentially, it removes the carbon footprint problem that Ethereum and some other blockchains have. And so it's all about scaling, more transactions per second. It's about greater decentralization. It's about that low carbon footprint. It's also about ultrasound money. Ethereum is moving towards a regime where it becomes a disinflationary currency or token, and we believe that's going to drive a ton of value into the Ethereum ecosystem.
And Joseph, so interesting how you're going to convert most of your proceeds into ETH as well. Thank you for coming on. We hope to talk to you again soon, Joseph Lubin. And be sure to check out Crypto World. That's CNBC's digital show on all things crypto. Head to cnbc.com/cryptoworld.
Coming up next, Cathie Wood liquidating her position in one cloud name. We'll talk about it when Tech Check comes right back.
Time for a gut check. Buckle up. Cathie Wood's ARK FinTech Innovation ETF is in the green today, up more than 5%, but it's down more than 40% for the year. Top holdings there include Block, Coinbase, Shopify, and Twilio, but no longer DocuSign. Cathie Wood completely selling that position. This is a stock that's had a rough run in recent months with a 65% decline since September. CEO Dan Springer joined us after the company's Q3 earnings report and told us they're getting back on track for growth. Looks like Cathie Wood is skeptical of that forecast, at least compared, Carl, to what she wants to see.
Yep, we continue on a daily basis, Dee, to monitor her selling and her buying. Actually selling a little bit of Square now, in addition to the Twitter that she liquidated, buying a little Shop, buying a little Twilio, names that have had a lot of volatility lately, maybe because of her activity in part.
It's amazing, though, getting completely out of DocuSign. I mean, this is coming from someone who told us that these were names to hold on to for the very, very long time. What are we, John or Carl? Just a few, months out from the pandemic, I suppose. So, maybe DocuSign, again, one of these companies that have proved to be more of a feature than a platform.
Yeah, difficult to see how those pandemic trends are going to extend post-pandemic. Also want to get a check on Tesla today. Officially, as you know, opening that German factory today, delivering its first ever German-made cars as it looks to ramp up production. For more on the capacity, the supply chain, the impact on deliveries, go to cnbc.com as we are still hovering above 4,500 on the S&P. Tech Check is back after a quick break.
A big move in the battle for market share in digital ads, this time from our own parent company, NBC Universal. Julia's back with us for those details. Julia.
Well, Deirdre, NBC Universal is making its biggest push yet to compete with the tech giants such as Facebook and Google for digital ad dollars. Now, this morning, NBC Universal is unveiling new ad tools and targeting capabilities that are similar to what those tech giants offer, but for NBC Universal's premium content rather than what's generally user-generated content that dominates those platforms. Now, after Facebook, Snap, and others have struggled with losing access to first-party data in the wake of Apple's operating system change, NBC Universal announcing today the ability to do first-party data targeting across 230 million NBC Universal IDs. Those are people who have interacted with the company digitally. So everywhere from Peacock to Comcast set-top boxes to the Universal parks. Now, second, the company is also offering more digital tools to buy ads. So small and medium-sized businesses can easily buy spots across NBC Universal's platforms. They can also buy them through other outside ad platforms, including Adobe and Amazon's. And third, NBC Universal is rolling out new ad measurement tools that include streaming to guarantee those ads reach. And then fourth is also launching new ad formats, including live stream commerce ads. NBC Universal showed us this demo of how customers will be able to, say, shop into an Xfinity remote to buy products directly on their TVs. Now, NBC Universal is presenting this news to advertisers, tech platforms, and the likes of Salesforce right now as it looks to show that the power of big data is no longer the exclusive domain of the tech giants. Now, of course, it's not the only media giant to be chasing digital ad dollars. Paramount has its ad-supported Paramount Plus option, as well as Pluto TV. Warner Media has HBO Max with ads, and Disney Plus just announced that it is working on an ad-supported option as well. Guys?
Okay, see if it works. Julia, thank you. Missed part of the show? Well, don't forget to follow and subscribe to our podcast. That's the Tech Check Podcast. You can listen anytime, anywhere, wherever you download podcasts. Tech Check is back in a moment.
As the Nasdaq outperforms in today's session, it is Chinese tech names leading the way. Pinduoduo is the top gainer on the Nasdaq 100, up nearly 20%. You see Alibaba up 12%, JD.com, Baidu, NetEase also seeing huge gains. Though we remind you, as we often do, guys, that these names have still been beaten down on a yearly basis amid the clampdown from Beijing on antitrust. But guys, we have seen this surge in Chinese names now last a few days, making up some of those losses, Carl.
Yeah, a bit of a bounce. We'll see how long it goes. Meantime, one more thing, robots now poised to take over the roads of San Francisco. Alphabet's self-driving car unit Waymo announcing in a blog post that they're ready to finally introduce their driverless cabs to the city after offering free rides to volunteers since August. Company is still waiting on state approval and says that more details will be announced in the coming months. So for now, Phoenix remains the only market, John, where Waymo operates a fully autonomous taxi service. Even after all the data that they've collected, it's still a daunting challenge. I remember at Code, we talked about how especially just the topography in San Francisco makes it extra challenging.
Yeah, that and San Francisco, the city has changed quite a bit, Dee, since this expedition in driverless cars first started. If I'm going around San Francisco on a business trip, I'm not sure I'd feel comfortable necessarily not driving and not having another human being driving either, just because the crowd out there has gotten a little crazy since.
A little rowdy? Well, you got to get comfortable with having them on the roads. Tons of Waymos and other driverless cars on the roads here. Everywhere you look, Carl.
Yeah, it'd be interesting to see how that develops. We'll get Adobe tonight. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the resumption of the rally, even as rates continue to rise as well. Does that mean the worst really is over? We take that to the investment committee. Joining me for the hour today, Liz Young, Steve Weiss, Josh Brown, and Pete Najarian, the co-founder of MarketRebellion.com. Let's check the markets. The S&P getting back above 4,500 today. Man, it's been a run over the past 5-6 days. It's a gain of 1% for the S&P. Dow's good for 235. Interest rates are up, and stocks are up. And we haven't seen that very often, at least lately. I was going to start there, and then, Pete, I noticed a note that you sent in that said you haven't been this active in the options market in quite some time. And I looked down at the list of the calls that you've bought, not only today, but in the last few days, and it's astounding. Alibaba.
Yeah.
See what's happening there. Microsoft, AMD, Facebook, Apple, AMD, Walmart, the K-Web calls, and that's the Chinese internet name. So what's going on here? What's the statement here you're making?
Well, I think there's a couple of things going on, Scott, one of which is the volumes are off the charts. When you go to Friday, we had 50 million contracts trading. That's a big number. We had 41 million contracts trading yesterday. The activity levels are very, very high. Doesn't mean that they're going to be absolutely right on the timing of this whole thing, but certainly we are seeing across the board buying, Scott. One day it might be focused more on energy and uranium and that oil and that type of thing. The next day it might be more financials, and as you just read off, we're seeing more and more on the
Pete froze. We'll get Pete back. But he is doing a lot of buying, and so is Mr. Negative, Steve Weiss. Steve Weiss, you've been more negative than a lot of people lately, right, on where you think the market really is. And if the worst was really over, if this was a reliable rally or nothing but a bear market bounce. And I look down, I see you bought more Dick's Sporting Goods. I wonder if that's a little Nike play. You bought more Moderna. That's ahead of an event they're holding. More telling, though, perhaps you bought the semis, the SMH, and you bought Tesla calls. Talk to me, and hope you don't freeze.
No, I don't freeze in the face of pressure, unlike my friend Pete. Look, the reality is I've been negative, and I've been dead right, because I've been negative not over the last week, but I've been negative since January.
That's fine.
So
that's fine. Let's go where the puck is, right? I'm gonna borrow a saying from you.
Okay.
Right?
Exactly.
Where's the puck going now?
So everything, right? So everything I do is based on idiosyncratic stories. And if you take a look what I've done recently, yes, Dick's, and it's not working out as a trade. I have a rather large core position, and it's dirt cheap, less than 10 times earnings. but I thought it would move up on the Nike print. So that was a trade, and I'll probably get stopped out if it continues to decline on that, but keep my core position, of course. Moderna, look, Josh had a great call there when he came in and bought it, I think around the 150 level just a week ago. I added to my core position in advance of vaccine day, which I think is going to be another eye-opening in terms of their product pipeline and what will be coming to the market, perhaps the end of this year. You know, you look for the birth defect vaccine, which there is no competing vaccine in the market, RSV, et cetera, flu, et cetera. So that's all positives. That's why I bought more Moderna there. And the world's coming to realize that you're going to need boosters for a long time. And guess what? It's virtually every day they pick up another order, whether it's from Sweden, the Japanese government, Australia, et cetera. In terms of the SMH, I sold the NXPI last week because it just had a monster move off the lows. And I originally got into it about 185 and was unfortunately able to buy it a lot lower. And I just said I've got enough on. I've continued to add to on semi, which is in the same market by and large, but they're sold out all year, they've said repeatedly. So I think that's a cheaper stock and it works better. So the semi's just really getting market exposure. So that's the explanation.
But I mean, I feel like, look, you know, I know you like to have this persona, but I feel like you're growing more positive. That a lot of damage was done.
Yeah.
We're starting to put some stuff together. You know, the SMH maybe represents trying to get a little more exposure. Am I wrong? Am I making too much of this?
Well, you're wrong about a couple of things. In terms of persona, I don't like to have any persona because I really don't care what anybody else thinks. I'm doing what's right in this market to manage risk and make money. So if that fits to a persona, well, then so be it, if we all need a box to fit into. In terms of my view in the market, I always believe we're in trading range. I still think that the black swan event is out there in terms of China, and I don't think it's all in at this point. There, as you heard Meister last night, and what was an excellent interview in overtime, I mean, there's a wall of worry here. And I've maintained that you know, the positives are as well known as the negatives. So what's going to impact the market going forward? And in my view, the negatives are going to keep a lid on the market. Inflation's out of control, and we've seen some modifications in earnings. In other words, taking earnings down, and I think that'll continue. And as you get closer to the reporting period, you're going to see that more of a wholesale nature. In other words, guidance being played down by companies, by CEOs, et cetera.
Let me do this. Let me get back to Pete, because Pete got interrupted by the big freeze. So, Pete, again, you know, I made the list at the beginning of this program of all of these big name call options that you've been getting into, and continue the conversation for me.
Sure. Well, and you mentioned some of the names, Scott, and I'll rehash that. So Facebook is one of them. Today, it's amazing. All of a sudden, it seems like people have forgotten about Facebook for a while. I know it got under 200. I think Josh had a really nice trade there. He took it off very rapidly. And I'll tell you, Scott, now they're coming back again for Facebook, and they're coming for the 220 calls and looking at huge size. And we are seeing huge size trades across the board. AMD, a buyer of 50,000 of this week's expiring 120 calls. You look at what's going on with Facebook, those calls are about 36,000 of them. And as a matter of fact, they bought other strikes as well. So we're just seeing across the board. Microsoft, we were seeing upside. They're going actually out to April on the 320s in Microsoft. Stock was trading at the time just beneath 300. So it gives you a little bit of an example of what we're seeing, the kind of volumes that we're seeing, these size trades that are coming in. These are not mom and pop. These aren't Pete or anybody else making these trades. These are big fund managers that are coming in. You know, you take your pick on who you think it might be, but some monstrous trades that are coming into these trades. And it's just incredible. And it's something that I was just telling Patty, the producer, I think I've got a little over 50 different option trades on right now. So it just shows you how active it's been and how active I've been. A lot of trades. Some of them are traded very quickly. I traded a little too quickly out of BABA, but I'm back into BABA once again. We had those 100 calls getting bought about a week or so ago, actually a little less than that, and those absolutely exploded within days. I got out of it. I'm back into BABA right now. So we're seeing incredible option paper and a lot of different things, whether it's Chinese or oil or whatever. And, you know, you've got to be a participant. This is where the money is made, and it's being made now.
Wow. 50 trades. I hope you can keep track. of all of that. So Liz Young.
That's just the calls.
Yeah, well, that's true. Liz Young, I look at my back set right now and I click over on treasuries and I see 2 and 10s. I mean, they're up like 10% over the last couple of days, and yet stocks are up. And maybe that's the most telling sign that we know what's coming from the Fed, and we're going to get used to that fact pretty quickly because we have no choice.
Yeah, I mean, the anticipation turned out to be worse than the actual event. And now the messaging that we heard yesterday, honestly, I think it sets us up to be prepared for the worst, but hope for the best and hope for some sort of dovish tilt if we get a surprise that inflation, in fact, starts to relax, or that they can't hike rates as quickly as we think today. And also, we've talked about this on the show many times. If tech rallies, the overall market does better. So as tech sort of recovers here and sees some nice rallies, you're going to see the overall market go up as well. And there are a couple different outcomes that could happen. Well, there are a lot of different outcomes that could happen. I don't think any of us pretend to know exactly what's going to happen. But a couple things that could happen, if we end up orchestrating the soft landing, which I think is probably a low probability, then tech probably does well there if inflation cools off. If we have a hard landing and people get nervous because there's an inversion or an impending recession, tech still does well. So I think some of this rally in tech is something that could hold up for a little while.
Josh, rates up, tech up. I mean, it's been a nice run. You've had some hawkish comments in the last 24 hours from the Fed chair himself, from others. You've got the market now pricing in, according to Leisman, 7 more hikes this year from 6. And 50 basis points at least one meeting, and yet here we are. What do you make of it?
I think we get a curve inversion by the summer or early fall. I think then you're on recession countdown. Earnings should hold up throughout the balance of this year. Companies have done a remarkable job passing through all of their higher costs on everything from commodities to labor to the end customer. But that obviously can't continue as we remove liquidity from the system and all of these stimulus plans start to lap their 1-year and even 2-year anniversaries. So you've got a consumer that's in good shape. A year ago, I would have said incredible shape. Balance sheets are still decent, but they can't withstand what it costs to fill up a gas tank. They just can't. And then when we get into air conditioning season, it'll be worse. And now Europe seems to be moving toward some sort of full continental boycott of Russian oil. And that's going to make everything worse as well. Speaking of Russia, they are now forcibly removing women and children from the city of Mariupol, which looks like a Mad Max movie. They're packing them on trains. We used to tease Ray Dalio for calling this a late 1930s analog. I don't think you could do that anymore. That's literally what the pictures look like if you watch the news 7 nights a week.
So you're bearish.
In that kind of environment, it doesn't take much. In that kind of, well, look, the U.S. economy, the U.S. stock market is the best of the bunch, okay? But in that kind of environment, just remember, the market can turn on a dime. It's great that the NASDAQ has rallied off the low. It's great that Facebook and blah, blah, blah. It's great. I'm not against it. We own these stocks, okay? But this idea that we're going to flick a switch and be risk on, risk off, risk on, it's really, really hard to do. So I just think if you're going to be in this market, tighten up your stops if you're in a trade. Moderna is a great example. Weiss brought it up, so I'll reference that. I bought that stock by accident. It's my best trade of the year. Tells you how good I am. 125 actually. So now I'm rolling up the stop into the high 150s. I'm going to trail it from there. I'll probably end up using the rising 50-day at a certain point and just try to hold on to Moderna because I still think it's gotten too beaten up. You can do stuff like that, but I don't want full risk to have that entire gain, 45 some odd % off the low, turn into 15% off the low, and I give up all this opportunity. So I think you can be productive. I know what Pete's doing with options. That's very short-term stuff too. I think you can do that. I just want people to keep in mind the context is pitch black. Yield curve inversions and worsening geopolitical crises historically don't resolve themselves like a sitcom in 22 minutes plus commercials.
So then, Steve, that keeps a lid on things. I mean, nothing that Josh said was wrong. in terms of what the geopolitical, for certain, risks are. Inflation here, gas prices, you know, the obvious hit to consumer that it's eventually going to catch up with people even more so than it already has. Is that too much to overcome to get too bullish?
I think it is. We're in a trading range, and the trading range, guess what? The upper end of the trading range has continued to move lower since the year began, since last July. And I think that's where we continue to be. These are real issues, and I'm as surprised as anybody that you've had this major move in the indexes, while yet you've had rates just power up every single day. And rates, I mean the 10-year. That'll eventually come to an end. We saw how that could end yesterday when Powell raised the specter of 50 basis point hike. Now, of course, the bulls are going to say, well, the market absorbed it. Right, the market absorbed it. Look how it is. But when it actually starts happening from the Fed, and when it actually starts slowing growth, which is the only reason to raise rates, then your market multiple is still overdone. Look, we're not getting back up to a 25 multiple or even hanging out at a 21 multiple with the rate cycle.
Understood, but the key thing you said is when the Fed starts slowing growth. We expect growth to slow. The Fed is going to slow growth.
They already are.
The bet is that it comes down to the binary thing. Either they crash it or they don't, right? Either they crash the economy or they don't. It either is a soft landing or it ain't.
The GDP-weighted interest rate around the world will be about 3 to 4% by the time everyone does what they're expected to do. You look at every central bank around the world. So if you weight that all by GDP, you're looking at like a global interest rate, overnight rate, that's like north of 3%. Obviously lower in Europe, obviously higher in Latin America, but just in general, that is going to slow growth. In fact, we've never had a commodity spike like this one that didn't result in a recession. Never. So maybe this will be the first one.
And Scott, one more point.
I don't think it will be.
But Scott, one more point. So the real growth, if you take what Josh is saying, and 3 to 4% growth in the economy, that's all driven by inflation. That's matching inflation. So you're really not growing much at all. If anything, you'll be in negative growth unless you really get inflation down. And that is, look, high inflation has toppled governments. Now, it's not going to happen in a democracy here. Maybe it will. Maybe that's why the Republicans will come in. Who knows? But the point is that you have to slow it masterfully. You're right, so that there's no recession. But you have the supply chain working against you, which has had minimum.
What's a reasonable valuation in your mind, Steve, for where stocks should be trading? And I ask you that because you do have some revisions to forecasts from people who are a little bit tilted negative, but by no means are these forecasts falling out of bed. Parker over at UBS goes from 242 to 235. 19 times that is 44.65, something like that. That's right where we are now.
Too high.
19 times is too high?
The multiple's too high.
Why is that too high?
The multiple of 19 times is too high.
It's lower than we were.
Because historically, it's sure, but 27 was too high also. Well, hey, the multiple got to 2,000 in the NASDAQ bubble on NASDAQ. We came down to 1,900. It was down 5%, but still too high. And it took 10 years to recover. Look, the multiple on the market historically should be, in my view, a fair multiple is 15 times. In a hyperinflation, and this is hyperinflation for this country, it's not 20% in developing markets, but for our economy, where we've not been able to get above 2% for a long, long time, 7-8% is hyperinflation.
Well, then you better wipe 1,000 points off the S&P. Then you better wipe 1,000 points.
Well, I'm not saying
the S&P.
No, because earnings are growing.
I don't think that's going to happen.
It's not that dire.
Yeah, I don't think
it's not that dire. Earnings are still growing.
Right.
Yeah, I know they're still growing. I just gave you the earnings
number. And buybacks will break a record. And buybacks will break a record this year too. So it's not that dire.
And there's still no alternative to equities. So people take money out of equities, they'll sell foolishly on the emotional downticks, and maybe that gets you down at some point another few hundred points on the S&P, which I don't think is unreasonable, by the way. That just be a 10% correction. I think we can go lower than that. I'm not saying we will,
Liz Young.
but that's the downside. And we should rest out around
sir.
16 to 17 times.
Get on in here.
So let's start with the 15 times statement. I know that that's a long-term average, and I understand why Steve is saying that. I don't necessarily disagree over the long term. I think in an environment where I don't think the Fed can raise rates above a certain level without breaking the economy before they have to cut again, you have to adjust that multiple. So it has to be a little bit higher, which is why I agree with Josh. It can't be that dire. It just can't be. If you look at why we've seen a rally recently, I think markets have started to worry more about inflation, and rightfully so, than anything else. Because if we didn't touch it, if the Fed wasn't hawkish, if we didn't worry about this, inflation would break us regardless. And it would break the consumer to a point that was hard to recover from if we went into a recession because of that. So I'd almost rather that the Fed is more hawkish, more aggressive, inverts the yield curve, just get it over with, right? Shake the tree, get it over with, and then let's move forward. Maybe it's a brief kind of painful recession. Maybe it's one that we don't even know about until after it's over, but then we come out of it at a much more comfortable level of prices.
So you think that the rally that we've seen from, a week ago, it's been pretty much a week-lasting rally, right? Last Monday was a terrible day, and then we've had a nice move up. You think doesn't sound like you think it's all that reliable.
I don't think it's reliable at this clip. No, I don't think we're going to go straight up from here till the end of the year. I think it's possible we end the year in low single digits in return, which would have to take us pretty far from here. But still, I don't think it's reliable in the sense of, okay, it's all over, there's nothing to worry about, everything's going to be fine. But I do think that getting up to the point where we had that first hike was really the worst part. And because we haven't had a recession, down 21% on the NASDAQ is a pretty good flush. So it makes sense that markets are going to pause from going further into bear territory here. But again, there's a lot of stuff that still has to happen. And we've got a lot of time between now and that next May Fed meeting. I think we're going to bounce around.
All right, well, let's bring in our halftime headliner. Mike Wilson is back. He's the Chief Investment Officer and the Chief U.S. Equity Strategist at Morgan Stanley. Welcome back.
Thanks, Scott.
You still negative?
Well,
I mean, it just has to be as simple as that, right? We've had this big rally. You've been on here saying that we're going to have a big pullback. Well, we had it, and now we're trying to put something together to the upside. Are you still negative?
Yeah, unfortunately, I mean, look, your panel described it for the most part. I mean, look, the risk setup is worse today than it was 3 months ago, just with the war itself, or just that alone. Okay, it doesn't even take into account the Fed moving faster now and the risk that has on the economy. I mean, these are real changes that are for the negative. And so you can't be more positive than you were in December. And we were negative then. And the price isn't that difference at the S&P level. Now, the good news, Scott, as we've talked about a million times on this show, okay, we're in a bear market. We've been in a bear market for a while. It started a long time ago. We've done a lot of good work at the stock level. And actually, last year, the average stock underperformed significantly the S&P. This year, it's probably going to be the opposite. Okay, so what you guys are talking about, picking off names that have already been hammered, that's the strategy now. Get away from the S&P 500. It's a trap. Okay, like thinking about the S&P is, that's not what investors do. Investors look at individual names, and that's what you need to be doing. Now, at the S&P level, we're absolutely more bearish today than we were a month ago because the price is adjusted. And we thought there'd be a rally to 4,500. We wrote about that. Here we are. It's a bear market rally. And look, the numbers you guys are throwing around, I would throw 16 times. That's the right number right now, given where rates are. Okay, the equity risk premium today is 280. That's the lowest equity risk premium that we've had since the GFC. Okay, that's the lowest number. Does that make sense to anybody? 280 equity risk premium. You're not getting paid to take equity-like risk at 280 basis points. No different than credit spreads, which have blown out here recently. So what's the right equity risk premium in this environment? We have a war going on. You have a Fed that's moving us to inversion quickly, and growth is not negative, but it's slowing. Okay, that setup says 400 basis points. That's 16 times. I don't think it's that complicated. The hard part is knowing when we're going to get to 16 times. Is it going to be next month? Is it going to be 2 months from now, 3 months from now? I don't know. But I'll tell you this, I'm not that interested in buying the index until we trade to 16 times.
Let's be clear. Your base case on the S&P is 4,400. So for all intents and purposes, we're there, right? I mean, so that's your base case. Your bull case is 5,000. So a better chance than not of being right around where we are in the ballpark, or perhaps better, 3,900 is your bear case. Now, I'll agree with you when you said the risk picture, and I wrote this down because I want to make sure I got it right. The risk picture is worse than it was 3 months ago. Can you not make the argument, though, that the risk picture is better than it was 3 weeks ago, right? Because more is known, right? We know now what path the Fed appears to be on. We've been able to absorb this higher move in interest rates. And I'll tell you what, I know you could cite some earnings revisions being negative, but earnings thus far ain't so bad. And maybe Nike tells you that yesterday, that maybe things are going to be all right when it comes down to earnings, and the market can handle a move higher in rates. So maybe the picture's better than it was 3 weeks ago, but not 3 months ago.
I don't think the picture's better than it was 3 weeks ago. We're closer to the sun now, right? We're closer to where the revisions are going to get more negative. And you're exactly right, though, Scott. The thing that's held this market up is earnings. Josh said the same thing. That's exactly correct. But the price is wrong, because growth is not going to be as fast as it was, obviously, the last 2 years, nor is it going to be as fast over the next probably 5 years, because you pull forward a bunch of demand. That's not the end of the world. We're not even calling for a recession. You don't need a recession for valuations to normalize. 16 times is a normal multiple, given where rates are and given the setup that we have in front of us from a risk standpoint. So I do not think the risk is better than fears, mainly because price is higher. How could it be better if price is higher and risk premium is down 40 basis points?
Yeah, but I want to argue with you on one thing here. You said you pulled forward all this demand. I mean, you might have pulled some demand forward, but demand is going to be off the charts this summer, albeit, unfortunately, at higher prices. But you can't find an airplane seat that's not, that's not full. You're not going to get hotel rooms. I mean, demand is going to be robust for a while. Why wouldn't it be?
Right, which is why we're not going to have a recession. There's going to be a share or a wallet share shift from goods to services, not nearly as accretive for the stock market, okay? The consumer discretionary sector is 85% goods, 15% services. The economy is only 30% goods, but 70% services. So it's good for the economy, not great for necessarily S&P 500 earnings. It's that simple. It's just the math. And look, the reality is I'm not that sure that we're going to have the 6th reopening that we've had at this point. Yeah, demand's going to be good, but those seats are already full, and the hotels are full. So where's the incremental capacity going to come from? We're already bumping up against that. I'm not so sure that demand isn't already robust. I mean, it's already robust for a lot of things.
Well, my headline here from you now is no recession. So as bad as you think it is, you think the Fed's going to be able to engineer a soft landing?
Well, define soft. I mean, if soft is
no recession. I mean, they're not going to crash the plane.
Well, it doesn't mean. I mean, let's talk about what we're trying to figure out in terms of the markets. Okay, a soft landing is that, yeah, the economy doesn't go into recession, but you can have a stock market that comes down severely, and there could be stress in the economy from that tightening. But yeah, why can't they engineer a softer landing than what people are saying? That could happen. Okay, but growth is going to slow either way. And something we've written about extensively, the risk of recession next year has gone up significantly. Okay, the risk of recession next year has gone up. And as Josh said, once that curve inverts, okay, the clock starts ticking, and usually within 12 months. So no recession this year. That's our call. Next year, we'll see. The market is going to start to figure that out. That's another reason why multiples are going to come down, right? This is the fire and ice. Fire, we already know. That's Captain Obvious now. Everybody knows it. Okay, the ice part is the part of the trade now where the multiples get ahead of the earnings revisions to the downside.
Well, we're going to see, right? There's no guarantee.
That's right. We're going to see. I'll be paying attention.
Oh, I know you will. We're going to be paying attention as well. I'll do this. Let's take a break. Can you stay over the break? I want the gang to get in on this. All right. We'll be back with Mike Wilson. We'll get the gang involved here. Financials, by the way, among the top gainers today. There's a bullish note out on that sector. We're going to debate whether you should be adding some of those stocks to your portfolio. It's in our call of the day. We're back in just 2 minutes.
Welcome back. I'm Rahel Solomon, and here is our CNBC News update at this hour. Some tough questioning from Republicans on day 2 of the Senate confirmation hearing for Supreme Court nominee Ketanji Brown Jackson. In response to suggestions that she's too liberal, she pledged to rule from a position of neutrality. Judge Jackson has also been criticized for representing some Guantanamo detainees as a public defender. Her response was, "We cannot let the terrorists win by changing the country's fundamental values."
And what that meant was that the people who were being accused by our government of having engaged in actions related to this under our constitutional scheme were entitled to representation.
One person in North Texas is dead after suspected tornadoes hit several areas in the state and also neighboring Oklahoma. This video shows the aftermath in Round Rock, that's near Austin. And as CEO Elon Musk was in Germany celebrating a new Tesla factory, the SEC told a court in New York that he should be bound by his 2018 agreement to get a company lawyer's okay for some of his tweets. And tonight on the news, an exclusive look at NATO training in Norway. Scott, you're now up to date. I'll send it back to you.
I appreciate that very much, Rahel Solomon. Thanks so much. All right, we're back with Morgan Stanley's Mike Wilson. Josh Brown has a question for you, Mr. Wilson.
Hey, Mike. So the record of soft landings engineered by the Fed is actually not great. So 1965, 1984, 1994. I think in all cases we had a great demography and we had a roaring economy, and the soft landing was really just about trying to prevent inflation. This is a very different situation. Inflation is here. It's worse than anyone on the board expected. It seems to be caused by things other than the economy, which is a little bit tougher for the Fed to address. Why do we think this this attempt at a soft landing will be successful where so many others failed and recession became the result?
Yeah, look, I mean, I'm not opposed to a recession potentially happening. Quite frankly, I would strongly suggest that we need a recession. Okay, we need to curtail demand. I've always said that we don't have a supply problem, we have a demand problem. The reason we have inflation is we overstimulated the economy and we created excess demand that led to, the surge in prices.
Well, we have both.
Well, okay, but we're producing way more stuff than we were pre-pandemic. Okay, it was a demand problem. We can debate that another time. The point is that if we got a recession, it would alleviate a lot of the inflationary problems. I don't think the Fed's going for a recession. Okay, let's put it that way. Will they be successful? I don't know. It doesn't matter to me, though, Josh, because at the end of the day, earnings are still going to slow and the price is wrong. So I don't even need to make a bet on a recession at this point to say that there's downside to the S&P 500 from 4,500. And that's sort of the point. I'm not trying to solve every puzzle out there. I'm trying to solve a puzzle that I can fix, and I know what that is that the price is wrong. So let's just get that right first, and then we can debate whether or not there's going to be a recession.
Pete, you got a question for Mike Wilson?
Yeah, Mike, thanks again for coming on. I know it's always difficult, but I will ask you this. So you talked about individual names.
You mean it's
I know
always
you
difficult?
Won't talk
Why is it always difficult? What are you talking about? It's always difficult.
He gets a hard time he gets a hard time for people. But Mike, very seriously, the individual names, like you mentioned that earlier when you first started. I'm curious. I know you can't go over the individual names, but what sectors? Is there a specific area of the market, maybe 1, 2, 3 sectors that you'd say, you know what? Our economy's this, we're going to see a lot of pressure to the downside, but this is an area that I think you can actually is investable. Is there a specific sector you'd point out?
There's several, Pete, and thanks for your comments. I mean, look, healthcare looks extremely attractive in both a valuation perspective, and that's an area where there's pent up demand. It's also defensive, which is in line with our general defensive posture. Okay, and look, I mean, unfortunately, this war is terrible, and we all want it to be over. But there are some structural changes that are going to result from it, even if it ended tomorrow. There's going to be more spending on probably energy services. There's going to be more spending on, defense and national security, and that would be software security as well. So those are new trends that are just emerging here right now, and really just the inflationary trends that we're going to see in materials. Right, we're taking off a lot of supply permanently, regardless of the outcome of this conflict.
Mike, we're going to leave it there. I hope this wasn't too excruciating for you. Know how
Always
difficult,
my pleasure.
know how difficult it can be sometimes to answer some real questions, but I hope it worked out for you.
Anytime, Scott, anytime. Great to see you.
All right, that's Mike Wilson, Morgan Stanley. We'll see you soon, I hope. I hope we'll come back now. It's tough. Bank of America is out with a bullish note on the financials, telling investors to stay overweight that sector despite the inversion of the yield curve. Financials are one of the top performing sectors today. Made it our call of the day. Liz Young, what do you think about the financials here? Okay, I like the note is interesting. Part of it is fairly counterintuitive. In the 1990s, the S&P 500 banks earnings were 80% correlated with the yield curve. Correlations dropped to 17% since 2000. And today, our banks team cites the short end as more important than the 90s. Historically, financials have outperformed 50% of the time during curve inversions like the one you're calling for.
Yeah, so 50% is not a good probability. That's like flipping a coin, right? So I don't know that I'd hang my hat on that. But usually financials are correlated with the long end of the curve. Recently, they've decoupled from that. That's because the entire curve moved up and there wasn't a steepening in the yield curve, so we've stayed quite flat. If the curve inverts, usually following an inversion is a pretty quick steepening. So financials would benefit from that. Also, let's move through the year. Think about the idea, first of all, that financials are not overbought here. So this isn't a place where I feel like the market is frothy. And if consumers start to run out of that excess savings, they're going to start to borrow because they still have demand, as we've all been talking about. They still have demand. They're going to start to borrow. They're going to have to borrow from the banks. And they're going to have to borrow in an environment where rates are higher. So I still like financials here. I think they're cash rich. I think that their balance sheets are much healthier than they were in previous recessions. And I think that they're an okay place to stay.
Pete, you bought more B of A calls.
I did, and I agree with everything that Ms. Young was just talking about. I think it's phenomenal that there's some opportunities that are still there, Scott. I think, I love J.P. Morgan. I know that the desk oftentimes loves J.P. Morgan, but they were way too overpriced at one point in time. They were trading 2 times book or more. So I think it's finally getting into the area now where it's a little bit closer to Bank of America. But Bank of America and Wells Fargo, I think you get a little bit more bang for your buck with those names, and you have been getting that. All you got to do is look at the charts. Year to date, I think Bank of America is up 12% over what's going on with J.P. Morgan. So I think there's just it's an issue where you got to be selecting the right banks. And I think there are many of these banks or financials, if you will, that are still in a great position to go higher. I think Liz is right. And I own Bank of America. I've got some Wells Fargo. I've got more bank exposure than probably I should. So I probably will start to trim at some point. But right now, I think that there's a bit of a slingshot effect right now with Bank of America to the upside. That's what the calls are telling me.
Quickly, Josh, J.P. Morgan really hasn't been the same since it reported earnings.
Yeah, I mean, look, this is a stock that tends to move in spurts, and it's really tough to time when the next one will be. I've seen it go up 30 points in the span of weeks. I've seen it go 9 months without going anywhere. So I think with J.P. Morgan, I've always said that I'm an investor. I own the stock significantly lower. The dividends automatically repurchase more shares of stock when they get paid. And from one quarter to the next, I'm really not going to change my mind on what I think the opportunity is. We're basically in a situation where I think with every passing year, we add trillions to the size of the U.S. economy. I think no matter what happens, what areas the economy grow, J.P. Morgan Chase will have an important role in that growth. I think they've done a really good job fending off competition from fintech firms. I think a lot of those fintech firms that we thought would supplant the traditional financial system probably run out of money in this cycle. So JPM is like a loading the animals onto the ark. When you put capital there, I think you could feel pretty good about it. You might be bored, but I don't think you become permanently impaired, really, no matter what happens.
Not bored this week, up nearly 8% for J.P. Morgan. Josh does find some opportunity in some new places, though. When we come back, we're going to talk about 2 of Josh's new buys next. All right. Josh Brown has 2 new buys, even though the music's playing. We're going, right? Oh, they're still playing the music. I just wanted to make sure. They're telling me wait for the music. Sometimes we like music in the background. Josh Brown, 2 ETFs. The IEO, Oil and Gas Exploration and Production, and the U.S. Aerospace and Defense ETF, the ITA. Take the IEO first.
So what both of these have in common, what both these have in common, though, is that they are tiny relative to the S&P 500. And my bet is over the next 3 years, they're going to grow significantly relative to the overall stock market. So the market could be up, could be down, but I think these 2 sectors are becoming way more important for our national security, for our supply chains, and they've been ignored, underinvested in, however you want to put it. So IEO is exploration and production. It's oil and gas companies. It's not gigantic integrated oil companies. It's really the companies that have the reserves and are producing it, and many of them will be acquisition targets. Many of them will find mega fans like what we've seen in recent days with Occidental Petroleum being accumulated, hoovered up, some might say, by Berkshire Hathaway. I think our supply of natural gas and oil are going to be seen almost as defense when you think about what's going on, what I talked about in the A block with Europe, the revanchism and revisionism of Putin and Xi. These are 2 men who would like us to be out of the Pacific, out of Europe, come back home, have no influence in the world. They want to refight World War II. They want to pretend 1989 never happened. This is going to be a very tough few years, especially with Biden at the helm, who doesn't seem particularly disposed to wanting to face this threat head on. And so I think IEO becomes a very strategic investment. The other one is even more on the nose. ITA is defense and aerospace. This has not even made a new high relative to pre-pandemic. Now, a lot of that has to do with idiosyncratic issues related to Boeing. Boeing's a big weight in this ETF. But when you think about the other companies in here, there's one thing we know for a fact. Even if we have a ceasefire or a truce in Eastern Europe tomorrow, we know for a fact that every one of the 30 free nations, most of which are in the West, every one of them is taking a serious look at their budget for defense spending. And in most cases, those budgets are going way higher. Germany wants to put it in the Constitution. So they weren't really listening when Trump was saying you need to spend more as part of your NATO requirement. Now they're going to spend even more than Trump would have wanted them to. And that's just the pendulum swinging all the way back the other way. Even if you think of the U.S., our military budget on the surface nominally is absurd. However, it is substantially lower as a percentage of GDP than where it was under Reagan. And I think that's going to reverse. We're going to be spending a lot more money. We almost have no choice. So I think ITA, IEO are defensive. I think they are secular bets over the next few years that will outperform the market. And I think they will balloon in market cap size as the big winners within those 2 sectors grow.
Let me take a quick break, come back. Pete reveals his unusual activity trades next. Let's do unusual, Pete. What do you see today?
Let's do it. Now, Scott, I usually don't like to focus on the ETFs. I'd rather get a little bit better beta out of the individual names. But that being said, we have Jets, and it's the ETF, obviously, of the airlines. It's really interesting to see. We see this paper occasionally in there. We'd rather see it in the individual names, but we got 21,000 of the September 25 calls being bought. Those are getting bought for about 85 cents. That's with the ETF trading at 20, a little over 20, about 20.30. So it's going to take a heck of a move, but it's also unusual because of the fact they went out to September. I got another one that's going out to September. This is an individual name. We never see this name. Paramount Global. So you're talking about media, entertainment, all of that. September 45 calls. That's where the stock was trading around 37 at the time. The September 45 calls, 10,000 of those were bought for a little over $2, Scott. So I'm in both these names. I like what we're seeing. I'd rather not be in the ETF. Oftentimes I'll go to a Delta or United or something else, but this time I've got Jets on. So we'll see what happens. We'll see if we get that kind of move. But we have been seeing the airlines seeing more and more option activity, and the bullish paper has been very, very correct so far.
All right, good stuff. We'll take a quick break. We'll come back. We got final trades ahead. Try and get a comment, too, about NVIDIA meets its investors in about 6 or 7 minutes from now. We'll give you that trade as well when we come back.
You following the Halftime Report podcast? What are you waiting for? Real debate and actionable advice from the investment committee, plus unusual activity and more. Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Hope you'll join me in overtime, 4 o'clock Eastern Time. Billionaire investor Carl Icahn joins me today. Looking very much forward to that conversation. I hope you will join me for that. NVIDIA meets its investors in about a minute. Josh Brown, quick take as you own the stock.
I mean, I feel like Jensen Huang is slowly becoming the new Steve Jobs. People flock to this event. They love to hear about some of the new technologies coming out. I'm one of them, so I will be paying attention via live stream.
LY, Liz Young, your final trade is what?
Cloud computing. It was pretty expensive for most of last year. This is a good entry point and a long-term theme.
Okay, thank you for that. Pete Najarian?
Love Apple, of course, but they're buying the April 1st 170 calls today. 21,000 of those, Scott. I'm in those as well.
What a rebound for that stock, right? Pushing 169.
Absolutely.
Amazing. Josh Brown, final trade.
Yes, sir.
Defense and aerospace ETF. Protect your neck.
All right. And Weiss, what you got?
The fundamentals on Porsche are far outpacing the stock price. I think it continues to move higher. Nice recovery from now. It's going a lot higher.
All right. Pretty nice move for the market today, too. As we said at the outset, the S&P is back above 4,500. You see it right there. The exchange is now. I'll see you in overtime.
Thank you very much, Scott. Hi, everybody. Ahead this hour, yields on the 10-year hitting their highest level in nearly 3 years. Goldman's Jan Hatzius now forecasting front-loaded rate hikes with half-point hikes at the next 2 meetings. This after Powell's hawkish inflation talk yesterday. We'll discuss the pros and cons of this new tightening timeline with a former Fed economist. And the great energy transition. Crane Shares launching an ETF filled with traditional energy names making the switch. But what about the oil and gas we need right now? We'll talk to the manager of that fund. Plus, a growing divide in the staples sector between pandemic winners and losers. Our analyst is here to name names. But first, let's start with today's market action. As Scott mentioned a moment ago, the S&P above 4,500. That's the level people are watching right now. It's around the December lows, 4,507 for a 1% gain. Almost that strong a gain for the Dow, which is up 264 today. The NASDAQ in the leadership role up 1.6% or 226 points. So a surprisingly strong rally given the move in rates and all that half-point hike talk. Now, the FANG names doing strong. That's one reason why the NASDAQ is doing well today. Meta up 2.5%, Alphabet up nearly 3%, and Nike, the big gainer and the Dow leader after a strong earnings beat. You can see here Nike shares adding about 3%. They're off their session highs, though, as the excitement has waned somewhat, but still what investors were looking for. And the financials moving higher today as those rates rise. Wells Fargo, Bank of America, JP Morgan, and Regions, your leaders. Wells up almost 4.5%. So speaking of rates, look at this move in the 10-year. Since Powell first started his hawkish pivot late last November, the 10-year at that time period was trading below 1.5%, 1.44 to be exact. And look at what a move we've had, especially in the last couple of weeks here. So almost 2.4% today. 239, the high watermark, 237 is where we are right now. Now, we spoke with Dave Zervos of Jefferies yesterday, who said the markets are loving the Fed's inflation-fighting credibility. But my next guest sees it the very opposite, saying the Fed's quote-unquote incredulous dot plot last week just eroded decades of credibility. Joining me now is Bill Lee. He's the chief economist at the Milken Institute. It's great to have you on, Bill, and you think the Fed, there's no way they can achieve what they are telling us they're going to achieve?
What I'm saying is that the markets don't believe they're going to achieve what they want to achieve. The dot plot and the projections they presented was just an amazing case of immaculate disinflation, right? Disinflation without rising unemployment or any kind of recession, any kind of slowdown. And that's what the markets are really not buying. That rate increase that you just pointed to, that's all nominal rate increases, all because the expected inflation rate has just burst out. For the 5-year break-even inflation rates are now 3.5%, way above where it was just a month ago. And that is a sign that despite the hawkish talk from Powell's press conference, they still don't believe that the Fed will be doing this. And I think one of the things that Jim Bullard has said was, we got to get to 3%. We got to get there faster the better. The faster the better. You know, I was writing about this today, and someone wrote back and said to me, why don't they just raise rates to 3% right now? Well, the markets would be very shocked because they didn't think the Fed would be able to do that. And also the Fed is counting, and amazingly, they're still counting on half the inflation disappearing because the supply conditions are going to get better toward the end of the year and into next year. And that we have some doubts about. I think markets have some doubt about because the war looks like it's extending the supply problems around the world, not just in the commodities, but also to the global supply chains and manufacturing.
But Bill, let's talk about what you mean when you say the markets aren't buying it. There's kind of two schools of thought here, or probably more than that. But one is the Fed is going to do all of this, and as a result, growth is going to slow, and that's why the 10-year yield is still lower than where the Fed appears to be taking the funds rate. The other is they won't be able to follow through on what they want to because the economy won't be strong enough. So what do you think exactly is the message from the markets here?
I think given the Fed's new framework, which emphasizes the importance of full employment, inclusive, and maximum employment. Having said that, the markets are asking, can the Fed pivot around to saying we need inclusive disinflation because the poor are hurt even more by inflation? And right now, because the 5-year break-evens are way above 3.5%, and even the 5-year, the second half of that 10-year window, those rates have gone up to 2.25% from where it was a rock solid 2% before. So whatever credibility the Fed had, it seems to have gone. And I think the fact that the projections are not showing any rise in unemployment kind of implies that the Fed has no intention of allowing unemployment to go up.
But it seems to me, how do you read it, that Chair Powell is pretty dang serious about being hawkish right now? I mean, he's telling us every which way, every time we turn around, that he's going to try to get ahead of this. He even said yesterday the Fed would tighten beyond the neutral rate if necessary.
Those caveats really make me wonder whether he's serious or not. Talk is cheap, but when we start to see people not finding jobs despite the huge number of vacancies, when people are saying, my God, the businesses are closing. And don't forget, consumption is already showing signs of slowing down. And the red hot sectors of the economy are really real estate and consumer durables. So the smart thing for the Fed to do is to really target the balance sheet, take away that excess liquidity that's feeding that overheated portions of the economy, and in some sense, save some of its rate increases for later. Now, I think to be credible, they now are in a position where they have to front load. They have to have a couple of 50 basis point increases just to show that they're serious. But after that, if we could use the balance sheet judiciously, I think we can save ourselves the problem of getting ourselves into the kind of recession that many people fear.
Yeah, you've talked about this many a time, how you'd like to see them drain the balance sheet more than do rate hikes. So just a final point here to make sure that people are on the same page. It's you just think as they go about this tightening, the economy is going to slow. I mean, do you think we're definitely going into a recession? It's not a problem if the economy slows, given that we're supposed to grow, if you look at Morgan Stanley's number, 4.3% year on year. That's almost double what potential growth is right now. We have plenty of room to slow without this meaning that we have huge job losses and a recession or anything like that.
Absolutely, Kelly. And most of that growth is coming from inventories. If you look at the latest GDP numbers, you strip away inventories, we have less than 2% growth with consumption investment. But the key thing is the Fed can get us into a slow landing by using all the tools and not just focusing on interest rates. And that's been the mantra from the Fed. Primary tool for policy is the interest rate, and we'll use the balance sheet and consider it like growing grass, something in the passive state. I think it's time to reverse course and say we need to slow down the hot sectors of the economy and allow the sectors that are slowing already to just not be affected by higher rates.
All right, Bill, great to have you on today. Thanks for your time.
Thanks for having me.
Bill Lee with the Milken Institute. Now, as the big question is whether we can achieve a so-called soft landing as the Fed embarks on what could be a pretty severe tightening cycle. The Nasdaq's down 11% since Powell's hawkish pivot last November, but my next guest isn't too worried, saying historically, stocks have held up pretty well to tightening. Joining me is Mark Smith. He's the Senior Vice President and Portfolio Manager at Wells Fargo Advisors. Mark, it's good to see you again, and tell me what gives you, some reassurance here.
Thanks for having me on, Kelly. What gives me reassurance is that in the last 40 years, there have been 6 major rate hikes that have happened. And almost every single one of those times, except for one, the market has been up, in some cases, double digits. So if you're just looking historically, the economy is able to maneuver rate hikes pretty well.
I see here there's only once in the last 40 years that hikes resulted in a down market. Was that the episode we hope we're not living through this time around?
Right. Tech was what did it last time with the tech bubble, right? And so we're hoping that tech, given some of their earnings and recent reports, even though we're seeing a downturn in some kind of 40% downside from the all-time highs in tech, we're hoping that some of this has been a little bit overdone, and so that won't be repeated. But yeah, that would be the last time was 2000 during the tech bubble.
Well, I would say that episode might give people, unless you're in those stocks, people more broadly some comfort because, you had markets overall, very different story. You had the economy in only a 6-month shallow recession, and that was with 9/11 and everything else going on. So, that would be a much more reassuring outcome, I think, than if we're talking about a repeat of the 1970s when stocks did pretty terribly.
Right, exactly. And so what I think that we need to look at is where is there opportunity right now that we know that these rate hikes are going to be happening. I think right now financials are a great place to be. They're one of the few sectors that when rates go up, they continue to make money and make more than they did when rates were lower. So you got to go in that. And then you're also seeing energy as a sector. Going back, all those different rate hikes also performed very, very well in all 6 of those different examples I gave earlier.
I'm thinking back to the Paul Volcker era of the early 1980s when we had a double-dip recession. The first one was sort of shallow, the recession. The second one, in response to more of his tightening, was pretty deep and pretty long-lasting. And that's the whole debate we were just having with Bill Lee just now, which is, can the Fed kind of keep inflation down without repeating that episode? And how telling do you think that double-dip recession is for what we might now have to go through?
Yeah, Powell has a very tricky performance he has to do over the next 2 years, and that is to possibly give 11 rate hikes without completely killing the economy. And so good luck to him on that task. I think it's going to be a difficult one because he's looking at really short-term data and making long-term strategic plays. So this is not going to be an easy thing for him. And I think that's what most investors are seeing, specifically my clients, is finding the reason to go aggressively in the equity markets, knowing that this has to happen. Inflation is at 40-year highs, and the Fed has to act. And by them acting, could they be actually slowing an economic recovery and possibly creating a recession? All that remains to be seen. And so Powell's going to write a really good book about all this at the end of it because we're all waiting to find out what's going to happen in the future.
So you mentioned financials. Yeah. Financials, you think, are one place people can feel comfortable, albeit unless maybe we have that slowing economy. But where else? Where else do you kind of look at the markets and say, people should feel comfortable putting money to work?
Well, one thing I've seen from all my clients specifically when I talk to them is our people are anxious to get out. And they've been a lot of times haven't done anything in 2 years. And many of my clients are going out and traveling internationally for the first time ever. So consumer discretionary, the hotels, the airlines, I think are going to be doing very well because there's a lot of pent up demand. So this is something that I'm seeing no matter who I talk to, no one's still home. So they're using all that cash that they have saved up over the last 2 years. In fact, more Americans have cash in their checkbooks now than they've ever had in American history. And what do they want to do? They don't want to spend it necessarily on items for their home. I think they did that already. I think the play is now getting out, experiencing things, and I'm thinking you're going to see that in all the consumer discretionary stocks in the next few quarters.
Well said. It's all over my Instagram. I'm not even going to check it next month during spring break. I don't want to know, where people are. The Caribbean, Florida, wherever they're going. Everyone have a great time. Mark, it's been great.
Yeah, I just try to keep a palm tree back in my office, make me feel a little better.
We'll put one on set here as well. Thank you, Mark. It's good to see you. Mark Smith with Wells Fargo Advisors. Coming up, a slew of new product announcements out of NVIDIA today as its Investor Day kicks off. The stock on pace for its 6th straight day of gains, up 27% since last week, but still down almost 20% from its October highs. We've got the trade on NVIDIA next. Plus, the Crane Shares Carbon ETF is on pace for its first negative quarter since inception. Now they're launching a new fund focused on decarbonization, but will it pay off for investors? And as we head to break, let's get a quick check on the markets. A pretty strong day across the board. 1% gains for the S&P, 1.7% for the NASDAQ, 237 on the 10-year. We'll be right back.
This is The Exchange on CNBC.
Welcome back to The Exchange. The world's fastest AI supercomputer, a CPU super chip. Those are just a couple of the announcements so far today from chip maker NVIDIA. Investors, for their part, excited about what the stock has been doing lately. While it's down 8% year to date, shares have surged 450% since their pandemic low. Christina Partsinevelos is at the NASDAQ with more for us. Christina?
Well, one state chip company, NVIDIA, has made clear artificial intelligence is very much part of its ethos. And this goes beyond just recognizing images and voices. It's about new silicon architecture called Hopper, robotics, and becoming, quote, intelligence manufacturers. NVIDIA has new models for video conferencing, for example, they just introduced. The Maxine platform can make it appear as if you are looking at the screen. So the real video that you're seeing is on your left right now. But this new platform can make your eyes look like you're actually looking at the people you're talking to, and it also translates languages in real time. The big reveal, though, was its latest graphic chip called the H100. NVIDIA says it will increase the computing speed of AI algorithms.
To put it in perspective, 20 H100s can sustain the equivalent of the entire world's internet traffic.
And that'll be produced by Taiwan Semiconductor and is expected to come to market in the third quarter of this year. The company also unveiled its new Grace Central Processing Unit superchip. So that would be a CPU superchip, which is pretty much two CPUs connected together. Think of it, the memory storage capability on an even smaller chip. And I mentioned chips, AI, and software, but the company also teased it was building a new AI supercomputer called EOS. It claims it'll be the world's fastest when deployed. NVIDIA is not the only firm doing this. You have companies like Microsoft, Meta, Tesla that have all announced their own versions of AI supercomputers. So a lot of news there. Hopefully not too technical for you guys, but the stock reacting on the news.
What was the thing about how it can make your eyes look like they're looking at the camera? This is huge for Zoom users.
Exactly, because the CEO did comment on remote learning. So let's say I'm looking at you right now. I see a prompter in front of me. Sometimes when you're at home, you're reading and looking down. Their technology can make my eyes look like I'm looking at you when it's really I'm looking down like that. And so that's just one example, which is why you had both sides of the screen as well as real time. So I could immediately change to Greek or French.
Great, and can we get, I mean, is this like 5 years off from now or like around the corner?
Well, there's different models of the Maxine. That's the product that you're talking about. For this particular one, it's not out just yet. I have to check to see if it's coming in the next, before the end of this year or 2023. So I can get back to you on that.
Well, either way, that will be a great development for society. Maybe too great. Anyway, Christina, thank you. We really appreciate it. Christina Partsinevelos. So is NVIDIA's stock a buy at these levels, or are there better plays in the sector? Let's bring in Steve Grasso. He's CEO of Grasso Global and a Cnbc contributor. All right, Steve, it's great to see you. And there's been a lot of back and forth with chips and what's going to happen post-pandemic after the inventory build. Where are your thoughts these days?
So the way I feel, though, Kelly, is you know, I've stated this. This has been my premise, where if you have a lack of a chip supply, the market starts to ramp up, and they want to make sure that they never get caught behind the eight ball again, so to speak. So they overorder, so they oversupply for the next issue that's going to take place. If they do that, we're going to have a supply glut. If you have a supply glut, chips are no different than any other commodity. They will trade off of that, and they will decrease in value. NVIDIA, though, is the premium name in the semiconductor space. So if you just look on a technical basis, the stock came from 323 down to 213. Mm-hmm. It's right at that 50% retracement mark right now.
Yeah, it's around 268.
That's where you want to make sure that, God.
And so to you, that's an important line for it to stay above. Like you said, this is the play that you like best in this space. You know, for all of some of what Christina outlined, they also made announcements that have to do with EVs and connected cars and a lot of different things. So even though they've been as volatile as you describe, would you recommend that investors stay there versus maybe worrying about the rest of the SMH? We've heard others recommend names that are more like Qualcomm and Broadcom as kind of the safer technology or chip plays right now.
All of those chips, all of the charts, if you look at all the charts, they all look very much the same in my book. There's maybe one or two standouts, but they're all in a declining trend line. NVIDIA is okay to put money to work as long as it holds that 268 level, and you could keep it really on a tight stop. We're right here. So if it breaks down, it's going to break down further. So hold the 268 level. I'd be a buyer there. They have NVIDIA Drive platform. And oh, Kelly, there was the metaverse, and now there's the Omniverse. It's a digital twin of reality now.
Okay, I can't.
This is one. No. This is one to watch. Connected home, connected car, connected life.
So 267 now and change on the stock. Seriously, how long do people wait for clarity on whether it's a bottom here, or what kind of time frame do you finally just say, look, you pull the trigger?
I would not be a buyer of NVIDIA unless it holds 268 for a number of days, and I mean that. Truthfully, I'd rather miss it and buy it at 275 than to be a buyer here and have it trade back down to 250.
Very interesting. Steve, thanks for joining us today. It's good to see you. Steve Grasso with the NVIDIA and really the chipmaker playbook. Still ahead, P&G on pace for its third straight month of losses for the first time in 2 years. One analyst is saying the stock is a post-pandemic buy right now. He'll make his case with P&G almost in correction from its highs. And speaking of post-pandemic, Robinhood has plunged more than 80% from its peak, but now it's rolling out a number of new offerings in an effort to get back on track. We'll take a look at their roadmap with the stock quietly on pace to snap a 6-month losing streak. And as we head to break, here's a look at the Dow 30 heat map with Boeing, Nike, and JP Morgan leading the way. We're back in a moment. Welcome back, everybody. We're just off session highs. That's when the Dow was up 313, and it's up 260 right now, with the NASDAQ leading the way, up 1.5%. In terms of sectors, the financials doing as well as you might expect with rates on the rise today. They're up 1.6%. Energy going the other way. It's down about 0.7 with oil lagging. Cloud and remote work names are also helping the NASDAQ 100 today. Datadog, DocuSign, Zoom, and Adobe. Datadog up almost 7%. Zoom and DocuSign were at 52-week lows earlier this month. And the housing stocks lagging again as rates surge, including Masco, Williams-Sonoma, and Home Depot. All of these are in the XHB, which we sort of call the Home Builders ETF, but there you go, a bunch of different housing components. And the builders have been struggling all month, with Pulte and Toll down about 6%. They're both on pace for their third straight month of losses and their worst quarter since the beginning of the pandemic. And let's end with a check on the China internet stocks. iQIYI, Bilibili, Pinduoduo, Baba, NetEase, all higher. Look at iQIYI up 26%, but again, it's about a $4 stock. Let's get to Rahel Solomon now for a CNBC News update. Rahel?
Hi, Kelly. Here's what's happening at this hour. It was a split verdict in the second trial over the Capitol Hill insurrection. Floyd Griffin, a county commissioner from New Mexico, was found guilty of illegally entering restricted areas, but he was acquitted of engaging in disorderly conduct during the riot. He's one of the few riot defendants who's not accused of entering the Capitol building or engaging in violent or destructive behavior. Ford, meantime, is recalling nearly 215,000 pickup trucks and SUVs to fix possible brake fluid leaks. The recall affects certain F-150s, Ford Expeditions, and Lincoln Navigators from the model years 2016 through 2018. This is Ford's third recall for the same issue. And in New York City, school and daycare mask mandates for the youngest children are set to go away. Mask wearing for kids ages 2 to 4 will become optional on April 4th. That's if COVID risk levels remain low. Now, at the same time, New York's mayor says he's not planning, at least yet, to make any changes to vaccine mandates for the city's professional sports teams. And on the news tonight, preparing for possible Russian cyber attacks in the U.S., how some companies are getting ready. That's tonight at 7 Eastern. Kelly?
Rahel, thank you very much. Rahel Solomon. Ahead, oil is lower today, but crude and Brent both up 47% year to date. But there's a new ETF to track the traditional energy companies making a move into renewables. Should investors jump into it? And could this actually put more pressure on oil and gas companies not to invest in higher production? We'll talk to one of the fund managers next. Welcome back to The Exchange. The war in Ukraine has roiled the global energy market, sending oil and gas prices soaring. Crane shares just launched a new ETF tracking companies in high-emission industries as they transition to greener energy. The Global Carbon Transition ETF, ticker KGHG, is up about 1.5% since it began trading last week, and its goal is to invest in future low-carbon leaders. That plan could be spoiled as oil producers are asked to do more to tamp down prices right now. Joining me now is Luke Oliver. He's managing director at Crane Shares. Luke, it's great to see you again. Before we delve into this, can I ask you about the carbon ETF that we've been following? I mean, this was an amazing performer last year. You might think that the carbon price would be higher than ever right now, but the opposite is going on. What's going on there? Can you explain that?
Absolutely. Thank you very much again, Kelly, for having us on. The carbon market's been fascinating. I think we saw a bit of a technical sell-off on sort of day two of the invasion that really roiled the markets. And I think the markets haven't quite come back, although they obviously recognize the technical nature of the sell-off, and we've seen that rebound. But it is reasonable. We've been doing a lot of work on this. Should we be a little higher than where we were or a little lower where we were in a pre-sell-off? And I think we're in a reasonable spot. I think we should see this possibly getting back to the sort of 90 EUAs, European carbon, getting back to the 80 sort of mark, 80 euro mark. But what's happening is that we've got these dueling movements. We've got the fact that we've got less natural gas flowing from Russia, which means more coal, more oil being burnt, which creates more emissions, which is why, as you rightly said, you could assume maybe we see higher carbon prices. But at the same time, higher energy could usher in potentially recessionary pressure that might actually reduce emissions in the net. So I think the net of this is slightly positive for carbon, but there's a lot of uncertainty. So
it's really interesting. It's almost like its own little yield curve where it's trying to predict future demand, and the bearishness there is offsetting the bullishness now. But yeah, I wonder also beneath the surface, we've seen policymakers in Europe specifically take capacity out of the market in order to drive up prices in recent years. Have they changed course at all? Because right now, obviously, if you want more coal and other things to kind of keep the lights on, it might help if people didn't have to pay up for emitting carbon.
Yeah, and so they haven't changed at all. In fact, what actually helped the market regain its confidence in the last couple of weeks is the fact that the Market Stability Reserve, which is buying supply, as you mentioned, the Fit for 55 program, which is the overall tightening of the market, which is increasing the decline in supply over time, all of those being reaffirmed. We're also seeing that in the California market, these programs being reaffirmed. And I think it's really important to notice that the price of energy isn't higher because of the price of carbon. In fact, it has very little impact at this stage. So reducing or taking, no pun intended, the foot off the gas on tightening the carbon market won't really change outcomes for energy prices, and will just put a hole in the efforts to, over the long term, fight climate change. So what I think is key to note is that energy security and just national security has become a much bigger priority in Europe. But it doesn't mean that just because climate and carbon prices have moved to priority 2, that they're not still, a very strong priority. And we've seen those markets, but the European Commission speak very clearly that they are not.
Is that, and everything you say is so important, and there's so many contradictory signals going on, because you have policymakers on the one hand upset that the industry isn't producing more. On the other hand, they're not, they're still charging a price for emitting carbon, basically, and they're not lowering that right now. Is it basically that it's so lucrative because of where prices are that producers can just absorb the carbon price and it's not that big a deal to them? Because I have to imagine it's a disincentive. That's the whole point of it existing.
It should be a disincentive. And going into this, now, we couldn't predict what happened in the Ukraine, but it's very clearly the point is to disrupt, is to increase costs on companies that continue to pollute and to not shift away to greener or more efficient ways of producing energy. So that hasn't changed. And although while we're in the thick of it, the urgency of what's happening between Russia, Ukraine, and Europe can't be dismissed. We must not get away from the objective of reducing emissions. We must decarbonize. So I think that stands. Europe still stands right behind it. We're seeing the market recovering. And I think, just as you say, there's the way we model it is we look at the declining supply over time, and then we adjust that demand curve. There's other things that could play in. Does Germany ration natural gas and maybe shut down certain industries for the short term, which might put bit of weakness into the market. We're seeing all of this being priced in. So I think it's great to see how efficient the carbon markets are, and that they are pricing in all of these factors.
It's fascinating. I totally agree with you. And it's a window that we didn't used to have into the specific dynamics of the energy market and the fossil fuel emitters, especially. So as we mentioned, you have a new ETF now. It's a basket of names that are traditional energy producers that you think are also kind of leading the charge on renewables. Give me an example of the component there. And this would be, it almost seems to me, the worst performers over time, because they have kind of mixed investment strategies and, you know, a cash cow over here, but someone, you know, an investment engine over there. Why do you think this is going to be a good product for investors?
Yeah. And maybe if you just to back up for 1 second on that, is that our overall vision here is that we must have decarbonization. 80% of the world's energy comes from fossil fuels. That's just not sustainable. It's not going to work. We must get away from that. So to do that, we see being long the price of carbon is the pure play and almost the antithesis of polluting. You need to be long the right companies. That's not necessarily the clean companies. It's these companies. And I'll get to that in just a second. And we also want to be long the resources that are going to be needed to feed that machine that is going to allow us to electrify, to get scalable green hydrogen. It could involve nuclear, but we need to get away from burning fossil fuels. So a great example of a company is Fortescue. It's an Australian iron ore mine. So investors have looked at that and said that's a company that is dirty. That's a company that is a legacy industry that maybe doesn't have a future. And it's a value stock. It's not very exciting. It's unloved. It's been starved of investment. What's happening is that these companies that we look at are companies that actually have these incredible adjacencies. So what's Fortescue good at? It's good at huge scale infrastructure projects, which is what mining is. And they're great at finding an off-ramp for their product, whether it be iron ore or something else. Now, that's something else. For a company that is in the desert in Australia, they also have a lot of wind and they have a lot of sun. And so they are shifting in a big way towards green energy, renewable energy, to create green hydrogen. So when people value this like an old industrial stock, what they're missing potentially is that this is going to evolve into one of the leaders of green hydrogen and therefore green energy for the future. So we think there are a lot of companies that are undervalued. Their true growth potential isn't being captured. And that creates opportunity. And that's
great point. And we've seen that it's a little bit like Ford and GM trying to kind of cultivate, you know, the industries of the future within the companies of today. Ørsted is another name in here. You've got names like Lind as well. So a bunch of holdings that don't usually, as you say, you know, they're not usually right on the tip of people's tongues. But these days, what people are looking for is very different. Luke, it's great to have you. Thanks so much for your time today.
Thank you very much.
Luke Oliver joining us from Crane Shares. Up next, check out this mystery chart. It's down about 8% so far this year, but up 50% in the last 2 years. We've got the name and why one analyst says changing consumer behavior post-pandemic will be the secret to its success. Speaking of trading, Robinhood is getting into the savings business. We've got its new offerings and whether they can help grow the user base as that retail trading boom wears off. Back in a moment. Welcome back, everybody. Take a quick look at shares of BuzzFeed. The stock opened lower, but has now gone positive after a report from Cnbc.com. It's fluctuating, I should say. Sources telling CNBC's Alex Sherman that several large shareholders are urging CEO Jonah Peretti to shut down the company's news organization. The news division has about 100 employees, and it still loses about $10 million a year, according to the sources. One shareholder told CNBC shutting down the newsroom could add up to $300 million of market cap to the struggling stock. It's under $5 a share right now. For more details, you can head over to cnbc.com. Meantime, when you think of pandemic darlings, you probably think of the Zooms and Pelotons of the world, but they exist in the consumer staples sector too. One analyst actually sees a growing divide between names in the space that have a solid business and those that need a pandemic environment to outperform. Joining me now is Bill Chappell. He's a managing director at Truist Securities. And Bill, you've identified this gap. Who are some of the winners and the losers here?
Well, what we talked about today, good morning and good afternoon, and thanks for having me, was Procter & Gamble in particular. But the point is, over the past 2 years, everybody was lifted by people spending time at home, around the house, work from home, be it not just household product companies, but food companies that were fairly mediocre for 5 to 10 years prior. And you saw ketchup sales up 40% for the first 3 months of the pandemic. So everybody got that lift, and it made it next to impossible to figure out who the winners and the losers were during the past 2 years. And what we're saying today is now, as we're getting to the new normal, whatever that might be, the trends are visible. You can see who's outperformed, see who really is coming out of the pandemic stronger, whereas every company says they're coming out of the pandemic stronger. There are a few, like Procter & Gamble, that truly are. They were stronger going into it. They were beating and raising. They were streamlining their business. And now coming out of it, we think you can see a separation from other consumer staple stocks as people can get a real stripes that they have.
Your price target is 175. It's trading around 150 right now. What is it that is setting them apart?
It's for P&G in particular, it's the long journey they've done probably 7-8 years ago when they started. They got rid of 100 underperforming brands, including a big part of their beauty business. They reorganized the whole operation. But the biggest thing that we love about it is they focused on product superiority, where they had a mantra where 70% plus of their products had to be superior than the next competitive set. Think of something like Tide Pods, that much better than not only other pods, but also liquid. And having that technical superiority is what's gotten consumers to not just buy the brand, but buy the enhanced product. And that's part of what our thesis today is. As inflation hits all these companies and they're raising prices, we don't think consumers are going to be willing to give up their pods or give up their enhanced razors or give up their enhanced paper towels. You name it, of what they've done to enhance it just because prices have gone up. And so I think not only can they separate just because of their back end, but also they can weather inflation a lot better than they did in the past.
Well, it's a very interesting point. It certainly speaks to experience in our household. Let's kind of close back to talking about Keurig Dr. Pepper. This is a bit of a different story. You have a hold on it. Tell me what the thought process is there.
I wish I had a complex thesis, but it's fairly simple. You, me, we all worked from home for the past 2 years. And they saw a nice surge of people buying Keurig machines because we were drinking more coffee at home. And now as we go back to work, we're going to drink less at home or less K-Cups. And it's not that that's bad for their business. They just had a 2-year acceleration of Keurig makers in household penetration, of attachment rates, meaning the number of pods you drank per home per day. And that's going to go down and probably worse than I think some of the street is looking for. And Keurig has always been viewed as Keurig and Dr. Pepper. When everything is going well, it's viewed as a beverage company, Dr. Pepper, and gets a higher multiple. When things in the coffee business aren't going so well, it's viewed as a hybrid beverage and appliance company. And that's our concern as we go back to that hybrid valuation you see multiple contraction, and it's not quite as exciting as it has been as the past 2 years.
It's fascinating. I love that pod attachment rate is something that you have to know on such a granular level. Not that you cover them, but it makes me think, all right, then it's bullish for the coffee chains. You know, if you're Starbucks, if you're Dunkin', obviously if you're all the specialties, and you're right that people are on the go more, they would seem to benefit. Do you think the category overall, so consumer staples overall, is at further risk of compression? In other words, is P&G well positioned in what's going to be a shrinking market, or is it not quite that severe?
It's not that severe. I just think it's, from an investment standpoint, it's become a stock picker's game again. It's not, you know, for the past 2 years, it was just very, very tough to tell who was good and who was bad. Now it's from an operational standpoint, from a market share standpoint, from an advertising effectiveness standpoint, you can pick the winners and losers. And no, I mean, we're still going to be spending more time at home than we did in 2019. So the whole category still will have a new higher base.
Yeah.
But with ones that can outperform, will be a little bit easier to pick.
That's great insight. Bill, thanks so much for joining us today.
Thank you.
Bill Chappell with Truist. Still ahead, we've had a lot of unprecedented times lately. The muni market isn't immune. We'll talk about how moves in the yield curve are causing volatility there. And a quick programming note, activist investor Carl Icahn will join Scott Wapner on Closing Bell Overtime at 4 p.m. Eastern today. They'll talk McDonald's, Oxy, and so much more. Don't miss it. As the idea of a potential half-point hike at the next Fed meeting picks up steam, investors have been caught a little flat-footed by the flattening yield curve, and that's spreading to the municipal bond market as well. My next guest says, quote, modern monetary uncertainty is fueling volatility there. Joining me now is Michael Zezas. He's U.S. public policy strategist at Morgan Stanley. Michael, it's good to have you, and walk me through the recent moves that you've been experiencing there.
Yeah, well, listen, I think the journey the muni market's been on this year was it started the year quite rich,
probably underappreciating the challenges that the Fed had in front of it to deal with inflation, the really complicated path it was going to have to follow. In fact, the fact that the Fed was really going to have to own the option to change its mind quite a bit. If the Fed owns its option to change its mind, that means bond market volatility because the bond market is short that option. And when you have elevated volatility in bond markets, that interrupts the demand channels for the muni market. You see mutual fund outflows, and the muni market's corrected quite a bit as a consequence. Now, none of that tells you that credit quality is poor, but it does tell you that we've got some technical challenges in the market. So I think the conundrum for the investor now is that you are probably being fairly compensated for credit risk, which is pretty stable. But as the Fed continues down this path, risks are probably skewed to risk premium staying higher and maybe even elevating a bit.
Why is it that the curve, more so than just the outright levels of yields, are a headwind for munis?
Well, I think for us, the curve is a representation of the Fed's challenge, as opposed to the Fed, the inverted curve, and inversion of the curve itself being a challenge. So we went back and studied prior inversion periods, the last 5 to be specific. You didn't really see a difference in muni risk premia yields relative to treasuries before or after. But the inversion itself speaks to what the Fed is trying to do, which is to challenge an inflation dynamic, which is uncertain in its cause, and it's trying to stay out ahead of inflation taking hold in the mentality of the U.S. economy. And curve inversion makes sense in that environment, but that uncertainty in and of itself drives yield volatility in the treasury market, as we've seen. That volatility is what interrupts the demand channel. It tends to make individual investors be duration shy, and that's why you see mutual fund outflows.
And we've been showing our kind of new favorite, or our other favorite yield curve, the 10-year versus 3-month, which is obviously sending a much more bullish signal. In fact, we're seeing a pretty wide spread. So if that curve is right and everything's going to be fine, or at least a lot less scary than what the others are showing, or if you're an investor in this for the long run, maybe you like the opportunities this presents, where would you be in munis? I see airports, higher ed. What's your advice to investors?
Yeah, certainly the sectors that we think give you a little extra premium, and you're being fairly compensated for risk, airports and higher education, for example. And again, I think the thing to keep in mind here is that, yes, while this conundrum creates volatility in the short term, you're being fairly compensated today if you're putting money to work. So those are the 2 sectors that we like. And frankly, because the curve is inverting, we don't think that investors should be shying away from longer maturities either. If you're constructing a portfolio, I think you want to balance out those longer maturities with some shorter maturities. But the typical muni investor sometimes is duration shy. We think that's the wrong impulse right now.
Can you explain that just a little bit further?
Yeah, well, so if a typical muni investor, they're looking for munis to be kind of sleep at night money. Owning too much duration can feel quite risky. But if the purpose of owning that muni bond in your portfolio is to dampen overall volatility, you want some duration that improves your risk-adjusted returns. And if you think the yield curve is going to invert because, in our view, 2s are going to out-yield 10s in the treasury curve, it means longer maturities are not just giving you more carry, they're going to give you less price volatility.
Very interesting. Michael, thanks for delving into all of this and also giving people some places to look for opportunity. We appreciate it.
Thanks very much.
Michael Zezas joining us from Morgan Stanley. All right, up next, shares of Robinhood are higher today as they announce 2 new products in an effort to attract users. This was once a $47 billion market cap. As you can see all the way to your right there, it's less than a $12 billion company today. We're going to look at their shift from trading disruptor to retirement account brokerage and whether that will pay off. The exchange is back in a moment. Welcome back, everybody. Been a tough year for Robinhood, down 24% since January. And the company is now making some moves beyond retail trading, launching 2 new products today, a cash card and savings accounts. Stocks up about 3% on the news. Kate Rooney has the details. Kate?
Hey, Kelly. Yeah, this is the latest sign that Robinhood is embracing some of the less exciting parts of the finance world as the meme stock and retail boom fades. The new cash card and savings accounts you mentioned lets users invest spare change, as they're calling it, from transactions into stocks or crypto. For example, say something costs $5.75. Robinhood will auto-invest the remaining 25 cents. It's also offering direct deposit and early access to paychecks. I spoke to Robinhood's Chief Product Officer about this, Aparna Shennapragada. She says it's a way to drive user growth, expand the definition of investing, and that some of these smaller investments cater to what she calls the crypto curious, those who might not be ready to go all in on that asset class.
Another idea that we are kind of pushing on, what we call this is like embedded crypto. This idea of like crypto comes with the product. Same thing with the spending account. You can split your paycheck. You can say, hey, some part of it goes into crypto so that you're not feeling like you got to go all in on this emerging ecosystem.
The product suite puts Robinhood in direct competition with the likes of Chime, Acorns, and Stash, as well as some of the publicly traded names, PayPal, Block, and SoFi. Those high-growth stocks, though, really getting hit this year. Robinhood, in particular, is down more than 80% from its all-time high. Kelly.
And it's such a tell on the different environment. I mean, nothing tells you the meme trading boom is over like Robinhood launching, a savings account. But how much is this costing them, Kate? Because, getting people into crypto, especially a few pennies at a time, doesn't come cheap.
Right. It could be what they call a loss leader, meaning that they're making interchange on this. So it's not looking like a huge revenue driver. It's one of those things that the tech companies really are known for. But you launch a product hoping that it brings new users in, and then you can eventually monetize those users and hope that if they're depositing their paycheck or if they're spending with a Robinhood card, that eventually they'll do some of the higher yielding transactions, maybe trade stocks or options in some cases. So it's really about that single money app that a lot of the fintechs have talked about. You got PayPal really going for the same thing. They're all converging to look a lot more like banks. And we didn't even mention the retirement accounts, but they're launching 401ks too. So definitely a sign that the trading boom, they have to supplement that. They're not always going to be able to rely on retail traders.
It's over. Kate, thank you so much. We appreciate it. Our Kate Rooney. That does it for the exchange, everybody. Power Lunch starts now.
Thank you, Kelly, and welcome everybody to Power Lunch. I'm Tyler Matheson. Here's what's ahead. The odds of a 50, the probability of the Fed hiking rates by 0.5% in May is climbing. Some also see another 50 in June. It's higher than 50-50 right now, according to the odds makers. So how can you protect your investments from an aggressive Fed? Our market pro will share his strategy. And the mortgage market in mayhem. The rate for 30-year fixed loans spiking, adding additional stress to the housing market at a critical, Kelly, time of the year.
And let's check on the market, Tyler. Amid all of these headlines, it's holding up pretty well. The Dow's up 279. We're about 40 points off session high. The S&P's up 50. The Nasdaq leading the way, up 262. That's a 1.9% gain. Dow was up as much as 314 earlier on. Now it's all about rates today. And that's what makes this so extraordinary. The Nasdaq is the outperformer as the yield on the 10-year reaches as high as 2.39%. Its highest level since May of 2019. We're just below that right now. 2-year, 10-year spread everyone's watching. It's one of the yield curves to follow anyway. It's down to 21 basis points, Ty.
All right, thank you, Kelly. Wall Street reassessing its rate expectations. Economists at Goldman Sachs now say they expect a 0.5 percentage point increase at the Fed's May and June meetings. UBS says the odds of a 50 basis points, another fancy way of calling a 0.5 point, are rising. All of this follows the more hawkish comments yesterday from Fed Chair Jerome Powell. And Steve Leisman now has more on what the market is pricing in, Steve.
Yeah, hey, Tyler, markets today adjusting to yet another new round of fresh hawkish talk from the Fed, this time from that speech yesterday from Fed Chair Jay Powell, who put the market on notice for a possible 50 coming at the May meeting and raising rates above neutral, possibly to slow the economy. The market heard the Fed loud and clear, the chair now more definitively than they did at his press conference last week. Before the meeting, the probability of that 50 basis point hike in May was just under 10%. After the meeting, settled back down to 36. Now it trades at 72%. So 50 now is the likely choice now for the Fed at the next meeting for the markets. Goldman Sachs, in that note that Tyler told you about, the call for 250 basis points hikes, also forecasts that the Fed would raise the funds rate to 3.25% by the end of 2023. That's a bit above where the market is priced. I'll show you where the market is priced here. Futures market sees 150 by August, 216 by year end, which, by the way, shows that an 8th rate hike is now priced in or assumed. The funds rate is priced at 280 by the end of 2023. That's the market price, and you can see that Goldman's above that. Whatever reason Powell felt to raise the ante on the Fed outlook, it's had the effect of pulling forward future tightening into today's economy right now. And that may be, Tyler, exactly why he did it.
Tell us a little bit about this curious phenomenon called the yield curve and why people are so concerned that the difference between shorter term interest rates, whether it's a T-bill or a 2-year note versus a 10-year note, that difference narrows. Why is that concerning, and what does it say that bond investors are expecting?
Well, it's a bit of a curious phenomenon that when it does invert, it tends to lead to recession. It's a little unclear and debated as to whether or not the inversion itself either helps cause the recession or is just a sign of a belief in recession. What it does tell you, among other things, and there are many different people who look at these same aspects and have different ideas, but it certainly tells you that down the road, markets think the Fed will be going the other way, possibly reducing rates. And if it inverts, the short end is above the long end, it tells you that the Fed's going to hike and it's going to slow the economy. And the market believes that it's going to go too far and potentially plunge the economy into recession. That's one possible interpretation of that, Tyler.
All right, Steve, thanks very much. Steve Leisman.
Now, all of this is playing out in the bond market as the yield curve flattens. Take a look at the move in the 10-year. On November 30th of last year, the Powell pivot, when it really kind of began in the hawkish language and the transition started, the 10-year was at 144. Today, it's almost a full point higher, up around 2.39%. Rick Santelli has more on what the bond market is signaling, Rick.
Yes, and I'll tell you what, let's keep that date isolated, the 30th of November. And this is a biggie. And remember, it gave you two chances. Not only as you look at this chart going back to the 30th, towards December, we actually traded down to 34 basis points, 134, an extra 10 to flush everybody out. But consider, so we're up over 90 basis points, 94 basis points to be exact, from that 144. Look at Boons. They were at minus 35 on the 30th. They're now at 50. That's 85 basis points. You look at gilts in the UK 10-year. They were at 80 basis points. They're at 170 today. That's 90 basis points. But the winner, and the central bank like Japan, it isn't necessarily where it needs to be, Australia. Look at the Aussie 10-year. It's at 277 now. It was at 169 on the 30th of November. We'll call that 108 basis points of movement. And on yield curves, boy, it's all about art more than science to some, because if you look at the 3-month versus 2-year, that's the widest it's been in 20 years, over 160. But 10s to 2s are a 2-year flat, and 3 months to 10-year, the original yield curve that dictated the research on recessions, that's at a 5-year steep. So what gives? There's lots of distortions, but in the end, I think the Fed is so far behind that the coupon curve, like a 2-year, is pricing everything in, but T-bills get auctioned every month, and they keep up with where market rates are now. Tyler, back to you.
Well, that's sort of my question. That was really what, and you wrote a memo about this earlier today, and I really thought it was really so smart. I don't understand why, if you look at the yield curve one way, it would be flattening severely. And if you look at it the other way, it would be as steep as it's been for a long, long time. Why? It just doesn't make a lot of sense.
No, and we saw 3 months to 10 years invert in 2019. Remember, everybody got so nervous, and it inverted in quite a large fashion. But there's distortions everywhere you look. Another distortion, of course, is that 10-year and the longer dated maturities have quantitative eased rates lower than they should be, which would make the normal 10s to 2s maybe look a little steeper. But in the end, 3-month bills eventually are going to catch up, which is why I think that the Fed being behind the curve has aided that distortion.
All right, Rick Santelli, thank you very much. The professor educating me. All right, so how will all this play out when it involves your investments? Our next guest says the flattening yield curve is leading to concerns about future growth. Joining us with his investment strategy is Greg DiMarzio, Vice President and Portfolio Manager with Rockland Trust. We've talked a lot about, maybe we've talked enough about the flattening yield curve, Greg, for right now. But what does it say for me and my investments and my portfolio? What should I lean away from? What should I lean toward?
I think that's a great question. When you look at it, I think what it's saying is that risk is rising in the equity markets. We are getting an inconsistent message right now from the bond market to the equity markets. I think you'd be hard pressed to come up with a thesis as to why these higher bond prices should lead to higher equity prices. In the past, we talk about having no alternatives on the bond side, the TINA statement. And now bonds are very much a reasonable option with higher yields if you assume that inflation is going to be calmed down. But I think the clear message is that risk is rising for your equity portfolio.
And so if risk is rising for my equity portfolio, what do I want to lighten up on? I'm sure you're not a market timer. Almost nobody who makes money in this business is. But where would you be putting fresh money to protect against what you see in the equity, the threats you see in the equity market?
Sure. I think you want to pivot off what the current situation is offering you as an opportunity. And when I look at it, the things that are rebounding now are consumer centric. Some of the early worries in the year that were the consumer stocks were going to get hurt as rates rose. I think you're seeing a lot of consumer stocks today kind of rallying back. And I think over the next 3 or 4 months, there's a lot of headwinds that the consumer faces, whether it's on the lower end and it's student debt, starting to be repaid back again, whether it's higher mortgage rates and what's that going to do to borrowing and things like home equity. So I think when we look at making new money investments, we're looking for non-economically sensitive names and non-economically sensitive sectors.
Well, that might help explain why a name like Chubb, which we don't often hear from stock pickers, why that one pops up, BlackRock, United Health Group. Is that the kind of common thread there?
Yeah, I think the common thread, if you look at it, is obviously within financials, banks have done tremendously well on the prospect of higher rates. At some point, that will lose steam. And when banks lose steam and people are worried about the economy, insurance stocks tend to do very well. If you look at a name like UNH, while labor is an issue, it's not a consumer-centric name. Healthcare is not as economically sensitive as other areas of the economy. And last but not least, you never want to not be taking offensive opportunities. BlackRock is a phenomenal company, a stock that people like for the long term. It's already down a lot with the market being down. So on pullbacks, it's a great long-term investment.
So you would, if I infer from what you're saying that you would lean away from consumer discretionary stocks.
I think that's a fair assessment. As we look out over the next 3 to 5 months, the U.S. consumer has a lot of headwinds. As I mentioned, mortgage rates going higher. I'm not sure you're looking at food and energy prices squeezing them. So I think that's a fair assessment that anytime you're at risk of a recession, and as you said, we've talked a lot about the yield curve, but the yield curve is starting to signal a higher risk of recession. Anytime you enter a recession, the consumer is 70% of our economy. It is something to be a little careful with.
Let me close with one quick thought on bonds. You said that now bonds are actually giving stocks a little bit of serious competition. If I want to, is this now not a good time to put money into bonds or bond funds because rates are likely to rise and eat away at the principal value of my shares? Or what should I do there?
I think bonds are starting to become a very attractive investment. At these levels for fresh money, I think your prior guest, it was Rick who noted that a year ago, or maybe just even back in November, the 10-year Treasury yield was really yielding in line with the S&P 500. Now that yield on the on the 10-year Treasury is probably 70 to 80 basis points higher than the yield on the S&P 500. So at some spread there, it makes it more advantageous to put more new money into bonds versus stocks, and maybe we see the end of the rates going higher.
All right, Greg DiMarzio, thank you very much. We appreciate it.
Thank you.
And coming up, President Biden issuing an imminent warning for corporate America, saying prepare for Russian cyber attacks. So what's at risk? The grid? The financial community? We'll ask an expert what he's most worried about. Plus, record diesel prices hitting the trucking industry. And with more than 70% of freight transported that way, the impact could be felt across the economy. We'll have the latest. And as we head to break, take a look at shares of GameStop. They are up. I spoke too soon. You know, I told Kate Rooney the meme trading, the boom, it's over. Maybe not.
No, look at that, man.
30% jump today with more than 100% of its average 30-day volume.
All right.
Back in a moment.
All right, welcome back to Power Lunch, everybody. Shares of Okta off its lows of the day after the identity management firm said it found no evidence of ongoing malicious activity. This follows claims by a hacking group that they had breached the company's internal systems. Now, cybersecurity stocks all rising sharply over the past week. There you see several of them up markedly, except for Okta, on the risk of a potential attack from Russian hackers. Okta, Palo Alto, up more than 12% on Okta over the past week, 10% for Palo Alto, 15% for CrowdStrike or thereabouts. Kelly.
Yeah, the White House issuing a dire warning about the escalating threat of cyber war with Russia. In a press briefing, Echoing President Biden's comments, Deputy National Security Advisor Ann Neuberger was saying, quote, "We've previously warned about the potential for Russia to conduct cyber attacks against the United States. We are reiterating those warnings, and we're doing so based on an evolving threat intelligence that Russia's government is exploring options for potential cyber attacks on critical infrastructure in the U.S." Pretty stark words there. So who's most vulnerable and how should the country prepare? Joining us now is Chris Ruland. He is the CEO of Phosphorus Cybersecurity, former CTO of IBM, and he's been advising the U.S. government for decades on cyber war. Chris, what do you think the biggest threat is here?
Well, our systems are probably largely compromised at this point, and the industry will say the people who don't know they've been hacked are the ones who are hacked. And when it comes to critical infrastructure, services like financial services are really well prepared, as is the energy sector. But other things, for instance, Okta is part of critical infrastructure. So are cloud services, and they are critical parts of the supply chain today. So we're going to see vulnerabilities in critical infrastructure tested. Other organizations like UPS and FedEx are also part of critical infrastructure. As to the most vulnerable, I would look at who the most common victims of ransomware are, and that's unfortunately healthcare is very commonly attacked and exploited.
It's one thing when there are groups of, hackers and pirates that are just targeting corporate America to make a quick buck. It's another when this is basically cyber warfare. Is there a higher responsibility for the U.S. government to do something here, or would it not even be effective if they tried to get more involved, either financially, in terms of resources? How is this best handled?
Oh, well, so Ann Neuberger ran the cybersecurity director for the NSA. So she is the #1 authority in this country on the Russian cybersecurity threat. And the NSA, the existence of the NSA is to defeat a threat like this and launch countermeasures in the event they attack us. And the NSA is like the Navy SEALs of cyberspace.
And so they are a potent adversary. And at what point of cyber warfare do you think the U.S. government retaliates? And how would that and would we even know about the retaliation? What form would it take?
Well, there's a concept of intel gain loss. What do you want to use because your adversary will see it? And we may be coming up on a point where we're going to see some new technology that we didn't know existed take place if we have a hot cyber war. So I absolutely know that the NSA is far better at offensive cyber than the Russians are. And we should be a serious deterrent. And I really think the NSA could put the Russians back to the 19th century.
You mentioned healthcare as one of the more vulnerable areas, in part because they have been the ones who have been hit with ransomware. Two questions here. Could the Russians get involved in a kind of ransomware without asking for ransom? In other words, where we're just going to do the damage and we don't care about the money. That's number one. Number two, what's the vulnerability of the transportation system, by which I mean air traffic control, trains, planes, automobiles, et cetera?
Well, on the transportation side, I think the biggest vulnerability is GPS, the dependence on GPS, everything from our cars to Uber, et cetera. And while the Department of Defense is geared up to operate in what we call a GPS-denied environment in a world where there is no GPS, the commercial sector is probably not. So that'd be the #1 risk, I think, transportation. When it comes to healthcare is a very tough environment to lock down and secure. There are a lot of machines and things and computers that work together, and they've been easy targets for any kind of cyber attackers looking to make a quick buck. But you're absolutely right. I would probably change the playbook and not pay any Russian ransomware because I doubt you're going to get the password. I think another concern would be understanding cyber insurance policies, because insurance policies don't always pay out in an act of war.
Real quickly, Chris, but if they aren't to pay out the ransom, that's the only way people have usually been able to recover from these attacks. So what are they supposed to do then?
Well, in the White House guidance this morning, they recommended backups and encryption. There may be capabilities that the U.S. government has to crack encryption that we don't know about.
Well, that would be nice. and necessary
It would be.
to national security. Chris, we appreciate your time today. Thank you so much.
Thank you, Kelly.
Chris Ruland. All right, shares of Tesla soaring more than 26% just since last Tuesday as high gasoline prices have increased interest in EVs. That increased demand comes at just the right time. Tesla opening its Giga Berlin factory. We're back in a moment. Welcome back to Power Lunch, everybody. A big milestone for Tesla. The company today starting deliveries from its Gigafactory in Berlin, which could help them keep up with surging demand. Phil LeBeau has the details. Phil?
Hey, Kelly, you know what I've got for you? I've got video of Elon Musk dancing. Who doesn't like some good Elon Musk dance video? This is him on the assembly line at the Giga Berlin. Yeah, that's about what we usually see from Elon when it comes to dancing, as they were delivering the first Model Y. These Model Ys, by the way, that are coming off the line, they are going to be delivered to European buyers, and the ramp up in production in Europe is a big reason why many believe that Tesla will deliver more than 1.4 million vehicles this year. They did 936,000 last year. They're going to deliver an increase of almost 500,000 according to many analyst estimates. Let's see if they can hit that. And Europe is really the weakest of the three major EV regions in the world when it comes to Tesla sales. Look at this. North America, not a surprise that they have more sales there than anywhere else, but China catching up quickly, the world's largest EV market, and Europe only 168,000. That's because the vehicles being sold in Europe by Tesla are built in China, then shipped over there. That will change now with Giga Berlin. As you take a look at shares of Tesla, keep in mind, this is the first of two big Gigafactory first delivery dates that Musk is celebrating. There's today in Berlin, and then early April, we'll see him do something similar when they open deliveries, or begin deliveries, I should say, at the Gigafactory outside of Austin, Texas. Guys, back to you.
Two big plant openings. Is Tesla done opening plants for a while?
For the near term, yes, Tyler. They don't have any plans that have been announced in terms of saying, hey, here's another gigafactory that we're going to be putting in place. But they can expand where they have right now. So as demand and sales of EVs continues to grow in China, which is expected because that is a country that is really pushing electric vehicle adoption, and it's the world's largest EV market, they can expand that plant in China significantly. And so you'll see increases there, and probably over time they can increase production at the two plants here in the U.S. and then also with Giga Berlin. Obviously, Giga Berlin is going to take some time. There are some issues there with the state government in terms of water usage and some other restrictions there, but they'll likely get that resolved, and you'll see production increase over time. It's already scheduled to have production of up to 500,000 a year eventually. So they've got some room to grow.
All right, Phil LeBeau, thank you very much, reporting on Tesla. Meantime, let's get to Rahel Solomon now for a news update. Hey, Rahel.
Hi, Tyler. Hi, Kelly. Here's what's happening at this hour. In the besieged Ukrainian city of Mariupol, a military group says that this video we're about to show shows a Russian airstrike blowing up factories and industrial buildings. Reuters has verified the location of the video, has not been able, however, to determine the nature of the explosions. Meanwhile, the AP reports Ukrainian defenders still fending off Russian attempts to take the port city, and that's despite weeks of bombings. Back home in California, in Burbank, California, in fact, about 100 Disney employees walking off the job. They're heeding calls to protest the company's response to that Florida legislation that opponents are calling the Don't Say Gay bill. Disney CEO promising a company-wide listening tour to address workers' concerns. Florida Governor DeSantis says that it's unfortunate that Disney has been bought into false narratives about the bill and that he will sign it soon. North of Houston, more pictures of damage from storms and apparent tornadoes hitting Texas and Oklahoma. About 40,000 are still without power in Texas. Some of those storms now in Louisiana, where more than 26,000 utility customers have lost power. Tyler, I'll send it back to you.
All right, Rahel, thank you very much. Ahead on Power Lunch, we're going to get you caught up on the markets as stocks are higher across the board right now. The Nasdaq leading the way, as you see there, up almost 2%. Chinese internet stocks continuing their strong rebound. Alibaba up more than 50% in just a week, and the yield on the 10-year note, well, 2.37%. Stocks, bonds, oil, you got it. We got it covered. Next on Power Lunch.
90 minutes left in the trading day, and we're sinking off the highs, still up nicely, but let's get caught up across stocks, bonds, commodities, and this spike in diesel prices we're seeing. We'll start with Bob Pisani on the move higher in stocks, although Dow's up 200. Bob, high was what, 313?
Yeah, off of the highs, but Boeing's rebounding. That's really helping the Dow. And of course, Nike's great earnings, not only helping the Dow, but it's helping consumer discretionary. Banks are up because, of course, we're seeing interest rates move up. So Goldman's up, JP Morgan also helping the Dow. But the really notable mover, again, is these commodity stocks. This rally is very real. It's been going on for a while now. We have a new high on the S&P Materials Index. It's a historic high. So some of these stocks have moved up. They're off of their highs, but CF Industries, Nucor, Freeport, McMoran, Deere, all at new highs at some point earlier in the day. Deere, of course, associated with the commodity industry. Elsewhere, if you look around here, it's very interesting to watch Cathie Wood-style stocks and China stocks kind of move together. They've often been doing that recently. That's happening again today. So nice moves up in Tesla, in Block, in Zillow, Coinbase, Teladoc, all moving to the upside. Finally, I just want to note the meme stocks. Yes, you noted, Kelly, GameStop up 30%, but all the old favorites there. Look at AMC and even Express. And yes, remember Bed Bath & Beyond briefly was a meme stop for a brief moment in January, February of last year. All moving again, all mostly in the middle of the day, a little bit after 12 o'clock Eastern time. No particular news out there, but keep an eye on that. Kelly, back to you.
Isn't that remarkable? Bob, thank you so much for pointing it out. Our Bob Pisani. Over in the bond market, as you well know, yields have been on the rise today. 2.39%, that's the high for the 10-year. That's its highest level since May of 2019. It's all after Powell was a lot more hawkish at yesterday's speech, saying he's open to a half-point hike if necessary. Goldman comes out, they expect 2 half-point hikes now in the next meetings. Here's the yield spread between the 2s and 10s, 21. That's a low. 3-month 10-year looks a little bit better, though. In fact, 3-month 2-year, we can also watch. Both of those have been steepening, and they are favorites of the Fed, a little more bullish sounding. Over to crude oil for the day, which is closing right around $110 a barrel. Pippa Stevens with the latest. Pippa?
Hey, Callie. Oil seesawing between gains and losses today before ending the session more or less at the flat line. Whether or not the European Union institutes an oil embargo remains front and center. Should a ban be implemented, the next stop for oil is 180, Rystad Energy said today. Let's look at prices here. WTI down 0.75% at 111.30. Brent crude is flat essentially here at 115.71. Now, even if there isn't an overarching ban, self-sanctioning does continue. French giant Total Energies just now announcing that they will stop buying Russian oil and petroleum products as soon as possible and by the end of the year at the latest. This comes after the company faced a backlash for its initial response to Russia's invasion, which had stopped short of halting Russian operations altogether. Kelly, back to you.
Great point, Pippa. Thank you very much with all the latest developments there. Now, it's not just oil and gasoline prices that have been spiking across America. Diesel in particular has hit fresh highs. According to the EIA, we're at record diesel prices averaging $5.13 a gallon in the U.S. That's up almost $2 from a year ago. Here to discuss the effect of all this is Donald Broughton. He's an expert on the trucking industry, managing partner at Broughton Capital. It's great to see you today. And first of all, why are diesel prices still so high? We haven't really seen them ease yet.
Well, because the demand is out there, quite frankly. You're not seeing an ebb off in the demand for diesel to the demand for moving freight. And therefore, with demand strong, prices are going to stay high.
Been this decoupling effect a little bit from gasoline, and I don't know if it's going to continue, but to your point, Donald, what does it mean for truckers who are facing now the prospect of a lot higher fuel costs? People have raised the kinds of protests we've seen in recent decades over similar problems, saying there were times that people would literally stop driving trucks. They would, shut down routes. They'd go out of business. I mean, we've already had such a supply chain problem. This now adds another element to it.
It certainly does. And it's certainly pinching margins for all truckers. What happens is if you look at any level of diesel prices, the fuel surcharges that are in place, those programs essentially completely offset the incremental cost. But there's a lag because you're paying the price at the pump today, and that price has been going up, and the fuel surcharge resets once a week, and it's based upon last week's average price. So there's a lag and there's a catch up, and so you get a lag a shortfall on the way up. You get a windfall on the way down, but you got to weather through that period first of all. And as you pointed out, Kelly, we've never seen this big of an increase in such a short time frame. We saw literally a $1.20 gallon jump in the price of diesel in just 3 weeks.
Wow.
And we're at prices, 65% above where they were a year ago.
Let's talk stock impact. There are a number of publicly traded names involved here, but as you know, it's the smaller players who will be hit the hardest. They have fewer resources to deal with it. What does it mean for Knight and Schneider and Werner and J.B. Hunt?
Well, for Knight, Schneider, Werner, those are big fleets. They're going to certainly have those short-term headwinds of playing catch-up on it, but it's going to be a bigger headwind for their smaller competitors. So in the grand scheme of things, they'll weather through this. Decent balance sheets, good operating fleets, et cetera, and they buy at bulk rates. So they're going to escape the pain that the smaller guys are going to suffer full on. Hunt's is a different story. Remember that Hunt is the largest truck to rail to truck, what's called domestic intermodal player in the U.S. And sure, they have a truck division which will get hurt just as Knight and Snyder and Werner's will. But their truck division is 7% of their revenue, 6% of their operating profit. Their intermodal business is 45% of their revenue, almost 60% of their operating profit, and that part of their business is doing extraordinarily well right now because you can save yourself as a shipper the higher fuel surcharge cost by switching to that domestic intermodal, and so the customers are beating a path to their door as a result.
Does Hunt own the trailers, or do they own the trucks themselves that pull the trailers? That's question one.
Well, they own the truck.
Yeah, okay, they own the trucks.
And they own the containers.
The containers.
And then they have partnerships with, right, and then they have partnerships with the Burlington Northern, the Norfolk Southern, and the Canadian National, which are three of the biggest, best intermodal players, domestic railroad players in North America.
I like a guy who knows how to say Norfolk. Donald.
Norfolk, exactly right.
You got it, man.
But you're also seeing demand in other places jump up. So the flatbed guys are doing extraordinarily well because rig counts are jumping higher, and they're moving all of those materials from out to those job sites as you see more and more new rigs be put up because taking advantage of the higher prices of oil and gas.
Don, thank you very much. Don Bruton, appreciate it.
Oh.
All righty, as interest rates rise, mortgage rates are going along for the ride, if you want to put it that way. Up next, we will have the latest numbers on 30-year mortgages, and it's going to put the housing market in potentially a deep freeze. Will it do that just as the spring selling season starts coming out, along with the blossoms? We'll be right back. Well, the housing market may be entering uncharted waters just ahead of the spring home selling season. Mortgage rates are spiking, but inventory is still low. Diana Olick is here with the latest numbers and the effect. Di.
Ty, mortgage rates got nowhere to go but up. And add to that the steady rise over the past month, and economists are now revising their home sales forecast lower for the year just as we get into the heart of the spring market. Take a look at the average rate on the 30-year fixed. It hit 4.72% today, moving 26 basis points higher just since last Friday, that according to Mortgage News Daily. Most estimates at the end of last year had the average 30-year mortgage rate hitting 4.5% by the end of this year. But the war in Ukraine, rising oil prices, and inflation have all lit a fire under rates. Last year at this time, it was around 3.45%. The COO of Mortgage News Daily, Matthew Graham, told me rates have a small chance to top out before hitting 5%. And a good chance of topping out before hitting 6%. It is a rapidly moving target in this environment, he said, due to inflation. Lawrence Yun, chief economist for the National Association of Realtors, had his official home sales forecast for a 3% drop this year. But Yun told me this morning he now expects sales will fall 6 to 8%. And CoreLogic is also revising its sales estimates lower. With home prices already up 19% from a year ago and the higher mortgage rate on top, you're adding over $350 to the monthly payment on the median priced home and close to $100,000 in the full life of the loan. Back to you guys.
So what are these higher rates likely to do to prices?
Well, that's the big question, Tyler. Normally, in a historically normal housing market, you have sales start to drop, and then 6 months behind that, you see prices start to cool off. But this is not a normal housing market. We have record low supply, very strong demand from the millennials. And with this imbalance, it's hard to say if prices can really pull back that much. We're still hearing about bidding wars.
Right.
But as we watch those sales fall, possibly this summer into the fall, we might see prices cool a bit.
All right, Diana, thanks very much. Diana Olick.
Up next, we've got a working lunch with the head of a company turning the tables in the jobs market and helping some of the pandemic's most underappreciated heroes. John Ford will be here to explain next on Power Lunch.
righty, the pandemic highlighted the demand for healthcare workers in America and put a lot of strain on the workers themselves, particularly nurses. Today, John Fort brings us up close with a doctor and CEO whose tech company is giving nurses more power in the job market, if not the upper hand.
Yeah, well, it's good to be back at the table.
Nice to have you
with
here.
you guys. Yeah, Dr. Iman Abuzaid is co-founder and CEO of Incredible Health. It's a startup that's addressing the nursing shortage through the power of a social network. Incredible system lets hospitals recruit nurses instead of nurses applying for jobs. Abuzaid is used to charting her own path. She was born in Sudan, grew up an expat attending American school in Saudi Arabia, lived in the Emirates and the UK, and then emigrated to the US when she was 24.
I mean, the truth is it wasn't easy. I mean, I definitely don't speak Arabic as well as someone who grew up in Sudan, right? And at the end of the day, I'm pretty accustomed at this point of being like a quote unquote outsider, you know, like once you've lived in multiple countries and, you know, you're a minority in all those countries, frankly, then, you know, you are a little bit of an outsider. And that's, I've really used that to my advantage, to be honest, because being an outsider means that you have like different perspectives. It means that you're not like seeking like belonging, to be honest, right? You're kind of doing your own thing. And if anything, you're trying to get, in my case, I'm getting others to join my mission.
That mission through Incredible Health is empowering nurses and partnering with more than 500 hospitals and health systems, including Cedars-Sinai, HCA, and Kaiser Permanente. Last week, the company published results from a study of 2,500 nurses showing a third say they're likely to quit by the end of 2022. On the platform, Iman is able to use data to understand nurses' needs better, see why they're leaving their jobs, and maybe get them into better ones.
On average on our platform, we see a 15% reduction in commute time. You know, so some are just looking for a shorter commute time, and we also see a 17% increase in salary as well. The other thing, just to speak to the activity on the platform, every 30 seconds another interview request is sent, right? And it is the activity on the platform is very high. So when you are a nurse on our platform, one of probably the best benefit you have is that the employers are applying to you instead of you applying to them.
Growing up, Abuzaid moved around so much because her father was a surgeon in Saudi Arabia. Now 2 of her brothers are also surgeons. Iman did do med school too, but instead of practicing one-on-one medicine, she decided to go into management consulting, then to Silicon Valley to work for a startup. Then she launched Incredible with co-founder Rome Portlock. She's keeping it moving with plans to expand from 25 states to 40 by the end of this year.
So you answered my question. I was going to ask, was she trained as a medical professional?
Yeah.
And clearly she was, but she's also got an inclination as an entrepreneur. So do nurses register with this portal, and that's how she finds her base of candidates?
Exactly. And then the employers want to get in
the
on
hospital
there,
systems.
Yeah, to recruit the nurses. It's similar in a way to Doximity, which is a social network for doctors, right? And there are so many people who want to get the attention of doctors, pharmaceutical companies, et cetera, et cetera. But there's power in having that, because not only are they looking to allow nurses to get recruited, but also to increase their training, because leveling up in training and knowledge is one of the things that a lot of nurses are saying they really want.
I wouldn't be surprised if we see technology press further, taking what she's doing, her company's doing it, others are trying to do it, almost making nursing an on-demand service, kind of like an Uber, a platform a little bit more like that. And if the unusual pandemic is going to be the catalyst for workplaces to change and accommodate that as well.
Indeed, but she says that nurses really want full-time work, not really the gig work, because of benefits, because of stability. Nurses tend to start out doing more of that flex stuff and want to settle down into a good situation. So that's what she's focused on.
It sounds like her anchor tenants or clients are big hospital systems. If I was a member of a multi-office practice, could I use it? If I was a solo practitioner somewhere, could I use it to find someone in my area who was qualified to be my nurse?
You absolutely could, but as she scales, she certainly is dealing with a lot of those larger organizations. But hey, there's demand for nurses.
Who pays her?
The large organization, the clients who are, the hospitals who are trying to hire the nurses are the ones who pay.
So the nurses there's no fee to sign up if I'm a nurse.
Even the training on the platform is free.
Wow. She's so impressive, by the way. I mean, I know that goes without saying, but the life she's lived, her whole family of surgeons, too.
Yeah. Traveled all over.
Trotters,
She sounds kind of American, but, you know, she didn't show up
She's
here
a
until she was an
cosmopolitan
adult.
person. Yeah.
Very.
All right. Thanks, John, very much. All right. Next on Power Lunch, this $50 mansion.
I'll buy that.
Yeah, if that was $50, sign me up. That's $50 million mansion. It's in Aspen, owned by a Russian oligarch. Assets around the world, they've already been frozen. This property could be next. Stay with us. We'll take you there.
Welcome back, everybody. Dow hanging on to a 224-point gain, or about 70 points off session highs. It's good for a 0.2% increase. But take a look again at the Nasdaq, which has been leading the way today with a 1.9% rally at session highs and a 268-point move to the upside despite higher interest rates.
Well, the Russian oligarch Roman Abramovich owns a Colorado mega mansion, and it could be the first oligarch property to be frozen if the White House sanctions him formally. Robert Frank has the details. Robert.
Hey, Ty. Well, sources telling me the White House now considering adding Roman Abramovich to its U.S. sanctions list. The UK, Europe, Canada, Australia have already sanctioned him. They've frozen his assets and banned his travel to those countries. If he is sanctioned here, his Rocky Mountain real estate could be the first oligarch assets to be frozen by the U.S. Abramovich actually owns two mansions near Aspen. One is a 14,000 square foot modern glass mega home on 200 acres in Snowmass. He bought the property in 2008 for $36.5 million. Brokers tell me he expanded underground. It's now worth well over $50 million. He also owns a 5,500 square foot ski chalet just down the road that he bought for $12 million. Now, most oligarchs own U.S. real estate through anonymous shell companies or relatives, but county property records show these two homes by Abramovich both remain in his own name. That means the feds would likely be able to freeze them almost immediately. Now, to seize them or actually take title, The Justice Department would actually have to prove Abramovich committed a crime, which could take years or even decades. Meantime, buyers are circling these properties. Demand at Aspen right now is so strong that the average sale price for a single-family home right now, guys, is over $13 million.
Can you live in a frozen house, Robert?
So it's a little uncertain. So he can't transfer it, he can't sell it, and he can't benefit from it. And that legal term of benefit is a little unclear whether he can live in it or not. He is probably able to visit it, but whether living in it remains a benefit is unclear. But he can't sell it, he can't transfer it, and the U.S. government can only take title or seize it if they prove a crime.
And his travel would be highly restricted these days, I would guess, in the U.S.
Yeah, so his 2 yachts and 2 of his planes are in Turkey right now. The speculation is that he is in Turkey. He is an Israeli citizen and a Portuguese citizen. People thought he would go there, but he is not. And certainly in the U.S., even though he's not sanctioned yet, no one in Aspen has seen him for years.
Fascinating.
Yeah, very,
House
very
might need some
interesting.
upkeep, you know.
Does he still have Russian citizenship too, Robert? I assume he does.
Yes, he Russian, Israeli, and Portuguese. Those are his 3 citizenships. And his ex-wife and his daughter are both U.S. citizens and live here in New York City.
All right, thank you, Robert.
Robert Frank on it as always. Thanks for watching Power Lunch, everybody.
Closing bell right now.
Stocks are firmly in the green and yields are at multi-year highs. The most important hour of trading starts now. Welcome to Closing Bell, everyone. I'm Sarah Eisen. Here's where we stand in the market. Rising again, the S&P higher for the 5th time in the last 6 sessions and up a full % as we go into the close. The Dow is off session highs, but still up a healthy more than 200 points. The NASDAQ is doing the best of the big 3, up 2% right now. Technology and consumer discretionary in the lead. Small caps also coming back up more than 1%. We're higher for the month of March, and we are building on last week's big win streak. Here are my top takeaways on the biggest stories today. Nike jumping. You will hear analysts talk about China, supply chain improvement, pricing power, all true. But one thing to pay attention to that nobody's talking about yet, Nike's new virtual strategy. In the call last night, CEO John Donahoe announced Nike Virtual Studios to build Web3 products and experiences and to scale it. Nike acquired a startup Artifact, launched its first NFT this quarter. Reminder, Nike was ahead of the pack on digital, so watch this space. A lot of companies did well during the pandemic and into this year because of lockdowns, work from home, virtual school, and consumer staples especially. But that trade is not working anymore as the pandemic fades and life returns. Truist says it's time to buy P&G, Procter & Gamble, above the rest because it actually emerged stronger from the pandemic and is ready to separate from the pack that just got a temporary lift from pandemic trends. And why are stocks rising and bond yields shoot up? Usually, this kind of rate move spooks stocks, especially technology. One theory, Fed credibility is bullish for the market. Fed Chair Powell's pivot and tough talk on inflation this week restores cred to a central bank that was behind on the inflation fight. As Ironside's Barry Knapp said in a note today, it's bullish for the asset class that benefits from capital formation, productivity, and real growth, namely equities. Let's get straight to our top story. The signal from the bond market, yields on the shorter end of treasuries jumping to multi-year highs. It's happening faster than longer-term yields, fueling a big debate about whether the bond market is about to signal a recession. Joining us is the National Economic Council Director, Brian Deese from the White House. Brian, it's great to have you back on the show. Welcome.
Happy to be here.
So you're an economist. You follow the yield curve. Fed Chair Powell played it down yesterday. Are you worried about recession signals?
Well, when we look at the strength of the economy, we try to look at indicators across the board. And I think one of the striking things about the economy right now is the resilience of the American consumer and demand. We're seeing that in data over the course of the month. And so we continue to believe that we've got a resilient economy with a very strong labor market and with a consumer that is continuing to sustain and has continued to sustain through a number of shocks and changes as we've come through this recovery. So that's our assessment as we sit today. Obviously, there are risks and uncertainties looking forward, but the strength of this recovery is quite notable. And so we believe and expect that that will continue.
Strong enough to handle 7, maybe 8
interest rate hikes this year? That's what the market's starting to price in.
Well, look, we have had a historically strong economic recovery. The economic growth that we've seen is the strongest in 40 years. The labor market performance is the strongest that we've seen ever in a modern economic recovery. And we've seen that through a number of unexpected twists and turns, including the pandemic and the Delta variant, the Omicron variant, some of the supply chain challenges. And obviously, we continue to have real challenges on the supply side of this economy and with elevated inflation. But we think that the most notable issue right now is the resilience of the American economy, and I would note unique among advanced economies in the world. The president's heading to Europe later this week, and the American economy stands out for that resilience as well.
But the inflation picture has changed, and it's gotten worse. I know you met with CEOs yesterday, Brian. What did you hear from them, and what did you tell them about what you're expecting now as far as how long inflation is going to last, especially with this new shock we're seeing in food and energy prices?
Well, we had an important meeting with CEOs from sectors across the economy yesterday. The principal focus was on the war in Ukraine, both in terms of giving them an operational update on facts on the ground and our sanctions and export control efforts, to thank them for the work that they're doing in partnership with the government to effectuate those sanctions, and for a number of companies to take individual steps as well, and then to talk through the outlook and the resulting impact on the global economy and the American economy. The good news is that the sanctions package and the impact is being principally felt by the Russian economy, and we are taking steps to mitigate wherever we can the impact on the European economy and the American economy. But there will be impacts. Certainly that's true in energy markets and gas prices as well. So we talked about the ways in which we can continue to work together to maintain this crushing blow on the Russian economy while mitigating the impact here at home.
There was also discussion of cyber threats, and President Biden warned the CEOs that there's evolving evidence that Russia is considering launching cyber attacks, that they have a patriotic duty to step up spending on their defense. What more can you tell us about which industries or sectors might be most vulnerable?
Well, I can tell you this. The president made a very clear call on the corporate community to do everything they can to harden their cyber defenses for critical infrastructure, which in the United States is operated principally by private actors. This is not an issue that we come to recently. We've been working for months with the private sector around how to encourage them to take steps to harden their own defenses. But it is made acute right now because the Russian government has these capabilities. It's signaled its intention to use them, to react to and to respond to the sanctions package that we have put in place. And so everybody needs to be vigilant and on a high state of alert. And one of the things the president underscored is that for many of these companies that operate critical infrastructure, this is not just about the benefit of their shareholders and their stakeholders, that the benefit of the broader American public and the broader economy is on the line. And so therefore, it's important that we all do everything we possibly can at this moment. I can't tell you when exactly Russia may act or on what sectors, but what the president made very clear is that risk is real.
Is there any evidence that it started?
We have not seen any evidence of wide-scale or very targeted efforts at U.S. firms. We have seen some activity in Ukraine that has spilled over and has had some impact on European and in some cases American companies. But the fact that we have not seen it yet should be a reason for vigilance and for action, not complacency, that this threat is real. And that was what the president tried to underscore. A lot of partnership between the federal government and the private sector is going on. That's a good thing, but everybody needs to step this up and be on a high state of vigilance.
Those cyber stocks flying today. Brian Deese, thank you for joining us with an update from the White House on that meeting.
Sir.
After the break, a slew of airlines have come out with bullish demand forecasts. But what about the cruise lines? We'll ask Carnival CEO Arnold Donald about what he's seeing from customers. Next, you're watching Closing Bell on CNBC. Dow's up about 225. Carnival out with earnings today, reporting a miss on both the top and bottom lines for the first quarter, citing a temporary slowdown in bookings due to the Omicron variant. Joining us now for Closing Bell Exclusive is Arnold Donald, CEO of Carnival Corporation. Welcome back, Arnold. Nice to see you.
Hey, good to see you, Sarah. Good afternoon.
Good afternoon. So the miss was blamed on Omicron, and now you're talking about very strong booking volumes that you're seeing. What's driving that? Is it simply getting out of a pandemic phase? Talk a little more about what you're seeing.
Oh, no, absolutely. We have about 75% of our ships as of March sailing again, which is fantastic. We've seen unbelievable strength in bookings in our Carnival brand. The past 3 weeks are wave season type bookings, so extraordinary bookings at higher pricing. So we have a lot of momentum going. Of course, we've had to change some itineraries over in Europe. And so I would like to take a moment now to say, along with everyone else, we stand for peace. We have thousands of employees from the Ukraine and from Russia, and our hearts just goes out to everyone who is being directly impacted, whose loved ones are being impacted. But even with those sailings, while we've had to pull out of Russia, we've been able to replace it with itineraries going to different places in Sweden and Latvia and Norway and Denmark. So things are really positive from a demand front and from a booking front looking forward.
Even in the international cruises, is that where people want to go right now? Because what we hear from the airlines and hotels is that there's this boom, but it's largely domestic.
Well, keep in mind that we're a global company. We have 9 world-leading cruise line brands, and they sail in home port all over the world. So we source a lot within Europe. And of course, Europeans, many of them still want a vacation. And so those brands are seeing, good booking strength and good onboard yields when people are on board, as are our North American brands. So yeah, you see pockets of where people may have some sensitivity to specific itineraries or specific locations. But overall, North America and Europe, as we said in our business update today, we have good booking momentum at strong pricing.
So on pricing, fuel is definitely going to hurt. Hurts the airlines, certainly hurts you guys. How much of a damper does that put on the financial recovery that you expect, and how can you offset that? Are you raising prices?
Well, what we do, first of all, is manage consumption, and we've done a good job of that. So we've had a 30% reduction in unit fuel consumption since, 2000, mid-2000s, and we've done very well with that. We have additional opportunity for reduction in consumption, both because we have 25% of our ships will be new ships once we are back at 100%. We took out less efficient ships, about 22 of them. Plus, we have many initiatives on board our ships for better fuel efficiency, from itinerary planning to fine-tuning the engines to using different lighting, conservation on board of water, as well as food waste and so on. So we have, first and foremost for us, is consumption. Fuel prices go up, they come down. It's happened through time. We've suffered through fuel spikes before, and we'll see how long this one persists. And if it does, then we'll take a look at other actions to take if that proves to be necessary.
When, Arnold, do you feel like you'll be back to normal as an industry as far as demand, capacity, service? I mean, there's just so much coming at you. I know you got the level lowered by the CDC, which was probably good news for you.
Yeah,
but when do you go back to normal?
Yeah, the world is always not normal. And so for us, when are we going to see a return to 100% of our fleet and EBITDA greater than what we had in 2019, et cetera? Right now we're looking at positive EBITDA in the third quarter is what we're looking at, for the third quarter. And so in 23, we're optimistic we'll have the full fleet sailing. We already have 40 sailings already now that are at 100% occupancy. And so we see that as an additional indication of strong momentum. So we have to see what happens around the world, because you never know. But based on the trends today and the demands today, we're optimistic in 23 we can return to seeing 100% of our fleet sailing at the occupancy levels and at stronger pricing.
But almost 30% of Americans are not double vaccinated. Arnold, doesn't that represent ultimately a challenge if you are doing these 95% vaccinated cruises? in terms of demand?
Well, Sarah, the way things have worked out for us, and we work very hard with medical experts and scientists around the world. In fact, the incidence of COVID cases is lower, consistently lower on board the ships than they are, shoreside, than they are in land communities. We've been very diligent with testing, with vaccinating our crew.
Right,
and
but you have to be
frequent testing the crew.
vaccinated, right? To get on?
Right now, you have to be 95% vaccinated in the U.S. So we are, for example, children under 5 are not counted against that. And then we do have, some exceptions for other reasons. So at this point in time, but we'll see how that plays out over time as the world has become increasingly vaccinated and as the virus has had variants that have not created hospitalizations to the same degree or worse. Then it becomes something that we learn to live with. It becomes an endemic versus a pandemic. And so we'll see if that trend continues. The variant B that people are experiencing around the world, again, while people have it, they don't seem to be as sick. Of course, we have better treatments now. A lot of people are vaccinated. All of that contributes to that. And as society moves forward and learns to live with the virus, then things are return to more normal. And that's the trend we see now, and people are having a great time on board. They're spending more money than ever, but more importantly than that, they're creating those joyful memories and moments, which is why they cruise in the first place. And it's going very well and has been for some time.
Good to hear. Arnold Donald, thank you for the update.
Thank you, Sarah.
CEO of Carnival. After the break, the flattening yield curve leading to some questions about whether recession is looming. But Mike Santoli takes a different indicator that could ease some of those fears. Takes a look in the dashboard next. NASDAQ up 2% as we head into the close. Technology and banks are what's leading this rally today. You're seeing it in the big cap tech, the chips, up just near session highs. There's the NASDAQ up 2%, the S&P up 1%. The Treasury yield curve continues to flatten, though, today, sparking some fears of a looming recession. Brian Deese from the White House isn't worried about it, neither is Mike Santoli, who is looking at one other indicator of a potential recession.
Yes.
That's not so bleak.
The index of leading economic indicators, it's a composite. It's not just a single source. Now, the New York Fed has a yield curve-based recession prediction model. It's one component. It's the 3-month Treasury yield versus the 10-year. 3-month 10-year, not 2-year 10-year. This is a composite of things which over a long span of time, as you can see, goes back over 60 years, has almost always rolled over before the shaded area, which is recession. Not always too far in advance, but you see there's almost no recessions that have not had this really degrade a little bit before you get into recession. However, 2020, there's a difference, right? That wasn't a normal recession. That was the economy forcibly stopped. So it's still pointing higher. It was actually higher in February versus January. January dipped a little bit. So this is at least a slight reassurance that even if things are slowing down, even if the risks are rising, we're not on the precipice, most likely, of a domestic recession.
And we were just talking about what goes into it's a number of indicators compiled into one. The market.
I do know stock market is included in there, and I believe there's some employment stuff in there, some manufacturing stuff, maybe credit markets as well. So, you know, it's a blend. It maybe isn't perfect, but I do think there's some reassurance from people who are screaming about the 2-10-year
pushback against all that negativity. Well, don't look now, but meme stock mania is back. GameStop and AMC soaring right now. Up next, we'll get reaction from Interactive Brokers Chairman Thomas Petterfy. His thoughts on the state of the retail investor when we come back. Check out shares of GameStop up 25% today. Other meme stocks higher as well. AMC's up 14%. BlackBerry, Bed Bath & Beyond also outpacing the market. Joining us now is Interactive Brokers Chairman Thomas Peterffy. Thomas, it's great to have you. I know that you sometimes overlap with the Robinhood set, right? But you claim that you have a little more sophisticated investor. What does this kind of action in these stocks tell you about where retail traders are right now?
Well, I don't think this is a good situation for retail traders because in the fullness of time, these stocks are very likely going to go to zero, right? So somebody is going to end up holding them at the time when they really go to zero. So I hope that not many of my customers, Interactive Brokers customers, are not in these stocks.
What are you seeing from the Interactive Brokers customers in terms of participation and appetite for stocks right now after a pretty brutal start to the year, but a nice little bounce here in the last week and a half?
Yeah, so interestingly enough, our customers, Interactive Brokers customers, are not participating in this latest rally. In spite of the fact that IBKR offers margins as low as 1.83% to all the way down to 0.83%. Our customers' margin loans have decreased by about $8.5 billion, or roughly 17% in the current quarter. Similarly, free cash deposits have increased by 7% to $95 billion. So most IBKR customers do not seem to believe the current rally. And I think that they think that there'll be a better opportunity later to get back into the market.
So pretty defensive posture there. Is that what you would say? What about overall just activity? As far as, stimulus checks have faded and Fed is tightening interest rates. What about just retail investors' embrace of the markets at all?
So our average customer has about $200,000. So these are more sophisticated customers than people who are basing their investments on relief checks.
What about technology in particular? What have you seen as far as inflows and outflows and that once beloved part of the market that has been most vulnerable to what's changed here?
So I think they are all worried about the Fed hikes, right? And although I don't think that the Fed will be able to raise rates high enough to stop inflation, I think that this is because they don't want to appear to be starting a recession right before midterm elections. Second, the higher they raise the rates, the higher interest rate payments will become on the freshly issued debt that will contribute to the nation's indebtedness. I think Treasury made a big mistake in not refinancing at much lower rates while they were available. And this situation is further aggravated by the very high level of borrowings in the $11 trillion private equity space, where managers have been trading companies among each other at ever higher prices, loaded with more and more debt. That worked just fine with, interest rates were zero, but they will not work at 3, 4, 5%. So I think we'll see a lot of bankruptcies in this space.
No, I know you've been warning of that and worried about it. What about your own results, Thomas? Do higher interest rates net help your earnings or hurt because of what you just described?
I just said that we're sitting on $95 billion of customer cash. So obviously higher interest rates are going to be helpful, yeah.
Thomas Peterffy, appreciate you joining us.
Thank you very much.
Always good to get an update. Here's where we stand in the markets right now. Going strong here into the close. The Dow's up 240 points. Technology is in the lead. As I mentioned, NASDAQ been hit harder than the rest this year. It's up 2% and having a bigger rebound. The S&P up 1%, small caps up 1% as well. Up next, venture capitalist and crypto investor Katie Hahn on whether private crypto company valuations are starting to look expensive. What's Wall Street buzzing about today? Venture capitalist and crypto investor Katie Hahn. After leaving her high-profile role at Andreessen Horowitz last year, Hahn now breaking records with her $1.5 billion debut fund. Kate Rooney exclusively sat down with Hahn in her first interview after leaving Andreessen. Kate, tell us more.
Hey, Sarah. Yeah, this is the largest debut venture capital fund ever by a female founder and the biggest debut crypto fund, according to PitchBook. Hahn Ventures is going to be split into two parts. It's $500 million for early stage investments and $1 billion for the later stage growth side. Hahn led and co-led Andreessen Horowitz's multi-billion-dollar crypto funds before leaving the firm in December. She was an early investor in Coinbase and sits on that company's board. She says a smaller team will help her be more nimble. Hahn also tells me Bitcoin prices and publicly traded crypto companies getting hit is not spilling over to private startups quite yet.
We're still seeing very high valuations in the crypto space. I will say, though, that some of those high valuations, some of those companies are actually profitable and have metrics that you can go look at. And so I think it's important that we don't treat crypto and Web3 as a monolith, because they really are very different in terms of what problem they're tackling and different projects out there.
Han has invested through multiple bear markets, sometimes called crypto winters, and says that's when some of the best companies are built. And as far as where the opportunities are, she mentions blockchain gaming and identity verification. Sarah.
We will watch it. Kate, thank you. Kate Rooney on The Buzz. When we come back, NVIDIA unveiling a new chip aimed at speeding up AI computing. And Tesla cuts the ribbon at its German gigafactory and soars to the top of the S&P 500. Those stories and more when we take you inside the market zone. Twenty minutes left of trading. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Needham's Raji Gill on NVIDIA's new product announcements, what it means for the stock. Canaccord's Jed Dorsheimer on Tesla beginning deliveries at its gigafactory in Germany. First up, though, on the broader markets. Stocks are rebounding again after yesterday's big sell-off. The major averages are near session highs. Dow's up 250. NASDAQ now past 2% or so, Mike. And what stands out today is that Treasury yields are really jumping. We're seeing fresh multi-year highs on the 2-year, on the 10-year. They're at 238%. Usually, that would spook equity investors a little bit, especially in technology, right? You worry about the effect of higher interest rates on the economy and on longer duration assets. What does today's action tell you?
Yeah, I mean, obviously, treasuries were in the wrong spot for a fast-tracked Fed tightening program that they're now talking about. So there's no doubt about that. The question was how rapidly the market itself might adjust. What's interesting is we're now up to levels of yield that treasuries have not spent a lot of time above over the last, let's say, 8 years. I mean, 2.4% on the, on the 10-year. Yes, in times in 2019 and a little bit before that, you did get above that 2017. But not a lot of time. So we don't necessarily have a stock market that's been, stress tested for that level. I don't think there's anything magic about these particular thresholds, but it is interesting. When it comes to tech, I mean, look, we had a 20% pullback in the NASDAQ. The relative performance of the NASDAQ 100 to the S&P hit a new 2-year low basically a week ago. So all we're doing is doing some catch up here. The duration, discount back at a certain rate at the earnings of long-term assets. That story is a small piece of the valuation puzzle. It's not relevant right now. Final point, if we're slowing down, you go for the stocks that can grow their earnings, which are growth stocks.
Growth stocks, true, which is working today. NASDAQ still about 13% off the highs. S&P, Mike, wanted to also note, because we did pass 4,500 for the first time today since February. Give us the Santoli big pick on just where we are this move after last week's big rebound and now some follow through today.
Yeah, a lot of folks focused on an area about, let's say, 2% up from here, just under 4,600. If you look at that chart there, there's basically twice in February, that's where the index peaked out. And even when we were at the lows, a lot of folks were saying, hey, even if we bounce from here, we're probably in a range that goes from 4,200 to 4,600. So we may be relatively close to testing that proposition. Like I said, 1 to 2% up from here, and you'll be just about at the doorstep of it.
Up 1.2% right now. NVIDIA announcing several new products at today's Investor Day, focusing on AI, enterprise products, and teasing plans to build what it says will be the world's fastest supercomputer. Shares are down today, but have gained about 20% since last Monday. Let's bring in Needham analyst Raji Gill. Raji, welcome. What do you think were the biggest takeaways for investors today?
Well, this was probably one of the most comprehensive, the most compelling analyst days I've witnessed for NVIDIA, and I've been covering NVIDIA for well over a decade. There are a couple of kind of major things that were quite exciting. I think number one was their new GPU. It was the Hopper H100 processor. This has 80 billion transistors. It's 6 times the performance of the previous Ampere architecture that was introduced 2 years ago. And one of the interesting stats that Jensen Huang, the CEO, mentioned, if you have 20 of these H100s, it can basically power the whole world's internet traffic. That's how powerful and computational this new chip is. So this chip basically is going to enable the adoption of more advanced machine learning and artificial intelligence into enterprises, whether that's deep recommender systems, genomic sequencing, natural language understanding. Because of the raw speed, it will enable that level of processing. I think the second thing that was very interesting, and I think speaks to the longer-term potential of NVIDIA, is the software opportunity. They outlined about a $300 billion TAM just in software. They're building a long-term subscription software model by licensing their software to enterprise servers, also to the Omniverse.
And this has been one of your themes, NVIDIA into a software company. I'm just curious, why do you think the stock is lower today on the back of some of these, as you're describing, pretty bullish announcements?
Yeah, I mean, the stock had, as you mentioned, rallied, 20%, heading into this analyst day. There might have been an expectation that the CFO would have raised the near-term outlook, but to me, this is just kind of near-term kind of trading. The bigger picture is the revenue growth, the earnings growth, and the TAM, the total addressable market that's available for NVIDIA. And if you look at NVIDIA's been growing about 200% over the last 4 years. It's grown earnings, net income, 300% over the last 4 years. It's one of the most pristine financial companies, not only in semiconductors, but of all of technology. The TAMs are enormous, $1 trillion TAM that's available.
So are you changing your numbers on this? It's still about 24% off the highs for NVIDIA. Are you changing your numbers, the valuation, on the back of what you heard today?
I have a street high price target of $400. The $400 equates to a $1 trillion market cap company. This would be the first $1 trillion semiconductor company. That only is about 50 times next year's earnings. So I have them doing about $8 of earnings, and the multiple expanding back to 50 times. At one point, NVIDIA was trading at 60 times. The multiple is compressed to 35 times. But if you look at other tech companies like Tesla or software companies that basically either have no earnings or a fraction of the earnings, they're trading at well above 50 times already. So 50x times $7 to $8 of EPS is not that far-fetched, and I think ultimately we'll get to.
And just really quickly, Raji, any implications for any of NVIDIA's competitors or maybe its suppliers?
I think this is, there really is no competitive implication except maybe perhaps to Intel. But essentially, NVIDIA has been at the forefront of pushing artificial intelligence and machine learning into the enterprise, into the hyperscalers, into vertical industries. This is a secular kind of theme. This is not going to slow down. And then the ultimate kind of move to 3D virtual worlds through the Omniverse, virtualizing physical worlds, whether it's designing skyscrapers or designing buildings and doing that in a virtual world enabled by NVIDIA software. This is, again, a completely new market that NVIDIA is leading. So it's not really relevant to look at the competitive landscape. It's really more relevant to look at where the revenue growth is now and can it grow into these massive TAMs that are available to the company.
A lot of people watching TSMC as well, longtime supplier for Intel. Raji, thank you for joining us. Raji Gill on NVIDIA. Shares of Alibaba surging today, up 11% after the Chinese e-commerce giant said it would increase the size of its share buyback program from $15 billion to $25 billion, largest ever buyback for Baba. Overall, it's been a volatile year, though, for the stock and all the Chinese internet stocks, which continue to face regulatory tightening from the Chinese government. Today's gains nearly wipe away Alibaba's losses for 2022, but not quite. The KWEB ETF, which tracks the entire group of Chinese internets, up 8% or so as well. Mike, I mean, it's been a pretty big comeback. Hard to call the bottom when you're dealing with China. But there was also a report today from Reuters that China's regulators were asking some of these tech companies to beef up their auditing disclosures, which could be taken as a good sign when it comes to dealing with the U.S. What's your take?
Yeah, I was going to say it's hard to call the bottom there, except when the Chinese authorities are working hard to send the message that they think a bottom should be put in here by, having a different tone in their messaging to companies and investors. Clearly, Alibaba, with this pretty aggressive buyback announcement, it amounts to about 8+% of the market cap over a couple of years. They might do this buyback at a pretty discounted valuation, so it's pretty good in balance sheet terms how this means in capital allocation. It's understandable why the stock would be up this way, but it also seems to come with the tacit approval of Chinese authorities. So probably more of a two-way market than it's been. That's not a very controversial proposition, given that it's been straight down for a while right now. But it does absolutely seem as if China does not want there to be this continued punitive tone about their companies and people who own capital in these.
So basically, J.P. Morgan analysts marked the bottom when they called the stocks uninvestable.
It's lining up that way at the moment anyway. Yeah, last week.
All right, look at Tesla. Tesla shares at the top of the S&P 500 today. The company officially beginning deliveries at its Gigafactory in Germany. Tesla expects the plant to eventually produce up to 500,000 cars per year. Let's bring in Jed Dorsheimer, analyst at Canaccord Genuity. Jed, with Tesla up 8% right now, talk about the financial implications. Does it hurt to drag on profitability in the near term? How are you looking at this new Gigafactory?
Yeah, I mean, thanks for having me, Sarah. So let's just take a step back for a second. I'm down here in Houston at this power electronics conference, so the guts that go into these Teslas. And I'm doing this interview on an iPhone. And when I focused on the cell phones, most pundits said, never imagined that I'd be able to do what I'm doing today with you here on an iPhone back in 2002. And so I think the context... Thank you very much. So I think the context of what Tesla is doing is we have to look at it through the eyes of a manufacturing juggernaut that we have not seen since Henry Ford with assembly lines changed and created the automotive industry that we know today. And so when we look at Austin and we look at, which is going to be coming online in a couple of weeks, when we look at Berlin, which is going to double their manufacturing, and we look at electrification as a bigger trend and the value that that brings to the market, I can't help but think that these are all positives with respect to Tesla. And it also reduces the geopolitical risk that we're now seeing increased tensions from Russia, Ukraine, and China as well.
Because what they were using the Shanghai factory and shipping cars from China to Europe. Now they could theoretically now just supply them the European demand from the European factories. What sort of opportunity does that represent?
Well, two things. You're exactly right. So first, over 50% of the cars that they're producing now are coming from Shanghai. So you're going to reduce the dependence on China is that central low-cost hub for where you're shipping. Two, imagine all the embodied energy that's actually attached to floating these cars on a ship all around the world and being able to regionalize and with local manufacturing. And lastly, these are going to be cars that are moving to the 4680. And a lot of people don't understand this. That's just the size of the battery. But it's really important because in our view, it creates an Apple-esque type strategy here, which opens up other markets, namely the markets that they haven't been doing much in, which is energy storage and battery backup. We haven't seen much, but they've said that they've been supply constrained on the 2170s. And so this opens that market up for them. And we think that's going to be an area of growth to augment the automotive growth that they're going to be more than doubling.
That's what I was going to ask about, because all of the EV companies now, Jed, are supply constrained, are they not, with the price of the materials that go into batteries spiking and a lot of them stuck in Russia and Ukraine? Elon Musk has complained about this on Twitter. Where does Tesla stand relative to other EV competitors when it comes to dealing with these issues and potentially raising prices?
Yeah, so Tesla's raised prices across the board. They're not going to be immune from the supply chain challenges. I don't think any companies are going to be immune. You're going to see that flow through. However, one of the things that Tesla's done really well is they've looked at a system design, which other companies are starting to do, but Tesla's way out in front of the pack. So, for example, using silicon carbide for their inverter to get more out of the electrons that are going into the batteries, which allows you to get to a smaller battery pack or to reduce the amount of copper to lightweight the vehicle. Those are going to be things that are going to become more important. That's why I'm at this conference down here in Houston, listening to these semiconductor companies talking about what the plans are actually going to be. So I think near term, Tesla is not going to be immune to the supply chain challenges. We think that's going to create opportunities with the volatility to buy on pullbacks. But I think when we look longer term, it's clear to us that the trend towards electrification, which includes transportation as well as decentralized electrification on the generation for solar and battery backup, are clear winners in terms of a much larger trend.
So you're buying on the dips. Tesla's still down about 6% for the year. It's 20% off the highs, but it is surging right now and had a good month or so here.
Yeah, I mean, I think in this market, we have a buy, we have a $1,200 price target, but recognize it's like the pilot coming on the flight saying there's going to be turbulence. There's going to be a lot of choppiness. Our macro strategist, Tony Dwyer, has talked about that and actually has been proficient in calling a lot of these trends. We do think that things are going to be bumpy, but we would be buyers on pullback because this is where the puck's going to be going.
Jed Dorsheimer. Jed, thank you very much.
Thank you.
Appreciate it. On Tesla, which is up right now about almost 8%. Financials among the leaders in today's rally, as well as Treasury yields continue to rise. While conventional wisdom says a yield curve inversion signals a recession, Bank of America says investors should buy financial stocks now that the 3-year, 10-year yield curve has inverted. The firm says the traditional view no longer applies and that a yield curve inversion does not necessarily signal trouble for the banks, with the sector outperforming 50% of the time during yield curve inversions, which does make you scratch your head a little bit, Mike. What do you think of the call?
Yeah, I mean, the business model of banks is no longer what it used to be traditionally, principally, which was, taking short-term deposits, lending out 10 years, or borrowing very short and lending out 10 years. The curves that matter more to bank earnings are on the shorter end, so those are still relatively steep. And also just the absolute level of short-term yields matters a lot for the deposit-heavy banks. So that just means as the Fed hikes rates, it flows right through. So all those those things are true. And I think that the curve has inverted in recent cycles when we kind of gotten later in a cycle, but we've had long cycles. So, it stays late for longer. And I think that's one of the reasons banks have continued to be okay. And valuations got reset a little bit. If you look at like a Bank of America, it was basically at its high end of its range for valuation before these little pullbacks. And it, obviously got a little more in the target zone for buyers. So it all makes sense to me. As we remember, everybody piled in. It was a stampede into banks and energy at the beginning of this year, and only energy has really given you a smooth ride. So we'll see if investors are going to be gun shy in really rushing back into financials after that.
Well, it's certainly happening today with the rise in yields. Mike, it's a weird day because we're seeing these yields spike, the 2-year, the 10-year, really across the board, even though we're seeing some flattening. And equities are doing pretty nicely. We're coming off the highs, but we're still up 1% on the S&P. NASDAQ up 2%. It makes financial conditions a little looser, which make Fed Chair Powell's job a little bit easier when it comes to tightening them. He has more of a green light to do it. I just wonder ultimately if it's the right trade. What's going on right now, given the Fed chair is doubling and tripling down on this inflation fight.
Yeah, it's not the cleanest read at all. And I think a lot of times what I would resort to in trying to figure out what's going on is, again, to go back to positioning and where we started from. You go back a week and there was absolutely rock bottom sentiment and risk positioning. It's obviously gotten taken care of. People chasing this rally. We've been talking about the late day rallies every day. Well, guess what? That often means people feel underinvested, underexposed to a stock market that's not letting them in. That can't in itself last for very long. Maybe it's actually running its course right now. But to me, that helps explain why the big index stocks, which are the big growth stocks, are playing catch up today. Maybe it's actually running its course
Tesla, Apple,
right now.
Microsoft,
But to me,
Amazon, Google, Facebook, all leading the triple Qs higher. We've got 2 minutes to go. What do you see in the internals?
It's been positive,
Tesla,
Sarah,
Apple,
but I wouldn't
Microsoft,
say
Amazon, Google,
overwhelmingly so. The
Facebook, all
equal
leading
weighted
the triple
S&P is
Qs
actually
higher. We've got 2
lagging the
minutes to
main
go. What do you see in the
index. And you see
internals?
here, it's been positive, Sarah, but I wouldn't say overwhelmingly so. The equal weighted S&P is actually lagging the main index. And you see here, it's about positive 2 to 1, 2.5. But we talked about advancing versus declining volume. In terms of the number of stocks, look at it on a month-to-day basis. Software positive and financials. But we talked about both tech so far and financials doing well. Look at it on a month-to-day basis. That's a very similar looking curve, and that hasn't been the case over the last year. Those groups have been more diverging and again moving together. A very similar looking curve, and that hasn't been the case over the last year. Those groups have been more diverging in the high 30s. The volatility index continues to cooperate. Again, down another half point. So down under 23. Remember, we peaked for this to receive below 20 to really have a sense, and that's a good market is on firm footing and is back in within the next week or two.
As we head into the close, I'm just watching Nike, which has given up some of its earlier gains. It's up about 2.5% after what was considered a very strong quarter from that company. As we head into the close, I'm just watching Nike, which has given up some of its earlier gains. It's up about 2.5% after what was considered a very strong quarter from that company. Financials, technology, we've hit all the tech and bank themes. Energy is the only sector that's lower right now. Everybody else, communication services, financials, technology, we've hit all the tech and bank themes. Energy is the only sector that's lower right now. Everybody else is higher. The Dow, best performer in the Dow, adding to the Dow gains as well as JP Morgan and some of the banks there. The NASDAQ, the biggest winner of all three, it's adding to the Dow gains as well as JP Morgan and some of the banks there. The NASDAQ, the biggest winner of all three, it's adding 5 gains of the last 6 sessions for the major averages, building on last week's strongest rally since 2020. 5 gains of the last 6 sessions, but a pretty strong day considering yields jumped. Building on last week's strongest rally since 2020. Still down for the year, but a pretty strong day considering yields jumped. That does it for me on Closing Bell. Send it over to Scott Wapner in overtime.
All right, Sarah, thanks so much. Welcome to Overtime. I'm Scott Wapner. You just heard the bells. We, of course, just getting started here. In just a few moments, I'll speak live to billionaire investor Carl Icahn. It's an Overtime exclusive. We can't wait for that, to get his views on the markets and find out where he is placing his biggest bets right now. Let's begin, though, with our talk of the tape, whether the tide is truly turning in favor now of the bulls. Let's welcome in our panel. Eric Johnston of Cantor Fitzgerald, Shannon Sakosha of Boston Private Wealth, and, of course, the Halftime Investment Committee. It's great to have you both with us. Eric, I'm going to begin with you because you have been bearish. And you know what? You got a lot of cred because you've made some great calls lately that have come to fruition. January to February 24th, you were looking for a pullback in stocks of 10%. Well, the market sold off 10% in 6 weeks. From February 24th to March 7th, you were tactically bullish, looking for a big trading bounce. We're up 5% in a week. So I'll give you all the cred. The question is now, is the tide turning? Stocks up, rates up. The VIX down for 6 straight days. S&P 500 back above its 200-day. Apple with a big rebound. Earnings all right. Nike said things are good. What do you think?
So, we think this is a classic sort of bear market rally. Sentiment got extraordinarily negative. If you look at systematic strategies, CTAs, they brought their exposure close to 5-year lows. Hedge funds de-risked. Things got washed out. And so we think this bounce where we're seeing now CTAs starting to increase their equity exposure, hedge funds have stopped de-risking and actually adding small, and now individual investors are sort of getting their fervor back. But we think this is the tail end of this short-term bounce, and that the downside is going to resume. You saw these big rallies in 2008. You saw these big rallies in 2000. All bear markets, they do have sharp rallies within them. But the fundamental backdrop, we think, is still extremely negative, and it's going to lead to lower prices. You've got economic growth is going to be materially lower, and we have a bunch of reasons why we think stock prices should be and will be much lower in the coming months.
All right. I mean, Shannon, Eric's not the only one who thinks this is not a reliable rally. We had Morgan Stanley's Mike Wilson on halftime today. Here's what he said.
I don't think the picture's better than it was 3 weeks ago. We're closer to the sun now, right? We're closer to where the revisions are going to get more negative. And you're exactly right, though, Scott. The thing that's held this market up is earnings. Josh said the same thing. That's exactly correct. But the price is wrong because growth is not going to be as fast as it was, obviously, the last 2 years, nor is it going to be as fast over the next probably 5 years because you pull forward a bunch of demand. That's not the end of the world. We're not even calling for a recession. You don't need a recession for valuations to normalize.
All right, no recession, but not great either. Shan, you agree?
I understand the point. I mean, we certainly are facing down slower growth, but why wouldn't we be facing down slower growth? We're really looking back and taking a look at 2019 and having that as your anchoring point. And it's not surprising to me, Scott, to see the activity that we've seen in the market over the last couple of days. If we are truly going back to an environment where we have low growth, we're going to be looking for stocks that are quality, that have free cash flow, and that can grow on their own in disruptive, innovative ways in order to compensate us for perhaps that slower economic growth. However, I think that we're setting up a backdrop comparing ourselves to 2000 and 2008 that's really inaccurate. We have a much stronger labor market than one would expect coming out of the pandemic. Some of that demand has been pulled forward, but frankly, with the supply chain constraints that we've had, we haven't been able to alleviate that demand pull forward and meet that as of yet. There's continued manufacturing investment here in the United States that's very different from 2018 and 2019 when we were essentially in a manufacturing recession. And so I think there's a lot to be said for the second half of the year. I think that why you're seeing this strength in the equity market is that this story right now was the one that we were preparing for. We were preparing for first quarter volatility based on coming up into the Fed, in the tightening cycle. We were not prepared for the war in Ukraine. And so I think now what we're doing is that we're realizing that we're going to see a war of attrition in Ukraine, and it probably is not likely to spill over into neighboring NATO states. And so now investors are taking a look at their portfolios and saying, wow, yeah, the yield curve is going to continue to steepen eventually, but in this interim, stocks are really the best play for this year, even in a slower growth environment.
Eric, last word to you, then I'm bouncing.
Sure. So, I mean, earnings have now peaked in our opinion. And so we've seen earnings rise, over 35% in terms of estimates over the last year. We think that is over. So if you go into a slower growth environment of, 0 to 1% growth, we think based on the input costs for corporations and where margins are right now, that earnings could actually turn lower. And I think once earnings turn lower, the earnings multiple that the market puts on these earnings is going to fall dramatically along with the Fed continuing to be hawkish. So we think it's certainly a rough picture from here.
All right, we'll see what happens. Appreciate the time from you both. Shannon Sakosha, Eric Johnston. We'll see you soon. Now to our Twitter question of the day. Which stock will hit a new high first? We mentioned Apple's rebound, NVIDIA holding its investor day today. Which one is going to get back to its highs? NVIDIA has a little bit further to go from a percentage standpoint, but tends to jump by leaps and bounds when it moves. Want to know what you think? At CNBC Overtime, tell us. We'll bring you the results before the end of our program. Now to one of the world's best ever investors. Billionaire Carl Icahn is with me live for an Overtime exclusive. Welcome to the new program, Carl. It's good to have you on.
Good to be on, Scott. Good luck on it.
Thank you very much. I wish we were seeing your face, but we'll take you however we can get you. And it is really okay. the trillion-dollar question, Carl, of where the market goes from here. And I think it pretty much boils down to whether you think the Fed can engineer a soft landing. Do you?
Yeah, I really don't know if they can engineer a soft landing or not, but I sort of agree with Eric there that I think we do have a lot of trouble ahead. When it happens, I've told you this many times, on the short term, I don't think anybody can really predict it. I think there's just too many variables in this type of a market. But one thing I did learn many years ago, you don't fight the Fed. And now the Fed, I think, pretty much has turned. And when you don't have the Fed put, that's a whole new dimension that's brought to this market. And you have a lot of people in this market, a tremendous amount, more than I've ever seen, that have no idea what they're doing. I mean, the market is not a gambling casino completely. There are people in this market that do have an edge, and you have so many people out there that really are gambling. So I think there's going to be a rough landing. That's what I think, but that's not my area of expertise, really. I look for these companies that are tremendously undervalued, and where we can bring in activism, and where we can get that big edge, and. So it's, I just learned it's very hard to predict it, but I do think in the long run, you've seen this movie before in some respects, and I know you're a movie buff, and in your heyday, Paul Volcker had to do what he did to crush inflation. Do you think, and do you have confidence that Jay Powell is up to the task? Well, I think he says he is, and I think you have to do it. I don't think there's a choice. Inflation is a terrible thing when it gets going. You can't get that genie back in the bottle too easily. We saw it in the 70s. We saw what happened. And I think at this point, we have, with the supply chain problems, and because our companies are so badly run, with many exceptions, we really don't have that supply. In the last 20 or 30 years, you had this... through the 80s and 90s, you had cheap goods coming in from the Far East, from China for sure, and even from Russia. So you got that great advantage for our society. People would take the dollar, and people would use that. And so all these countries wanted the Yankee dollar. And as a result, you really had cheap goods. And I think those days are over now. And you have this war going on now, which adds another problem to your inflationary picture. So, but you know what? That's not my expert. It really isn't.
No, but you have. Look, you have positions in a large swath of American business. So you see things that others just don't have the vantage point to do. Coupled with the experience you have from the decades you've been doing this, do you fear that we're heading towards a recession? Because that's going to impact the kind of investments that you either have or the ones you may make in the future.
Yeah, look, I think there very well could be a recession, or even worse. I really think the one thing that I do have experience in, and I will tell you sadly, that our companies, when we sit on a lot of boards, I don't, but I have delegates on those boards. And some are good, and some are fine. But when you get to understand what these boards do, the system
is needing fixing. There really are. There's no accountability in corporate America. You have some very fine companies, there's some very fine CEOs, but far too many that are not up to the task that I think is going to be necessitated. So I have that experience, I guess. And then I tell you this, I have kept, and I think we would have done a lot better, but I have kept everything hedged for the last few years. And I think now that we do have we have a strong hedge on against the long positions that we try to be activists in and get that edge. So that's the way I look at it. But I am negative, as you can hear. Short term, I don't even predict. I just.
But I mean, you said it though. You know, you have been predisposed to be negative for the last few years in the market. You've taken that view. You had once talked about, you know, your worries that high yield would blow up at some point. Do you share those worries today, or have you moved past, and inflation now is the primary worry that you have, and all of the implications, negative for sure, that come with that? What's the one area of the market you're most concerned about, if there is one today?
Well, we have a very large position on shorting the malls through the CNBC through a derivative. And that whole market is a huge market. I think it's got a lot of the market itself, I think, is manipulated to some extent. And you're going to be hearing from us on that in that area. But that is an area that I think has problems, certainly in the B and C malls and in other real estate. I mean, you can't ignore the fact that, and I don't know if this is a change that will continue, but you don't have people going to offices all the time anymore, obviously. And I think that is going to militate against the real estate area, perhaps. But, I mean, there's a lot of different areas that we go into. We just find companies that we feel are undervalued. Like, for instance, now we're in a fight for SWX. It's a utility, Southwest Energy.
That's Southwestern Gas. And you've been embroiled in a pretty good battle with them. The latest news, of course, is you raising your tender to $82.50 from $75. They say they'll review it. Do you have any indication of whether they'll accept it?
Yeah, I don't think they will, but, you know, they're the quintessential example of what's wrong in corporate America. I mean, you really don't have accountability. I mean, here's a company that has, for 7 years since this guy has been CEO, the company is only up, I guess, 10%, while its peers are up 40 or 50% of the stocks. But worse than that, they really, the agenda in that company, and many, in fact, is they're not on the same incentive program as a shareholder. And they in fact, own, they and the board, Hester and the board own very little stock. We think the stock is worth, you know, from 114 to 160, something in that area. And so the problem you have there is very literally just poor management. I mean, the one asset there is if you got the management out of there and stopped empire building, you would get a much better return in the market. You would be able to, in a utility, you take the rate base and you get a multiple on it in the market. And in this case, the multiple is only like 1.2, and it should be. The peer group is about 1.7. Now that's a major move. So this stock was selling when we bought it in the 60s. I think it's up mostly because we're there, you know, making our tender. So we find companies like that, and we hope that we can have an influence on it.
So let me ask you this. I think we learned from a recent documentary that is airing about you, how fierce you are as a competitor, but also when you know that maybe it's time to walk away. Is there any scenario here in which you would just walk away?
Yeah, no, I don't think so. I think here. We're here to see how this tender works out. I mean, the shareholders have a simple option, really. They vote for us and take the tender offer, or basically they don't take the tender but vote for us. And if they vote for us, we're going to clean up that company as we've done in the past in many companies. But in this company, I really think it's a sort of simplistic thing. You can't empire build, and you have to stop the SG&A growing and growing. Since Hester's there over the last 6-7 years, stock hasn't really gone up, but SG&A has gone up 37%. I mean, he's been criticized by the reg agencies quite a bit. And I'm not saying he's a bad guy. I just say that I think he's well over his head, and I don't think he understands that there are people he has to report to. The board certainly doesn't hold him responsible. But if you simply look at this company, for instance, on the one hand, he will tell you that my bid when I made 75 or 82, I'm sure they'll say that it's inadequate. And yet they put themselves in a position that they have to sell $1 billion. Well, you're saying that they have to sell $1 billion of equity. And
for
if they sell $1 billion, it's sure, yeah. When he said that, it was 62, so he was playing it at 65. So he said, well, I'm going to have to sell $65 of equity. I put you shareholders in this position that I have to sell it because he made a terrible acquisition just recently. And so on one hand he says that, and the other hand he says, well, you're 75 shareholders. Don't take it because it's inadequate. And he's probably going to say it's inadequate at 82.50, I would imagine.
Do you foresee a scenario in which you would go higher than 82.50?
I'm not going to discuss that on TV. I'm not going to discuss that on your program. Well, you know that, but you have to ask, right?
Of course. I don't like to spend other people's money either, but I do have to ask.
Right.
Carl, do me a favor. Sit tight if you would. I'm going to take a quick break, and we're going to come back. We're going to talk a lot more with Carl Icahn about some of the other positions he has in his portfolio. We're back with this Overtime exclusive in 2 minutes. All right, we're back with our Overtime exclusive. Billionaire investor Carl Icahn joining us today on the phone. Let me ask you one more question, if I could, Carl, about Southwestern, and then I'm going to move on to some other topics that I would like to cover. I mean, what's the end game? How's this all going to play out? It's just simply going to come to the proxy vote, and that's going to be the end?
Well, I hope so. And I can't speak for what the company is going to do, obviously. But I do think it's time that shareholders get the right to choose what they want. I mean, it's a clear option for them, and I don't think the company has the right to tell them we're not going to let you do it. And they did put in a pill to stop it, but that's not a condition in our minds anymore because the shareholders vote them out. The new board, we're basically independent, but I haven't even met the guys of the new board, but they're all responsible guys that know the utility business. So basically, the pill would be thrown out, and they would have a chance to collect their $82.50 or stay in a company that I think will be infinitely better managed than it is today, with a board that does know the business and does care. So I'm hoping it comes to that, and I'm hoping that we win it. And I think we will, because I don't know why a shareholder should take the third option, which is keep these guys. And so this is where I hope it ends up. So we hope to buy it. Look, obviously the company has other choices here, and so I don't think they're ready to certainly say, well, go ahead, shareholders, and throw us out. But I really think that the shareholders, I mean, at least every shareholder we talk to, feels they've done a terrible job. So
we'll follow it. We'll follow it and see what the end game is. I mean, the stock is up 2.5%. In overtime here as you're talking about it. Let me move on to Oxy. You recently sold your entire position. Why?
When you say sold it, I have had that company for several years, and I do believe that the company is a good company. It's operationally, Vicki Hallam's done a good job. Steve Chasen, who was the chairman, who came in to sort of save it when I still think the acquisition was very badly ill-timed and what have you. But I'm happy that, we had a big loss in it when we bought it because we never believed that the board would allow that acquisition to go through of Aramco. But now, it's really a bet on oil prices, and oil has gone up quite a bit. And if you really look at it before this war with Ukraine, oil, I believe, and I'm no expert on it, but just listening to experts on it, I believe that oil was fully priced, and we'll see what happens. But it's all dependent on what the government does too. I mean, the government certainly has a lot to blame on for these very high prices in gasoline, and you can't tell an industry we're going to punish you if you go look for oil, and then come around and say, oh, please go and explore now and spend all that money for exploring, and then you have members of Congress saying we're going to tax you, we're going to put a super tax on you. However, like all things go way up and way up very quickly. They come down, and that's not my business. I mean, my business is really be an activist. So there's no activism done in Occidental anymore.
I was wondering, though, and I was going to ask you specifically if this was a bet on oil that had come so far in a especially short period of time, and you figured that it had topped out, and it appears from what you're telling me now that is the case. It is noteworthy, and I wonder, what you're thinking as you're selling and Warren Buffett is buying. And he's probably buying some of what you were selling. I'm just wondering how you thought about all that as it was unfolding.
Well, he's a tough guy to disagree with. I mean, look at his record. And I don't know that we disagree completely. I think we're certainly, to a certain extent, in a different business with Warren. I'm an activist. I look for a company that's in my mind, way undervalued, such as SWX. And then there's something I could do about it. That's what I enjoy doing. That's why I come to work every day. And so we don't really just build a portfolio for the long term with a lot of capital. We look for the moment to strike. And, of course, I might have made a lot more money if I kept the Apples and the Netflixes that we bought. But we bought them and we made a big profit on it. And now, interestingly, we were losing on the activist play in Oxy because we never believed that they would even go through with it. And as you know, I mean, it's public record. We turned that loss. It's in Occidental stock. we've made well over close to $2 billion actually in the stock, and we brought to. And as an activist, I think we did one very good thing. That stock was so cheap that we got the board and Steve Chasen, and he agreed to do these warrants that we put out. I mean, those warrants, the shareholders could really have benefited from it. Probably many did. Those warrants were $1, and now they're selling at around 35. So, you know, so I have a complicated hedge on it still. You know, where I own the warrants and short some stock against it and short calls against it. That's my old days. You know, I was an arbitrageur for a while. And
yeah.
I love to play with those derivatives. So that's one of the plays I'm in. But
I mean, the stock went from 10 to 62. Your point's well taken in the long road that you had been in Oxy before you got out of it. Let me ask you this: McDonald's. What's that really about?
Yeah.
I mean,
okay,
200
well, that's really
shares. It's,
yeah.
You know,
we're not doing that. I'm not doing that to make money. I'm in McDonald's because it may sound sanctimonious to you, but you know, we're a country that really doesn't like or hates, I'd say, unnecessary cruelty. And I really hate it. I mean, for some reason, emotionally, I'm not trying to be sanctimonious, but emotionally, when you read about what they do to these animals, the unnecessary torture and cruelty really bothers me. And whenever I could do something about it, I try. And now I think there's a way to do it where, I mean, you take gestation crates with these pigs. I mean, these pigs are animals. They're feeling animals. They've got good brains. And I certainly don't own any pigs, but, you know, I own dogs and whatever. So I sort of love animals. And it really bothers me to see this unnecessary cruelty. And you have a board at McDonald's where McDonald's has a lot of gravitas, and they could do something about it. So my daughter worked for the Humane Society. She's a little chip off the old block here. And she worked for the Humane Society 10 years ago. And then she called me and she said, you know, we can't get through to McDonald's. And if we could get them on our side to stop the gestation crates, you know, that would be a great victory. They will call us back. I said, well, they'll call me back. I'll bet on that one. So I called the CEO, and he called me back in, you know, one day. And he said, Carl, look, you know, we hear you. We hear you. And we're going to make a promise to you that within 10 years, we will not buy from any producer that has gestation crates. These gestation crates are the cruelest thing you ever saw. You take this pig for its whole life, you know, it's only going to live 4 years, the sow, and you put them in a cage where they can't move. And the pig never did anything to you. I'd like them to put a tiger in there. I'd like to see what happens to him. So they put it in that cage. The pig can't move. They treat it cruelly its whole life. And it's like a machine to make piglets. And why do they make it? It's unnecessary. It's completely unnecessary to do this. I mean,
so let me just read this. I mean, they say they're on the road to making changes, and they say, and it's a fairly long quote, so bear with me if you would, but I think it's important to read it. They say, despite McDonald's progress, Mr. Icahn has instead asked for new commitments, including to require all of McDonald's U.S. pork suppliers to move to, quote, crate-free pork, and set specific timeframes for doing so. While the company looks forward to promoting further collaboration across the industry on this issue, the current pork supply in the U.S. would make this type of commitment impossible. Furthermore, it reflects a departure from the veterinary science used for large-scale production throughout the industry and would harm the company's shared pursuit of providing customers with high-quality products at accessible prices. That is McDonald's official response. I think it's important to get it on the record, Carl.
Yeah, no, it is important, and it's completely hypocritical. It's a lie, because there are many farmers today. Actually, what they're doing here is completely the antithesis of the ESG. And if you look at ESG, they say that you have to have some commitment, some feeling about when you talk about, you know, start the environment. Factory farming is terrible for the environment. All right. You get huge amounts of methane in concentrated areas. And it's also really, I believe, causes a lot of disease. And not just but experts in this. When you keep these pigs confined that way, together they're in these crates, they get these diseases, they fill them up with antibiotics. Your kids, the people out there, as kids, are eating this meat that's got antibiotics in them. And in the areas they're in, the air quality is very bad. I mean, I could go on and on, but I'm not the great expert on it. But everything McDonald's says is completely a manifestation of the fact that the board, and I will say the CEO also, has no real idea about where they're even getting the supply of these pigs. 10 years ago, they absolutely promised to get rid of this thing, get rid of buying from anybody that produced it. Now they're changing their story and saying we're asking for more. We're not asking for more at all. We're asking them to get rid of this problem. And McDonald's
they do say by the end of this year they expect to source 85 to 90% of its U.S. pork from sows not housed in gestation crates during pregnancy. By the end of 2024, the company said.
There's the complete bullshit that they're saying to you, because they say during the pregnancy. Well, the sow is pregnant for a good part of its life. So maybe they'll do this great thing. They'll make sure that the factory farm that's torturing the animal, so it's unnecessary cruelty or torture. Okay, we'll let them out for a week or two. I mean, I've talked to the board, by the way. I've talked to the chairman and whatever, and he seems like a nice guy. But he even told me, he said, I learned about this stuff only in the last few weeks because I'm talking to you. I think the board over at McDonald's, in my mind, is a sort of a rubber stamp board. Look what they did about Estabrook over there. They let him walk away with a lot of money until they had such criticism they had to bring him back. I'm not saying they're bad people. But I'm saying,
would you buy more stock? Would you increase your position and try and exert more pressure if that was a way to do it?
I would tell you this: you always like to know whether I'm buying something or not. And in this case, I am not doing this to make any money for myself, and I don't want to even be seen as owning stock, because I'm saying I am not here to say I'm going to make some money on McDonald's. I think McDonald's has a lot to answer to people that are fans of ESG, because I really think if you look at McDonald's, they got great gravitas, but in a lot of cases, for instance, in the environment, I would say they get an F because of what I've just told you. As far as the social issues go, this is antithetical to any kind of social issues that we're involved in here. And certainly in governance, you have a rubber stamp board. And you've had that for many years at McDonald's. But you know what? Many companies fail in governance. Many companies do have a rubber stamp board, but this is particularly one. For instance, they knew 10 years ago we had this promise. They never even looked at it again. Okay, so that's one thing. But the rubber stamp board in many other areas, too. Just the Estabrook fiasco shows that. And we're going to bring all that out in the next few weeks or the next month. And then, hey, let's see what they do. Let's see if they give a damn. But you know what? I really find that it bothers me, and I'm not going to tell you I'm here to, change companies and change the world. I do what I do, but I think I do it well. But when something like this comes up, it's more than just McDonald's. It's the fact that they have so much corporate hubris that you can't tell McDonald's what to do. And these animals are suffering day and night, 24 hours. They're suffering, and these guys just don't care. And that's what bothers me. And by the way, they told the Humane Society, this is why I got in again. So 10 years ago, they promised to do it. I said, great. My daughter said, oh, great victory. She left the Humane Society many years ago. But they did call me up, and they said, they just broke their promise. We tried to talk to them in 2017, which was the date that they were supposed to talk, and they just won't talk to us. And they just blatantly told us to go fly a kite. They told us, hey, too bad that we have a promise. We're not keeping it. That's what they told them. So I said, okay, that's it for me. And that's when I got into it, all right? And I said, all we're asking, and they said what you just read. We're going to do this, this, and this, and this. I said, well, okay, I want to verify that. I said, well, they really literally say, trust us. I said, how can I trust you when you didn't do it for 10 years? And
we'll stay on.
Right.
We'll stay on top of the story.
There's going to be we're going to. Hey, you'll be hearing from us on that, and this one is a freebie.
Okay.
This one is because I care about it so much. Okay.
Carl, right. I'm gonna leave it there. I really appreciate you joining us in Overtime, our new program. It's nice to talk to you again.
Okay, good talking to you, and good luck on it, Scott. Good luck. I'm sure you'll do as well in this one as your other one.
I appreciate it very much. That's Carl Icahn joining us in an overtime exclusive today. It's time for a CNBC News update with Shepard Smith. Hey, Shep.
Scott first. Mayor McCheese on line 2. And here's what's happening. Supreme Court Justice Ketanji Brown Jackson grilled by Republicans, supported by Democrats, as she faces the first round of questioning in her confirmation hearing. Judge Jackson questioned extensively about the role of court precedent, her sentencing of child sex abusers, critical race theory, and her time defending Guantanamo Bay detainees when she was a federal public defender. That hearing is ongoing. More U.S. troops may be permanently deployed to Europe. Several sources telling NBC News President Biden could make the announcement on his trip to Brussels for a NATO summit over the war in Ukraine. We're told no final decision has been made. And parts of Texas battered with tornadoes. The severe storms ripped through the southeast tonight. The National Weather Service says 5 million people are now under severe tornado threat in Louisiana and Mississippi. 75-mile-per-hour wind gusts predicted. Tonight from Ukraine, we'll talk to American fighters serving in the war after volunteering. Some of them already injured in combat. Their stories on the news right after Jim Cramer, 7 Eastern, CNBC. Scott the McRib, though, that's still very good food.
Yeah. Oh, boy. Shep, thank you. We'll see you at 7 o'clock. That's Shep Smith for the news this evening. Up next, betting big on Gen Z. One Wall Street firm is getting bullish on Block. It's today's MVP, our most valuable pick. We'll discuss it with the analyst behind a call next. Breaking news in the OT on Starbucks. Our Kate Rogers has the latest. Hi, Kate.
Hi, Scott. A Starbucks store in Seattle has just voted in favor of unionizing. The vote tally was a unanimous 9 in favor of forming that union with Starbucks Workers United, with 0 against. Now, this is the 7th Starbucks store we've seen that has voted yes in favor of organizing. 5 of the other stores are in Buffalo, where this all began, a 6th in Mesa, Arizona, and now the first one in Seattle, Starbucks' hometown. More than 130 stores across 26 states have now petitioned the NLRB to seek votes on unionizing. This is something that new and incoming CEO Howard Schultz is going to have to take on in April when he takes the reins over for Kevin Johnson, who is leaving that post at Starbucks. And just a reminder here, Starbucks does have to negotiate a contract in good faith with the union, but neither party has to agree with something. So yet another unionized store here, little stock reaction, but notable again for the union, another win. Scott?
No doubt. Kate Rogers, thank you. It's time for our MVP, our most valuable pick. Block is rallying today. Why? Because Mizuho raised the price target on the stock by $10 to $190 a share. The analyst pointing to strong adoption of Block's Cash App among teens. Let's bring in the man behind the call, Mizuho's Dan Dolev. It's good to see you. Welcome.
Thanks again, Scott.
You know, you raised the price target by $10 to $190. I mean, the stock was trading at $290 before. Is this a sign you don't think it's going to get back to those levels anytime soon?
No, what we wanted to do is we wanted to, we look at valuation very carefully, and I think the market is actually very focused on valuation. So we, because of this is early data, these are early days of the Cash App for teens or Cash App for 13 plus. We wanted to make sure that we don't overestimate the impact. But if you ask me, I actually think the real impact is going to be much bigger. But we wanted to see how it goes over time. But I think that we wanted to make sure that we actually, look at the data, interpret the data, and kind of see directionally where it goes. So obviously, we love Square, and 190 is hopefully just a start.
Yeah. How much is the company growing beyond Bitcoin, growing its revenues, which frankly I didn't realize until I was doing research for this segment, that Bitcoin is half of Square's revenues. So it's so tied to Bitcoin at this point, which remains especially volatile.
Right, and I think that's actually something that a lot of people are missing. That it's a big part of Bitcoin of the revenue. But if you think about the way we look at it, the way the market or investors look at it, they look at it on a gross profit basis, and the margin they make on Bitcoin is very, very small. So while it's levered to Bitcoin on a revenue basis or volume basis, Bitcoin really only accounts for a very small, single-digit % of gross profit, which is the way to look at it. And the other stuff, right, the seller business, which they now call Square, which is point of sale, Cash App, which was what we're focused on today, and the Afterpay business, those are like the real growth engines of the company.
Dan, we leave it there. Appreciate your MVP today. That's Dan Dolev joining us. Coming up, we're talking tech. Does the recent rebound still have room to run? We're going to break it down in today's halftime overtime as one trader on halftime makes a bunch of big call buys. We'll debate that next. In today's halftime overtime, the sharp rally in tech and the surge of options activity that Pete Najarian highlighted in some of the mega caps.
Now they're coming back again for Facebook, and they're coming for the 220 calls and looking at huge size. And we are seeing huge size trades across the board. AMD, a buyer of 50,000 of this week's expiring 120 calls. Microsoft, we were seeing upside. They're going actually out to April on the 320s in Microsoft. Stock was trading at the time just beneath 300. So it gives you a little bit of an example of what we're seeing, the kind of volumes that we're seeing, these size trades that are coming in.
Oh, the bulls are running. Let's bring in Arius Asset Management CEO Carrie Firestone, see if she thinks this tech rally has legs. Carrie, it's nice to talk to you. What do you think? I mean, the bullish activity that Pete highlighted today was pretty impressive, and you have a lot of positions in tech, from Apple and Microsoft to Alphabet, Twilio, et cetera.
Yeah, exactly, Scott. Thanks for having me. Well, this market got oversold, and as Pete has suggested, there are buyers that are now starting to rush. In the first couple of days of this rally were light volume. Big numbers going up, but not a lot of volume, and we needed to see the volume to see some follow-through. We know that the market's still unsettled because of Ukraine, because of inflation, because of interest rates, but there was so much decimation. The Nasdaq down 23%, the S&P down 13%. It was bound to happen that names like PayPal, Twilio, they're up 25% now from the bottom. Facebook, 16%. Adobe, Autodesk, 15%. The S&P's up 8%. And this is a strong reaction to what is an oversold position that may or may not continue to go higher. I mean, this 8% move on the S&P is a lot. So we have to be careful. If you want to keep buying, do it carefully now, because a lot of the easy money has been made, and now you have to be careful and pick your spots.
Yeah, now it's time to work real hard for it. Carrie, I appreciate it. That's Carrie Firestone joining us in halftime overtime. Up next, Santoli's last word, why it's not an all clear for the Bulls. Coming up next, it's Santoli's last word, plus our 2-minute drill, 2 healthcare picks, an opportunity in one old school tech name as well. Overtime, we'll be right back.
Let's bring in Mike Santoli now for Santoli's last word. What do we have today?
Look, it's a tenacious rally. I think you have to respect any market that keeps going up when there's a lot of excuses for it not to go up, like yields today. So all that being said, and we absolutely were primed for a big bounce, here's the thing that maybe are reasons to take a beat. One, right above 1 or 2% above this level, S&P 500 is a threshold. The February highs, 4,600 or thereabouts. Even folks who were saying this is a downtrend, any bounce up to that level, I'm still not going to be convinced. That's still out there. Consumer discretionary, not really leading. Broker dealers, all these little, kind of nagging issues where it's not fully in gear. Again, I say no all clear, but you know what? The great V bottoms of history, you didn't have an all clear until you were up a lot, right? So it's never going to be that easy.
You fixed some technical damage.
No doubt about it.
The VIX has been going down for, 6 days in a row. So you're like checking off the boxes of things you want to see happen.
But you have to be able to see both sides.
Yeah, good stuff. All right, that's Mike Santoli with his last word. Up next, our 2-minute drill. We're back right after this. Joining us now in our 2-minute drill is Profit Investments President, CEO, and Portfolio Manager Eugene Profit. You're on the clock. Welcome to Overtime. And your top pick today is mRNA, better known as Moderna. Why?
Well, Scott, it looks like a Johnny come lately, Moderna being up 6% today. But if you look at Moderna, you're looking at a stock that's a 6 PE. It has a product that's going to be in demand as the need for viruses is going up. They're combining vaccines to where they're trying to create a flu vaccine with the COVID vaccine. And finally, the U.S. government contract is up in April, and so they might have a little bit of pricing power, even though it'll be a little bit difficult. The fact is that the U.S. government will buy more vaccine, and there will probably be a fourth booster. So at a 6 PE, we're very high on Moderna. That being said, we were also high at the beginning of the year, and the stock was down about 55%. 30% of the return has come to the last 5 or 6 days. So you're still down 20%, but we're in the stock for the next 3 to 5 years.
I'm sorry to interrupt you. They have their vaccine day coming up, too, which maybe the stock is running a little into that. AbbVie was one of your other picks. But tell me about Intel. And maybe that's one of the most controversial, clearly. I mean, stock's going from 68 to 48. Why should I think it's going to get back?
Again, a 10 PE with non-recurring revenue forward. Essentially, they invest in the foundry business. I think that this will be in deglobalization as we try to bring chips back into the U.S. and Intel is well positioned. They have great clients with Qualcomm and Amazon. And a quick note, I mean, 13 years ago, I was on Halftime Report and I was touting Microsoft and getting beat up the same way I'm about Intel. So hopefully history will repeat itself.
I hear you. We'll see you soon. Thanks for being here. The Twitter result, Apple or NVIDIA back to its high? Apple. Big shock that you voted that way. That does it for us. I'll see you in overtime tomorrow. Fast is now.
Live from the NASDAQ market site overlooking New York City's Times Square, this is Fast Money. I'm Melissa Lee. Tonight's trader lineup, Guy Adami, Tim Seymour, Jeff Mills, and Dan Nathan. Ahead on Fast, Baba Bounce. Shares of Alibaba keep climbing, up nearly 50% in the last week, now almost back to even for the year. The Chinese e-commerce giant announcing a $25 billion buyback. Is this a bullish sign for investors? Plus, Elon Musk busting a move, literally. As he opens a new factory in Germany, it is the first manufacturing plant for Tesla in Europe. The stock rebounding from its electric slide, now up 20% in the last month. How big a deal is today's ribbon cutting for investors? And later, a fast pitch, a new face to us. The Fast Money tells us why he is teeing up this golf stock that's been in the rough for most of the past year. Will it be a 4 or a hole in 1?
Wow, Mel, that's brutal.
We can't fit any more puns in there. So we will start with another sea of green on Wall Street. The S&P notching its 5th day of gains in 6 sessions. It is now up a whopping 6% since its lows last Wednesday when the Fed announced its rate hike. And the threat of even higher rates coming even faster has not slowed anybody down, not even big tech. Just take a look at the gains since Wednesday's bottom. Amazon up nearly 12%. Meta up more than 11%. These 5 companies have gained a combined $780 billion in market cap in that run. And what's doing even better than tech? The consumer discretionary names leading today's rally up nearly 2.5%. So as the market come to terms with higher rates, it looks like everything's coming up roses. The Fed has got it under control. Either that or the headwinds will abate. Dan Nathan, things are great again.
All right, I'm going to one stock. We talked about Nike last night, and everybody was enamored with their earnings in such a difficult environment, and the guidance that they gave, and the stock was up like 8%. It looked like it was ready to party, right? Did you see where it opened today? And did you see where it closed? It closed on the dead low. If the stock market was open another hour, it would have closed down on the day. I think that's a bit of a preview of what we're going to see as we get through the end of Q1 into what might be a disappointing pre-announcement season. We might see companies come out and say, hey, listen, and I'll just tell you this, they kind of have a mulligan to keep with your golf theme. Do you know that's a golf thing?
Nice job.
No, I don't know if you did that.
Nice job by you.
Because of the uncertainty that's going on with Europe and supply chains and all this stuff. So to me, listen, this was a technical sort of reversal. I don't think any of us were pressing the lows a week and a half ago. It was a sort of sell the rumor, buy the news into the Fed.
I was not pressing the lows. I do think, though, that I've been not constructive on the market's ability to hold this, so I'm with you on a lot of this. I will say, though, I'll push back on your Nike and say that the triple Qs, so the NASDAQ 100 closed at the highs. And we're up 12.75% off those intraday lows from last Monday. And this was, again, on a day when rates kicked higher. So my caution is not to dismiss Dan's caution, which is I agree with this. Q1 earnings are not going to go well, and the guide's not going to go well. But I'm more worried about the market interpreting Jerome Powell and Evans and all these other, and Bullard, who have gone out there and said maybe you could get 50 basis points as a sign that the economy can withstand that, when these are the same people that told you there was no inflation up until November. So I don't think we should listen to the Fed and have the market take off and interpret this as the Fed is telling us the economy is resilient, it's strong, and we're good here.
Can I ask you one question, though? So when you think about the price action you just mentioned in the broad market, it seems very algo-driven. And then if you look at a single stock that has a lot of news in an environment where there's not a lot of single stock news and it acts the way it does, that to me is maybe more telling, especially as we get into a quarter end. And it was a very bad quarter for the broad market if you think about historically. So maybe we see a little bit of a mark.
Yeah. Jeff Mills, what's your take?
Well, there's a lot going on right now, but I think there are a couple interesting things that I wanted to highlight. First of all, it all comes back to the Fed and interest rates. I keep saying that, and it feels like now that the Fed wants to tighten until something breaks, and either growth is going to break or inflation is going to break. And I just think the chances of growth breaking have increased, and you see it in the curve flattening. I think we're probably in for more of that, unfortunately. And I think the interesting thing about all of that is that every time the 2-10 spread goes to zero, the 10-year Treasury rate starts to fall. So I keep saying, yes, we're closer to the top than anything else in the 10-year. Sure, could we go to 250? Of course. But I think ultimately rates start to back off. And I think maybe that's what you're starting to see right now in market leadership. We've been talking about this idea of growth as defense, right? And we've seen growth outperforming value even as rates have moved higher over the past couple of weeks. So maybe the market is starting to sniff out this slower growth, slower earnings growth. That's what we're all talking about. And investors are starting to huddle into these areas where they believe companies will be able to maintain at least some semblance of earnings growth. And just to wrap it all in terms of the broad market, you know, we are rallying right now, but it's not necessarily from a position of strength. This is not like the rally that we saw in November of 2020. That was sort of the last week where we saw a 6+% move. You have 50% of the S&P above the 200-day, 40% of the triple Qs above the 200-day. Those numbers were 72% and 84% back in that November of 2020 rally. So it just feels like a very different market, and potentially we have more to go on the downside.
I get all that, Guy. But you always talk about trading the market that you have. The market that we have today, at least, and over the past week, has been telling us risk on. I mean, take a look at the movement in the, dare I say it, the meme stocks today, in Bitcoin, in Ether, in ARK, all of these high valuation risk on sort of names all rallied. What does that tell us?
Not quite sure. I mean, you know, the guys talked about not pressing it. I'll flat out tell you. I mean, I thought the market was going to sell off meaningfully, you know, late last week into this week. That clearly hasn't happened. And, you know, I still think at some point that 3750 level in the S&P's sort of got a bullseye on it. But, you know, Dan coined this phrase a couple of years ago that the market was crashing higher. And I've talked about it. You know, typically we put panic in front of selling, but I would submit the last week, week and a half, we've seen panic buying. I mean, people just fleeing, just basically running in anything they can get their hands on, thinking the worst is behind us. I don't think they are. I mean, bond volatility, just for, you know, S's and G's, as they say. I mean, 10-year yields were 165 a few weeks ago. I mean, it's 240 now. I mean, that's an astronomical move. The S&P has rallied 340 or so handles in basically 8 or 9 trading days. I mean, does that make a lot of sense? Not in this backdrop, because quite frankly, the problems that we were talking about a month ago have not abated. If anything, I think they've gotten worse.
Can I throw this scenario out? I feel like I need to play the role of the bull in this conversation.
You can do whatever you want, by the way. I mean, you run the show here, so.
That is true. I could really do whatever I want. Yes. But let's say that the markets believe that the Fed has this under control, that they're going to fight inflation very hard, that they're willing to go to 50. They're willing to go to 52 times, according to Goldman Sachs in the May and June meetings. That if the Fed doesn't do that, it's because inflation has abated. Maybe the Russia-Ukraine conflict ends or gets resolved in some fashion, and those inflationary forces die down. Tim, I mean, could we be seeing actually a rally for a reason?
Well, I just think that the market, the equity market, doesn't understand that, first of all, you get to 250 on the 2-year, you've essentially broken the downtrend of 4 decades lower on rates. And if you look at that chart going back 40 years, you can see, and you know, we can overshoot, we can undershoot. It's that kind of a trend that I'm not going to tell you in the sand. I would also say that if you look at a 2-year note and you look at a 20-year chart, we're essentially, rates are higher than they've been, you know, almost 95% of the time over the last 15 years than they have been. And there's a direct impact on consumer credit, revolving credit, and things that I don't think the market really has a chance to assess yet. So where is the economy going to be in another 50 basis points or 100 basis points of Fed hikes? I think that that's something that stocks are going to have to wait for, even though they are a discounting mechanism. And that's why I would not trust a market that thinks Jerome Powell referencing 50 basis points is bullish for the economy. It's not.
Yeah, and I'll just go back to the last rate hiking cycle that we had back in 14, 15. You know, we're all up into that 2018. I mean, they got the 10-year U.S. Treasury yield moved up as the Fed funds moved up in a pretty steady sort of manner. And there were definitely some growth scares here and there. If you guys remember 15 and 16, you also remember crude oil going down 65% as the dollar was rallying too. So what's different now is that the pace in which they are doing it. And we remember the last time the 10-year U.S. Treasury yield was above 3% in late 2018, the stock market did not like it. So here we are. We have an S&P 500 trading about 19 times. That's basically in line with a 5-year average. It's above the 10-year average about 17 times. And I'd say this, if you're looking for a sentiment indicator, I'd say you'd want that to dip below the 10-year average, right? And there's a couple ways it could get there. I just don't think that we had the max pain, the horrible sentiment. It happened too quickly, given the uncertainty that we have in markets and given right now what is a certainty about a Fed that wants to battle inflation. And as BK said last night, the only way they really do that in such a fast pace is to slow the economy. And I don't think the stock market, S&P in particular, down 5% on the year, people, after up 26% last year, discounts that.
All right. Our next guest says he's got some ways to hedge against the Fed's additional rate hikes. Let's bring in Jason Trenner, chairman of Strategas, a Baird company. Jason, great to have you with us. You've got a new ETF out, relatively new, and basically it's sort of defensive and it plays inflation. Can you sort of walk us through the timing of this in terms of, you know, how this illustrates what your market forecast is?
Yeah, well, just listening to the guys and you, I have to say I'm uncharacteristically cautious on the markets now because I think the Fed is well beyond, is very far behind the curve. Probably has at least 6 or 7 more tightenings, perhaps until something breaks. And so we have a SAMT, Strategas Macro Thematic Opportunities Fund, which plays both higher inflation and also gets somewhat more defensive in terms of cyclical defensive companies that have strong correlations with staples but aren't quite staples. And then we also have companies that play quantitative tightening, higher inflation. The one theme that's not working out quite as well is a return to travel and leisure, travel and entertainment stocks by businesses. But that is the theme. Those are the themes that make up that ETF.
Just curious, Jason, how do you think about some of these inflationary pressures that we're seeing on various commodities and input costs if the Russia-Ukraine conflict ends? Does that go away for the most part, or do you think that sanctions remain on and this inflationary pressure remains?
I think commodity price inflation is only one part of it, Melissa. I think you have rents, which generally tend to follow home prices. Home prices were up about 18% last year. You have wages. You're close to full employment. You have 11 million job openings. There's a lot of job openings, especially in the service sector. That's going to continue to put pressure on wages. And then you have environmental policies, and we could debate their usefulness or efficacy or wisdom, but they are going to keep energy prices higher longer than people think, in my opinion. So I don't, even if Russia were to mercifully, if Lord willing, our prayers were answered and the Ukraine situation was resolved peacefully tomorrow, I think there is an enormous amount of the policy mix that you've had, enormous amount of fiscal and monetary policy that still has to get worked off. So inflation, I think, is going to be with us for a long time. You can't really call it transitory if the Fed has to slam on the brakes to stop it. And the Fed had its opportunity to make a forecast on inflation last year. It was wrong. It doesn't have that ability politically this year.
Hey, Jason, it's Jeff Mills. Great to talk to you. I had a quick question. So you guys have some baskets that you track internally. I think they usually do a pretty good job of giving us an idea of either where the economy's going or something relative to policy. So you have your reopening basket and companies that would benefit from cyclicality reopening. That's sort of uncharacteristically levitated here as the 210 spread has really fallen off a cliff. So talk to me a little bit how you see that basket's performance versus what we're seeing in the bond market.
Well, I think, I would just say that is indicating, as you're pointing out, that the economy is going to be a bit slower. The one theme in the Strategas Macro thematic fund that isn't working is the return of business travel. There's another ETF that we have, which is Global Policy Opportunities Fund, SGAP, and that is focused on companies that do a lot of lobbying. That's doing a little bit better because it has defensive, has somewhat more defensive companies in it. So I would argue that the economy right now, in my opinion, is showing some signs of strain, but I would not interpret that as a reason for the Fed to stop tightening. The Fed does not have a choice now. It is so far behind the curve that it has to continue almost regardless of what's happening in the geopolitical and macroeconomic environment. It really has to focus on its first mandate, which is price stability.
Jason, always great to get your thoughts. Thanks for joining us.
Thank you.
Jason Trennert of Strategas, a Baird company. Guy, that's pretty dire. I mean, we've talked about the box in which the Fed finds itself today in terms of being forced to go down this path regardless of what is going on around it. Do you still say that the consumer will hold up in this environment?
Well, there's a two-part answer. As long as the stock market does well, absolutely, unequivocally, I think for me, and I've said this for years, consumer confidence is just really an overlay of the S&P 500. People feel richer when the market goes up, regardless as to whether or not they own stocks. If the market would sell off in a precipitous fashion, consumer spending stops on a dime. We've seen that over the last 15 or so years, many times over. So I say it, I know you're going to repeat it, never underestimate the U.S. consumers want to spend. It doesn't mean they should be.
All right, let's check out Alibaba shares jumping 11% today. The company increasing its share buyback program to $25 billion. The Chinese e-commerce giant now up nearly 50% in the past week. They say this is a sign of its confidence in the continued growth for the business. Tim, do you buy that?
This is the third time they've increased the buyback since the stock's been in free fall. So this isn't a reason to go out and buy the stock, folks. It's up 53% off those intraday lows on a 5-day. The reason to buy the stock is if you feel the pressure from the Russia regulator is off Alibaba, because there's not a question about the growth. There's not a question about the valuation. We've done the breakdown. We've talked about what you get for free, including the businesses that they really tried to take apart, like Alipay and some of these others, some of their investments. But at 9 times 2023, stock's far from expensive at a time when I still think that the consumption trends in China are not going to disappear. So I like Alibaba. I'm long Alibaba. I'm not telling you this buyback is a fresh round of confidence from management that you should ride high.
Yeah, I would just say this. I mean, other than the valuation point that you point out, and I think that's discounting a lot of stuff that could potentially still happen, I think there's plenty of stocks here in America that are down 70% that have similar growth characteristics. And I mean that quite sincerely. I don't mean to sound so nationalistic. I just don't see, if we're worried about a geopolitical situation in Europe right now, right, where we're seeing all sorts of multinationals banning activity with them, I think you have to be worried about Chinese domiciled stocks.
And I hear you on, I think you're right to think about U.S. stocks. As an emerging markets guy, I always fought this with people. They're like, why do I need to invest when there's corporate governance risk when I can invest at home? Alibaba should be like Google, though. We're not talking about any company. And when I look at Alibaba and I look at Tencent, I think these are two of the most important tech companies in the world, and they're not tiny. I mean, they're massive. So I think you still have a lot of concern around the things we're talking about. But the fact of the matter is investors who do take a shot on some of these names on the long term, I think are probably going to be in a good place. Right now, they're holding back the entire emerging markets asset class as well.
But let's be clear here. I mean, should an Alibaba trade even close to the multiple that, let's say, a Google trades at? Or should there be a permanent discount? And maybe the discount is even greater in its valuation these days because of the geopolitical risk. Jeff?
Yeah, we've been doing a lot of work on this, actually, just thinking about emerging markets as an asset class and how we want to get exposure. And I think the right answer is it probably shouldn't trade right on top of a stock like Google, because you do have this regulatory risk. You do have risk around, variable interest structures and how U.S. investors get exposure to these companies. So there is some inherent risk that I think needs to now be priced in to these companies. And in terms of the move that we're seeing here, not that the valuation isn't somewhat compelling here for a long-term investor, it might be. But at 50% up over the last 5 days, I would probably be fading this. I feel like this is a big sort of negative sentiment bounce. I was doing some work just looking at how different areas of the market were trading. So I looked at KWEB versus ARC, for example. The correlation is over 0.7 versus ARC versus KWeb compared to the triple Qs, for example, where the correlation's far lower. So you're seeing these very low quality, high beta names that just have gotten absolutely destroyed. They're bouncing huge, so I just don't know that that's necessarily sustainable in this kind of a market.
All right, coming up, the Tesla Tango. Elon Musk breaking out the dance moves at Tesla's new German factory, if you can call them that. So is this stock worth grooving into? We got the details ahead, but first, we are all over the after-hours action in Adobe. Shares on the move after reporting results. We go inside the numbers next. Fast Money's back in 2. Welcome back to Fast Money. Check out shares of Adobe falling after reporting earnings. Frank Holland has been listening to the conference call. He's got the latest. Frank.
Hey there, Melissa. Shares of Adobe falling on soft Q2 guidance after beats on the top and the bottom. The call started just a few minutes ago. CEO Shantanu Narayan and other executives really focusing on its Creative Cloud offerings. But as you can see, the stock's still continuing to fall. Creative Cloud, that's part of its digital revenue segment that reported in just above estimates. Same thing for digital experience revenue. Adobe gets 98% of overall revenue from these two segments. Last week, the company also announcing cloud tools to get businesses into the metaverse, with customers like Coca-Cola and NASCAR as some of their first customers in that area. The real issue in the quarter was the guidance. Revenue and EPS guidance both soft, but Adobe broke out its Russia and Ukraine revenues that are just a small part of that pie after the company stopped all sales in Russia, but said it would still work with its customers in Ukraine. Shares are down year to date, double digits. Adobe not benefiting from a lot of that bounce back that other mega cap tech names have seen. Back over to you.
Frank, thank you. Guy, I'll go to you on this.
I think the stock was up $12 today. I think it's giving it back now. And again, one of these things that doesn't make any sense to me. It was not that it matters, but it was a $700 short of $700 stock in November. Here we are at $450. Yes, the second quarter guide wasn't great, but it wasn't disastrous by any stretch. You're still talking about a company that has probably I don't know, 20% EPS growth, trading at 28 times, which I don't think is particularly expensive. I think it's a really important company. And, oh, by the way, their operating margins were really strong. So I think you buy this quarter. And with that said, here it is getting sold off in the aftermarket. Again, doesn't make sense.
Yeah, I don't think you buy this quarter based on the current year that they're in right now. You have a stock trading 34 times, expected EPS growth of 11% on revenue growth of 14%, trading 12 times, people. This is a $220 billion market cap company, which did not give you anything on their guidance, in my opinion. So I don't think you buy it. And if you look at that bounce off of those recent lows, I think we're going to, we kind of got distracted, Mel, in the A block when we were talking about, some of those ARC names.
We always get distracted.
No, but what I'm saying is that's a bit of a sideshow in the meme stocks and the crypto. Keep an eye on these names. Keep an eye on Nike. Keep an eye on the ones that are the ones that are going to break the market back out to those. That's the only thing I care about.
I think it's what we're willing to pay for these stocks, because I don't see churn rates going that much higher in software subscriptions, and I think this is a cash flow machine. So what are we willing to pay for it? I agree that those numbers are expensive, and software stocks have come down a lot, but they could come down some more. But the quality of that revenue stream and the quality of the free cash flow is there in Adobe.
All right, from software to cyber, shares of authentication services provider Okta dropping today on reports of a possible digital breach. FedEx, JetBlue, Peloton, and the FCC are some major customers listed on their website. The stock was down 1.75%. Jeff, you've been following this one.
Yeah, obviously problematic for Okta specifically, but I think overall, this is something we talk about over and over again, and it's cybersecurity maybe being the biggest threat that we have right now to corporate America. Still only 10% of companies' IT spend is on cybersecurity. So a lot of these names, yes, they are expensive, but there's also runway. I think about a stock like CrowdStrike, for example. It's not cheap, but it's certainly gotten a lot cheaper, and it has this massive secular tailwind. You're starting to see operating leverage in these businesses now. You go back to 2018, for example, they were spending 87, 88 cents for every dollar of revenue. That's down to 33 cents. Their annual recurring revenue up 65% year over year. So the growth is there. And you also look at some of these charts. Major downside, CrowdStrike as another example, but fell precisely to that post-COVID high. It's held multiple times, turning higher. And there are other places to look. I think Palo Alto, it's a cheaper alternative. Okta itself, I'd probably be buying on any downside here. So I definitely like the space, especially after the re-rating we've seen in some of the valuations.
So the Biden administration guy has been out and vocal about warning corporate America of possible cyber breaches from Russia specifically. If we could travel in time forward to the future and listen to some of the conference calls on a Palo Alto network and a CrowdStrike and a CyberArk, are we going to hear about increased spend during the quarter because of these potential attacks?
Look how excited he is when he's talking about traveling into the future.
Well, that's why I have to, instead of just asking, are we going to hear, I with Guy, I can only, keep his attention if I can play a game. So play that game, Guy.
Well, first, you're right about that. I like playing games, as you know. First of all, I take umbrage with the if we could time travel. I mean, almost by definition, isn't daylight saving time travel, if you really think about it?
Ooh.
I'll let you think about that for a second and say this. Absolutely, Melms. That was a rhetorical question. You know that on conference calls over the next few quarters, you're going to hear all about the spend in cybersecurity. And listen, this is one thing we've actually gotten right in terms of these names. Palo Alto had a huge day today, another new all-time high. So these names, in my opinion, you sort of have to look past valuation, get your arms around what's going on in the world, and just continue to own these stocks.
All right, we are just getting started here on Fast Money. Here's what's coming up next.
Tesla turns up and Musk boogies down. Why he's rolling out the dance moves at Tesla's new factory. Plus, a fairway fast pitch. Break out your 9-iron. Our next guest lays out why this gold stock is a hole-in-one investment. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money. Check out Tesla surging higher today. The stock is now up nearly 24% in just the last week. This big move coming as Elon Musk declares the company's Berlin Gigafactory officially open for business. Let's bring in our very own Phil LeBeau for more. Phil, you know, Elon Musk has danced before, I'm sure, but I don't know if you ever saw him dance like he did today.
Oh, yes. Who hasn't? Who hasn't? In fact, cue the tape. Let's see it again. You would expect him to be in a celebratory mood now that the Giga Berlin plant is open. That's about the dance moves we usually see from Elon Musk. Look, he's chasing after a little drone that was videotaping him there on the line. This is, by the way, Melissa, the plant's been open for some time, but now they're delivering vehicles from there. And the significance of this is that they can now deliver Model Ys to European buyers instead of importing them from the Tesla plant in China. And Europe is really, of the three major regions where you see EV sales growing around the world, growing at a very fast pace, Europe is really the weakest of those regions for Tesla. North America, no surprise, the home market, 350,000. China quickly catching up. The Giga plant in Shanghai is growing. And then you've got Europe. And again, they had to import all of those vehicles sold there in from China. That will change. That will make a huge difference in terms of European sales. And it's a big reason why when you take a look at their annual sales, they did 936,000 last year. They expect, or I shouldn't say they expect, I should say analysts expect them to report annual sales of 1.42 million for this year. It'll be interesting to see if they get there, Melissa, because like all automakers, they are seeing constraints in the supply chain, including with semiconductors. They've managed it better than a lot of other automakers, but they are seeing that pressure. And what we're seeing today with the Gigafactory in Berlin, we're going to see a repeat performance from Elon Musk, I bet, in a couple of weeks when they open up the Gigafactory outside of Austin, Texas. And remember, that Gigafactory, Melissa, it initially will be building Model Ys for the eastern half of the United States. Now, they're going to eventually expand, and they'll be doing the Semi there. There's also plans to do the Cybertruck there. But initially, it'll be for the Model Ys in the eastern half of the U.S.
Has there been any sort of commentary, Phil? I don't know if he actually talked to the press at this event about, I mean, I know that they've hiked prices, but just about the input costs and whether or not they've locked in at certain levels. I mean, things are still rising. Things are still elevated. And I'm wondering how far out they anticipated, you know, those costs to be higher.
We'll find out during earnings. He has made limited comments, most of them on Twitter, on social media, where he said, look, they are noticing the impact of higher commodity costs. I mean, they're not immune to it. The question becomes, have they been able to manage it better than other automakers? The fact that we've seen prices go up is not a surprise. Look, we see this with all of the automakers. As much as you will hear people say, well, we're keeping the MSRP within check, they're all raising prices. And they have to, because of what's going on with the supply chain. So we'll find out more in detail about whether they're managing it better than their competitors when the quarterly numbers come out in late April.
All right, Phil, thanks. Phil LeBeau.
You bet.
Guy, I can't decide if Elon Musk dances better than you or vice versa. The bar's low on both fronts. Where do you stand on Tesla here? It's been a big run.
First of all, you know the answer to that. I mean, if he dances better than I do, number one. He's also a lot smarter than I am. I think this is one. Look, it traded down to that $700 level. We pointed out why that was a great support level. I never thought it'd get back to 1,000 this quickly. So, you know, stock market, this individual stocks seem broken both on the downside and the upside. So my inclination here is that 903 level, which is a previous all-time high going back a couple of years, we will take a look at that again, and then maybe you can trade around that level.
It's amazing, though, the input costs and what the impact it could have on EVs specifically. I mean, in addition to chip shortages and raw materials to build the actual car, but the input costs going into batteries are high, too. Batteries need not just lithium, but nickel, copper, all these other metals in order to make them. So, Tim, I'm wondering what your view on that is, because they're going to have to raise prices.
Yeah, the scramble
again,
for rare earth and the competitive landscape, and we heard, you know, from Ford and how they're committed to it, and so I think there'll be enormous upward pressure on every component in that car. They've done a remarkable job to this point, especially in the semiconductor shortages and bottlenecks. But I do think it's a case of prices have to go higher for a company that really had a difficult time producing the Model 3 at the price they said they were going to. I realize they've spiked up on sales. The biggest issue issue for Tesla is not now. I mean, to be clear, it's definitely not about can they get the cars and can they produce them. It's really a question of, I think, the price you're willing to pay for the company. And if you look at that stock, this is like a lot of charts out there. It's somewhere 990. It actually may be breaking that downtrend from November highs. A lot of charts look like this, and you can make an argument that it broke through it, although, again, we've had an enormous snapback.
All right. Coming up, crypto's cruising higher, and one investor is shattering records with the launch of a new fund. The details ahead. But first, we've got a fast pitch coming your way. Forget the baseball puns, though, why this stock may be a hole-in-one investment. More on the pick when Fast Money returns.
Get your trades to go with the Fast Money Podcast. Catch us anytime, anywhere. Follow today on your favorite podcasting app. We're back right after this.
Welcome back to Fast Money. Callaway Golf bouncing more than 2% today. The stock has been struggling this year, underperforming the S&P by about 6%. But one hedge fund is betting big on this name. We're mixing sports metaphors, teeing up with a fast pitch with Eric Udoff. He's co-chief investment officer at Marlowe Partners. So, Eric, what's your number one reason why you're so confident in Eli?
Well, we have three reasons here. Overall, I think it comes down to valuation, the strong trends. So Callaway, as you know, sells golf equipment and apparel, and recently merged with Topgolf. So, number one, the strong industry trends, the reopening benefits Topgolf, and then golf overall has been doing very well. Number two, the complexity has made it more likely for there to be a mispricing, and then finally, there's the valuation itself. So, on the strong trends, the group business is really important to Topgolf, where most of the value lies in the company now. As the pandemic continues to subside, we continue to see strong and improving results and earnings beats. Taking a step back at golf overall, the industry's been on fire during the pandemic with work from home. You've seen rounds played up 20% versus 19 last year. We've seen 4 years in a row now of more golfers on the golf course. All this is what leads to earnings upside. the complexity making it more likely for there to be a mispricing. That's something, a pattern we like to see in investments, a better chance of being right. They struck this deal in 2020 at a good time. Stock's only a few dollars higher than there, despite the earnings and everything coming in much higher than planned. And then finally, the valuation itself, we're at the low end of the valuation range. Good way to look at it, it's EV to EBITDA. It's at the lower end of the range despite the business improving with this merger. Topgolf is more like Shake Shack. It's a high growth business, secular grower. And then finally, I'd highlight the insider buying. You have in December, the CEO and CFO bought shares. And then again, last week in bigger size, they bought more.
Guy's got a question for you. Guy?
Sure.
Quick question is this. I mean, would this fall into the category, valuation compelling? Absolutely. Is this simply a reopening trade? And if you believe the back half of 2022 is going to be robust, almost by definition, you have to own this stock?
We think so, yeah. If the group business comes back, that's one of the things that's made Topgolf such a good business in the unit economic level.
All right, Eric, thanks for coming on and fast pitching us. We're going to vote now. No more questions. So are you buying Eric's pitch on Callaway? Jeff Mills, what do you say?
I'm going to give it a big yes. You know, I believe in the Topgolf story. I think that is going to propel revenues in a way that justifies the valuation. And I also think kind of the flexible work arrangements being here to stay keeps people engaged in golf. So overall, I think it's got some runway here.
Tim?
Yeah, I like Topgolf. I'm worried about the capital intensity of that business in the short term, but I'm a buyer, and that's actually a golf club hitting a baseball, by the way. So it's just in case you didn't see that.
Mixing metaphors again.
Dan.
Yeah, I also would be a buyer. There's a great pitch there. And I'd be worried if I were Jeff's employer that flexible work situation and the golf thing that he just kind of teased us up on.
He lives on the golf course.
Yeah, seems troubling.
Guy.
Fair. Can you read my smart board? You might have heard him point out the insider buying. That's what I said. Read that, please, Mel.
CFO bought stock. Hashtag GSB.
Yeah. That, of course, Guy's smart board. Yeah, and you know what? Jeff Mills should be playing golf. That's part of the job description, Dan. Leave the general alone.
All right.
Thank you.
Eric, thank you. The traders have spoken. We're going to do our Twitter poll, though, here, because we want to know if you out there are buying Eric's pitch on Callaway. You can vote. Go to our Twitter at CNBC Fast Money. We'll bring you the results later on in the show. Coming up, a $1.5 billion VC fund. Why this one is shattering records. The details when Fast Money returns. Welcome back to Fast Money. Crypto investor Katie Haun shattering records with her debut VC fund, the largest initial fund raised by a solo female founding partner. For more, let's get to Kate Rooney, who sat down with Katie for her first interview since leaving Andreessen Horowitz last year. Kate.
Hey, Melissa. Yeah, Katie Haun raising $1.5 billion for her debut funds. Haun Ventures, as it's being called, will be split into two parts. There's $500 million for early stage investments and $1 billion for some of the later stage growth companies. She really did become a household name in crypto after co-leading the digital asset funds at Andreessen Horowitz and surprised a lot of people by leaving that firm in December. She was an early Coinbase investor and sits on that company board and says a smaller team will let her be more nimble. She highlighted the wave of big tech and Fortune 500 companies now getting into blockchain and says that shows its potential across industries.
Not a week that goes by where a new entrant, a new large entrant, isn't coming into the space. And I think it's just reflective of the opportunity and that it will touch all industries. It's no different than you see some of the big banks and big financial institutions when they started investing in and getting more inquisitive about fintech. They saw that disruption was coming, and I think it's really no different here with some of the Web 2 incumbents.
Haun has invested through multiple bear markets and says that she learned some lessons from deploying capital during what some call a crypto winter.
I learned that don't get too distracted by the prices, because during that deployment of that first crypto fund, you know, Uniswap, Solana, OpenSea, and many, many other projects were born during that cycle. And so one of the things I've learned as an investor with really a long-term view of the space is that great products are going to be built and great protocols are going to be built no matter what the prices are in the space.
Haun tells me Bitcoin prices and publicly traded crypto companies like Coinbase getting hit lately is not spilling over to private startup valuations quite yet, and the firm is investing in both the equity of startups and cryptocurrencies known as tokens, which tend to be more liquid. Melissa.
Kate, I'm not sure, if Katie thinks about it this way, but I'm wondering if there's any thought that there's competition for those dollars, that all those dollars are going into funds like hers, and she raised a lot of money, as opposed to coins themselves.
It's interesting that the venture capitalists are now competing sort of with the average retail investors. One of the things we talked about was the idea of certain founders and entrepreneurs not taking venture capital money at all and just raising token projects and saying they want it to be community-led. She said she's seen some examples of that. It does seem to be common that they're still being let onto the cap table, but it's definitely a new funding model in general, and I think there is a thought that it could eventually be a threat to the venture capital model. But a lot of competition there. She really is, like I mentioned, a household name, a brand name, and people want her on the cap table, but there's just a flood of money going into the space. CB Insights had a stat about $25 billion went into blockchain funding last year. We'll see if that can keep up as crypto prices go down and if investors are going to want that level of exposure.
$25 billion. Wow. Kate, thank you. Kate Rooney. You can watch the whole interview with Katie Haun on our website. Head on over to cnbc.com/cryptoworld. Dan.
You know what it reminds me of? Okay, after the dot-com implosion, right? So we had this big run-up in the late 90s, and then we had this implosion in the public markets, and VC was small, so relative to where it is right now. This is probably like investing in some Web 2 companies right now. We've already had that big run-up in 17, the winter in 18, 19. So to me, the timing seems great, and some of the biggest innovations in finance and tech are going to happen in this period.
I just think the regulatory framework right now is so constructive for seeing assets flow in. I mean, there's no question that regulators are starting to get their arms around. You're giving the ability of CIOs in big institutions the ability to actually go. More regulation means more adoption, means higher prices.
Coming up, grab your popcorn. AMC surging in today's session. That had options traders running to the ticket counter. How they're playing this one next. And there is still time to vote on Eric's pitch. Are you buying Callaway Golf? Vote in our Twitter poll at CNBC Fast Money. More fast right after this. Take a look at shares of GameStop rising in the after-hour session, up 4.5% on top of a 30+% gain in the regular session. Chairman Ryan Cohen increasing a stake in the company to 11.9%. So the chairman going deeper into GameStop, so then now we're seeing the stock. It was interesting because the filing dropped and there wasn't any reaction in the stock, and then now the stock is rising, so we'll keep watching this one. Meantime, Reddit stocks in general, they were rising in today's session. One of these names is seeing a lot of love among option traders specifically. Mike Coe has the action. Mike.
Yeah, so the name we're looking at is AMC, although I'll quickly point out that GameStop also traded more than 4 times its average daily call volume today. But AMC, this is one that traded well over 2 times its average daily options volume. That put it on the podium. It was number 3 in terms of single stock options volume contracts traded today, trading nearly 740,000 contracts overall, calls significantly outpacing puts. And the most active options were the weekly 20-strike calls that expire at the end of this week. Buyers were paying just under 40 cents to buy those, obviously betting that the rally that we've been seeing in some of these Reddit names might continue through week's end.
Mike, you said GameStop had a lot of activity as well. Was it anything very unusual? I mean, it was a 30% gain today, and then the chairman announces that he's increased the stake. I don't know. Makes you wonder.
It was about the 15th most active single stock option GameStop was, and it traded 4 times its average daily call volume, well over 200,000 contracts. That represents about 20 million shares. And to put things in perspective, when we're talking about these big volumes, if you have a float like AMC does of about 500 million shares, you're talking about nearly 15% of the entire shares outstanding that are trading on the option side in a single day. So this is pretty notable activity.
All right, Guy, you know, on your smart board before, you wrote CFO buying as it pertains to Callaway Golf. Here we have chairman buying an increasing stake. So is that a positive for GameStop?
So I know what you're saying. You got to be consistent, Swizz. If it's good for Callaway, it's got to be good for GameStop or AMC and you're right about that. And it's funny. I think the General was on when they reported GameStop, and we said, look, it wasn't an earnings story on the way up. It's not one now. I thought the stock would probably sort of continue to sort of gravitate back down towards 50, and here we are at 100. Again, just one more sign, in my opinion, of a market that's a wee bit broken, Melms.
All right. Mike, thank you. Mike Coe with the Options Action there. And for more Options Action, you can catch our full show every Friday.